So welcome to part 2 of accounts marathon. See, the reason why I'm doing this video again, like as an intro video to the marathon, is originally we thought of uploading 20-hour single video, but as per recent YouTube guidelines, video cannot be uploaded beyond 12. So the video was deleted originally after we upload. So again, we uploaded 12 hours at a stretch, approximately 11.5 hours. That is part 1 of the paper 1 group 1 accounting marathon of CA Intro. And now this is part 2 video. Remember, very important instruction, do not watch this part. This part 2 video, do not watch without watching part 1. First finish entire part 1 and then watch this part 2. See, remember, I know in this part 2 there are some topics which are covered, and I know you want to see only those topics, but remember, when you watch from the beginning till the end in a particular order, some topics, some points will be interconnected. Suppose accounting standards framework is explained in part 1 example, I think so. If you understand that, now in this part 2, any interrelated topics, it is very easy for you to understand. So kindly cooperate here for your best effort, for your best advantage, for your, getting the best clarity for you. First complete part 1 marathon fully, approx 11.5 hours. Then watch this part 2. Okay, so Satya sir will continue here the part 2. Okay, carry on. This will be approximately some 8.5 or 9 hours. That's it.
Very good morning, friends. In this video lecture, we are going to start with a new chapter, investment accounts, along with accounting standard 13. This chapter, we are going to deal in two parts. Part number 1, we will see exclusive matters related to AS 13. Once we finished accounting standard 13, accounting for investments, then we will start with main chapter, investment accounts. You know, as a separate standard, content is given in the study material, as well as separate chapter is also given. We are discussing both the contents simultaneously. That is the reason why I combine accounting standard 13 as well as main chapter investment accounts. Right, guys? Now, first let us have look into accounting standard 13, accounting for investment, as part 1 discussion. So in the first and foremost part, we are discussing AS 13, title accounting for investments. So we will see what are the contents to be covered in accounting standard 13 under overview. So let me develop overview first. In overview, you know, any accounting standard start with objective. That is, either you can call it as introduction or objective, anything. First we will deal this. Then we will discuss certain definitions, including very important definition of investment. The standard is all about investments. We will discuss investment definition. Along with that, we are going to discuss some other definitions. Then scope or applicability. Then we discuss about scope or applicability. Then classification of investments. Classification of investments we will see. Then we are discuss about measurement concept. Measurement. After measurement, we will discuss valuation of investments. Sir, what is the difference between measurement and valuation? So before doing a valuation of investment, we will see one more. What is that? I mean to say components of cost we will see. So after measurement, first we will see components of cost. Then we will discuss about valuation of investments. Then after valuation of investments, we will discuss about disposal of investments. Then reclassification of investments. Finally, we will end the standard with disclosures. Okay, how for accounting standard 12, accounting for government grants, we discussed the overview. In the same way, we are going to discuss first I'm going to give what are the contents need to be discussed in this standard. That is introduction or objective, definitions, scope, classification of investments, measurement, components of cost, valuation of investments, disposal of investments, reclassification of investments. Finally, we'll end up with disclosures. Now consider it, guys. Let us see one by one. So the first one is objective. You know, in objective, what we will discuss? The reason for existence of AS 13, right? Why accounting standard 13 is introduced? Accounting standard 13 is introduced to provide accounting for investments. To provide accounting for investments to be made in financial statements. So the simple objective of AS 13 is to provide accounting for investments to be made in financial statements. That means accounting for investment comprising of that it includes that is the measure at which value it is going to measure in financial statements. That is accounting for investments to be made in financial statements. That means it includes measurement as well, at which value it is going to measure in the financial statements. It will discuss about majorly such issues, guys, measurement issues. Okay, that is the primary objective of introduction of AS 13, at which value you are going to measure the investment in the financial statements, and the related accounting treatment we are going to discuss in this standard, or that is the reason for which this standard is separately introduced. Next, coming to the definition. Under the definition, the first and foremost definition we are going to see is investments. What is the meaning of investment? Tell me guys, all of you, investment is an asset or liability? Investment is an asset or liability? It is an asset. Investment is asset held by enterprise. Investment is an asset held by enterprise with an intention to earning, with an intention to earning interest, dividend, royalty, capital appreciation, extra. So investments are assets. Investments are assets held by enterprise with an intention to earning interest, dividend, royalty, capital appreciation, etc. But not for the purpose of usage of production of goods or rendering of services. That is important. But in bracket I'm mentioning, but not for use in production of goods or rendering of services. If that is a case, it will become property, plant and equipment. Am I right? What is the definition of PPU? We saw in AS10. AS10 are also tangible items which are used for production of goods or rendering of services. It includes rental as well, guys. I forgot to tell you. Interest, dividend, royalty, capital appreciation. So rather than royalty, let me write rent. That's better. Interest, dividend, rentals, capital appreciation. Royalty also it includes. That is not that much of material item. So I am excluding. So assets held by an enterprise with an intention to earning interest, dividend, rentals, capital appreciation. Then such assets we can classify it as, then such assets we can categorize it as investments. But it is not for use in production of goods or rendering of services. Okay. Next. One more thing, guys. Assets held as stock in trade, we may not categorize as investment. Assets held as stock in trade, I mean to say that is inventory, right? Assets held as stock in trade is an inventory. For example, if you are dealing with a particular product X as your regular course of business, then if you are made any investment under such inventory, which comes to the inventory but not as an investment, that's why asset held as stock in trade are not the investment. That point also I am mentioning here. Assets held as stock in trade, assets held as stock in trade, not treated as inventory. Sorry, assets held as stock in trade, not treated as investments. Not treated as investments. So that is the definition of investment, guys. Okay, I will discuss each and every point again through my text. So please allow me to discuss the remaining points as well at this stage. Okay, I'll again come back to my text. Then we will see each and everything what is given in my text clearly. Now coming to scope paragraph, scope or applicability. You know, scope or applicability. Sir, in case of scope or applicability, sir, is this standard is applicable to all type of investments? Yes, this standard is applicable to, of course, all type of investment. It covers each and every investment. but it does not deal with it does not deal with income generated by such assets. Income generated by such investments. It does not deal with income generated by such investment. I mean to say, sir, income generated by such investments means the income generated by such investment is nothing but either interest, dividend, royalty, rents, extra, is completely dealing based on accounting standard 9 revenue recognition. Actually, as per AS 9, revenue recognition is applicable. When should recognize such interest, dividend, royalty in the books of accounts, at which value it should be need to recognize, such all issues we are going to see through AS 9 revenue recognition. It is one of the group 2 standard actually. So that's why this standard is only purely applicable to investment only. Income generated by such investment is we are going to deal through AS 9. For such incomes, AS 13 is not applicable. Okay, next. Number 2, the standard is not also applicable for profit. No, sorry, not that. Yeah, this standard is not applicable in case of investment properties. Investment properties. You know how to measure investment properties? We already done in accounting standard 10 property, plant and equipment. What is the meaning of investment property? That is, if you make any investments under PPE, like buildings, maybe like plant and machinery, for the purpose of earning the rentals, then which are termed as investment properties. Am I right? So how we should need to provide the accounting treatment for such investment properties, which are covered under the definition of investment. If you check here, investment properties are covered under the definition of investment, which are assets held by an enterprise for the purpose of getting either rentals or capital appreciation. That's why investment properties cover the definition of investment. But how we are going to measure such investment properties? Tell me, guys. We are going to measure such investment properties based on cost model of AS10, right? Cost model of AS10 PPE. We already learned such facts in accounting standard 10 PPE itself. Under PPE, one of the expression I told that, and under investments, also I am telling one of the exception. You know why? It covered the definition of investment, but it covered the measurement principle. There in accounting standard 10 property, plant and equipment, it was not covered under the definition, it was covered under the measurement. So that's why, which is I'm telling under the exception of both the standards. So part of the content is covered through AS13, remaining part is covered through AS10. That's it. So that's why we are taking this one also under exceptional category. So for investment properties, AS13 doesn't applicable with respective to measurement. Next. Sir, in case of mutual fund companies, venture capital fund companies, asset management companies, banking companies, financial institutions, organized by central government or state government. Okay. For all these, AS13 is not applicable. You know why? Sir, for coming to banking companies, Banking Regulation Act 1949 is applicable. How to value the investment of a banking company which held as investment in equity shares, investment in debentures, investment in preference shares. We will deal based upon the Banking Regulation Act. Coming to mutual fund companies, the treatment is quite different because the treatment is completely depending upon the SEBI regulations actually. In case of mutual funds, the objective of the establishing the mutual fund company itself is it will pull up funds from the public. It will make investments on their own on behalf of the public, to getting some certain dividends or interest. Am I right? Simply, the objective of the mutual fund companies are they will pull up money from the public. They will make reinvest such things in different companies. So why uh, such activity can be directly made by the public now? Then what is the use of the mutual fund here? Maybe public have the money, but they may not have that much of knowledge on which particular investment going to be invested to get the best returns. So mutual fund companies are in generally administered by professionals, so they know know the latest market trends. They have good knowledge on all the securities. So based upon the information they are getting, they are making huge investments, and they also can easily do the bargains with the companies to get the best price. Why? Because they are making the huge investments. The brokerage charges, such all things are very less in case of mutual fund companies. So in case of mutual fund companies, venture capital fund companies, asset management companies, that asset management companies means is also one of the example. Mutual fund again will come in mutual fund. One asset management company is also there. At this stage, these all are completely irrelevant. Maybe okay, whenever your curriculum progress, I mean to say, whenever you are come across your CA final, then you will get all these things as a separate chapter: mutual fund, asset management companies, merchant bankers. Okay, so that's why I don't want to take that much of pain at this stage. So you are knowing all these things in future. So what are the case? Maybe if any investment held by mutual fund companies, venture capital fund companies, and asset management companies, and banking companies, and financial institutions organized by central government or state government, for such investments, accounting standard 13 is not applicable. Separate accounting guidelines are given for the purpose of valuation of such investments. Okay, but for banking company investments, we will check in our group to actually how a banking company investments is going to value, actually how they are going to classify the investment of a bank that is held for maturity, held for trading. Okay, so like that there are some categories given for a banking company investments. Okay, so we will available for sale. So such all things we will deal in case of banking companies case, not in this standard. So which we are dealing in Banking Regulation Act actually, right? Next, one of the last exception I'm dealing, guys. Now please all of you concentrate. Entities making investments for funds related to employee benefit expenses. Employee benefit expenses. I mean to say funds related to retirement benefits. I can write like this, that is better word. Retirement benefits. For example, each and every company should need to pay PF at the time of retirement, gratuity. So such all things for each and every year we will debit, we will put aside certain amount in the form of provision for retirement benefits or provision for employee benefits. For such investment, if you made with such fund, if you are making any investment in the outside market, for such investment accounting standard 13 doesn't applicable. Why? there is a separate standard called AS15 is there, employee benefit expenses. The standard title is employee benefit expenses. So AS15 is applicable, which is employee benefit expenses, guys. Okay, so almost here we did three things. Objective I completed. The definition of investment also got completed, which is definition of investments. Then scope or applicability also we deal. Am I right? Actually, one more important definition I need to tell, but I don't want to tell at this stage. So whenever that particular definition needed, I will explain at this point of time. Even though in the standard all the definitions are given at a single place, I'm going to define one more important term, which is fair value. So I already told you, I think so in AS10 or in some other standard, I already told you we are going to explain what is the meaning of fair value in AS13. Yes, in AS10 only, I think so. I gave a reference at the time of discussing impairment of losses somewhere, something. I gave the reference. We are going to deal the definition of fair value in AS13. Now this is the time to discuss fair value in this standard, but not now. So at the time of relevant place. Okay, that's it, guys. Now up to this discussion, let us have a look in our text, guys. Please, all of you concentrate. AS13 deals with accounting for investments in the financial statements of enterprises and the related disclosure requirements. It will provide the accounting treatment in financial statements as well as related disclosures. What are the disclosures need to be made under notes to accounts also, we will see in the standard as a final step, which is under disclosures. I already wrote the disclosures part also covered under overview, right? Okay. Next, definition. Investments are assets held by an enterprise for earning income by way of dividends, interest, rentals, or for capital appreciation or for other benefits to the investing enterprise. Assets held as stock in trade, inventory, are not the investments. Assets held as stock in trade are not the investments. Okay, we already made a conclusion. Assets held as stock in trade are inventory, but not investments. Just a second. Yeah. So assets held as stock in trade are not treated as investments because those are inventory. S2 inventory is applicable. Further. Next, come back. So investments are assets held by an enterprise for earning either income or for capital appreciation or other benefits, that is dividend, interest, and rentals. In the diagrammatic representation also I given clearly. Next, so fair value. I told you we are dealing at the right time. We are not dealing right now. At appropriate time, I will take for the discussion. Market value also. This is the general definition we know. Both we will take at later point of time, guys. The second definition and third definition. Next, coming to the scope. This standard does not deal with the basis for recognition of interest, dividend, rentals earned on investments which are covered by AS9. On which basis we are need to recognize such interest, dividend, rentals, we will see under AS9 actually. So interest we are going to recognize on time proportion basis actually. Dividends going to recognize on the basis of declaration of dividend actually at the time of declaration, that is right to receive the dividend established. So interest is on time proportion basis, dividend is on right to receive established. Such all things are completely new to you, which we are going to deal with AS9 revenue recognition. Okay, if you are my group 2 student, then you already know such things. Why? Because we already completed AS9 in group 2. Next. 1 second. So I forgot to tell you this under scope paragraph, that is operating or finance leases. In lesser point of view, he is talking. Sir, if you made any investment in the leases, then for such all leases, AS19 is applicable. AS19 is applicable as 13 is not applicable related to the leased assets. I mean to say investment related to leased assets. So right, in case of leases, AS 19 is applicable. Accounting standard 13 is not applicable. That is, lessor, how much amount he invested in the lease, how much amount he invested in the lease, such investments, AS 13 is not applicable, AS 19 is applicable. Okay, that point we missed out actually in my OneNote. So anyway, I covered through the text. Next, investment on retirement benefit plans and life insurance enterprises. That is simply for all insurance companies, not only for life insurance enterprises, for all insurance companies. For banking companies, insurance companies, AS 13 is not applicable. For retirement benefit plan, you'll know accounting standard 15 is applicable. Am I right, guys? Next, mutual funds, venture capital funds, and other related asset management companies, banks and public financial institutions formed under central or state government acts are so declared under the Companies Act 2013. So all these investments held up by these entities, these many entities are not covered by accounting standard 13. So I already told you the reason, the treatment, how we should made the accounting treatment is given in the respective regulations or in the respective act. Am I right? Now, under the scope or applicability paragraph, I'll add one more point. What is that? That is leases. Leases in case of operating and finance lease. In case of operating and financial lease. So for both which AS 19 is applicable, accounting standard 13 doesn't applicable. So you can add here in the companies, you can also add banking companies, can also add insurance companies as well. Now it is fulfilled. Okay. Now all of you come to my overview. So we completed objective or introduction, definitions is over, scope is also over, and the definition, two more definitions are pending from my side, which is fair value as well as market value. Now coming to classification of investment, guys, all of you please concentrate, this is important. Classification of investments. As per accounting standard 13, on the for the purpose of measurement, this classification is for measurement purpose. For measurement purpose. As per AS 13, investments are broadly categorized into two types for measurement purpose. Number one, current investments, and the other one is long-term investments. Current investments and another one is long-term investments. Another name for long-term investments is non-current investments. Non-current investments. Now, what is the meaning of current investment? Current investment is an investment. It is an investment held by enterprise with an intention to resell, with an intention to resell within 12 months. from the date of purchase. From the date of purchase. Then such investments are technically known as current investments. Current investments are the investments held by enterprise, investments held by enterprise with an intention to resale within 12 months from the date of purchase. Then such type of investments are known as current investments. Sir, here intention is important. Here at the time of purchase, the intention is important. Why? Because maybe the intention is want to resell within 12 months, but due to some issues, we are unable to make resale within 12 months. Maybe due to the huge price fluctuations, very lowest price quoted in the outside market, or maybe the technical issues in the stock exchange, or maybe any issue. I don't know. I don't know. So due to any issue, if you are really not sell within 12 months, then such investments automatically become long-term investments? No, that is not the case, guys. So that's why it is very important that at the time of purchase, what is your intention? If you want to hold for less than 12 months, then we can treat it as a current investments only, even though it took more than 12 months to really resell. Do you understand my point, guys? Here now the intention at the time of purchase of such investment is only important. So the reality is completely outrightly we are not at all considering here. Okay, now sir, what is the meaning of long-term investment? So long-term investment is nothing but other than current investment. Simply, very simple definition, other than current investments. So long-term investments are other than current investments. Now, sir, we saw the meaning of current investments as well as long-term investments. Now, all of you please concentrate about measurement, guys. Sir, we are making this classification only for the purpose of measurement, right? Now we are seeing the concept of measurement, which is the concept of measurement. What is the concept of measurement? Now, initial measurement, that is measurement at the time of recognition. Simply measurement at the time of recognition. That is another name is initial recognition. That is initial recognition. Then subsequent recognition. Here measurement as on balance sheet date, which is subsequent measurement. If you observe, for property, plant and equipment also, the measurement concept we applies in the same way. That is initial measurement as well as subsequent measurement. Am I right? That is, initial measurement as well as subsequent measurement. Both we discussed at the time of dealing AST property, plant and equipment. Measurement concept related to PPE, right? Now all of you concentrate. Sir, measurement at the time of recognition means measurement at the time of acquisition. At the time of acquisition of such investment, at which value it is going to measure. At which value it is going to measure. Sir, whether the investment is a current investment or long-term investment, it is either current or long-term investment. We are going to measure it. We are going to measure it cost to price, guys. We are going to measure it cost to price. Now come to here, measurement as on balance sheet date. It is completely depending upon the type of investment. So for that purpose only, we actually classified the investments that is into current as well as long term, right? Current, long term. Now current investments is going to measure as on balance sheet date at cost or fair value, whichever is lower. Cost or fair value, whichever is lower. Cost or fair value, whichever is lower. Now coming to long-term investments, long-term investment generally measured at cost to price. Generally measured at cost to price. But if there is permanent decline in the value of investment, but if there is decline in the value of investments, there is decline in the value of investment, other than temporary in nature, other than temporary in nature. If you check here, all the long-term investments are generally measured at cost to price only, generally measured at cost to price only. But if there is a decline in the value of investment other than temporary in nature, the decline is other than temporary, that means which is a permanent decline, other than temporary, that is which is for the long term, the decline will hold for certain long period, the decline is hold for certain long period, then we may measure it at which value? That declined market price. So generally measured at cost to price, but if there is decline in the value of investment other than temporary in nature, it should be valued at declined market price. It should be declined market price. It should be valued at declined market price. Now, so just I simply wrote the provisions, so nothing we discuss it till now. Please allow me concentrate. Now the real discussion going to takes place. Sir, in case of concept of measurement, at the time of acquisition of investment, at which value we are going to measure in books of accounts, which is nothing but cost to price, which is nothing but cost to price. Sir, cost to price means which consisting, cost to price consisting purchase price, cost to price consisting of purchase price non-refundable duties and taxes, which is non-refundable duties and taxes, brokerage charges. If any brokerage is there, such brokerage charges is also form part of cost of investment. Sir, purchase price means which is actually originally quoted price in the stock exchange, if the shares are quoted in the stock exchange. So otherwise the other party quotation price, we can make it as a purchase price. Non-refundable duties and taxes, maybe security transaction tax is applicable at the time of trading. Such all things are non-refundable duties and taxes. Brokerage charges means you can buy or you can sell the securities through a platform, right? Either you may buy or sell in the through stock exchanges with the help of brokers, popular brokers, Motilal Oswal. So I'll open here. If you check here, popular stockbroking companies. Okay, just a second. So let us open popular stockbroking companies here, guys. Popular stock broking companies in India. So if you check Zerodha, I'm using only Zerodha. The name of application designed by them is Kites, actually, which is known as Kite. Hope you can see that, guys. Kite, Kite, Kite is displaying in my mobile. So which is the application I am using, which is offered by Zerodha only. Upstocks. So the recent advertisement is coming actually in Upstock, Angel Broking, Grow, ICICI Direct, 5 Paisa, Kotak Securities, HDFC Securities, IAFL Securities, Motilal Oswal. Earlier I given this, right? A difference. Motilal Oswal, Sharekhan, SBI Securities, Axis Direct, Paytm Money, Geojit. Okay, so so many things given: Religare, SMC Global, Choice Broking, LS Blue. So certain 20 broking companies are given. What they do, all these broking companies, they are having accounts in the stock exchange. We are not having any accounts in the stock exchange. Such people are having accounts in the stock exchanges. Now they are giving sub accounts to us. So they are giving sub accounts to us. With such sub accounts, we may do certain trading activities. In general, in stock exchanges, who can trade, sir? And the persons who are having accounts with the stock exchange can entering into the transaction, can making transactions with the stock exchanges. So we are not having any account directly in the stock exchange. So those guys are having a good accounts. That is, they're already members of the stock exchange. Now, who are the members of the stock exchange are particularly known as brokers. Brokers having sub brokers, sub brokers having sub brokers. So those sub brokers are having certain parties like of the public. For each and every public person, they are giving some login IDs. Whenever we are entering through the login ID, each and every broker connected with the transaction will get commission. Actually, that is nothing but brokerage charges is also form part of the cost of investment. These are actually components of the cost. These are nothing but components of the cost as well. Now, as on the balance sheet date, if the investment is a current investment, that means the intention of holding of such investment is want to resell within 12 months, then we should compare the cost price with fair value. Now the next question coming into your mind is, what is the meaning of fair value? Am I right? Now this is the time to discuss the definition of fair value. Earlier we ignored, right? Now let us define the meaning of fair value. Fair value is a price, which is a price entered between knowledgeable willingful buyer and seller in an arm's length transaction. In an arm's length transaction, fair value is a price entered between knowledgeable willingful buyer and seller in an arm's length transaction. Now all of you concentrate. What is the meaning of arm's length transaction? Arm's length transaction means which is a final price, which is a negotiated price. For example, you went to a vegetable market, just you want to buy certain vegetables. Just now you asked the price of a cauliflower. The other party told 50 rupees. So each flower cost around 50 rupees. Now you may bargain with that person, right? Somewhat. Sir, can you give it for 40 rupees? Like that you may ask. Now, if the other party is willful for such price, then the other party will buy such cauliflower at 40 rupees. Now, even though he told 50 rupees initially, after completion of negotiations, the final bargaining price is happened in between the two parties is at the rate of 40 rupees, right? Such 40 rupees is known as fair value. So that means fair value is the final bargained price. Sir, both the parties having knowledge, both the parties are willful, both the parties having knowledge on the market price of the product in the market. So fair value is the price entered between knowledgeable, willingful buyer, and knowledgeable, willingful seller in an arm's length transaction. Arm's length transaction means such final negotiated transaction, the final willingful price derived from both the parties is known as fair value. Most of the times, either market value or NRV, either market value or net realizable value is evidence for fair value, because whenever you go for negotiation, other party will also check the real market price. You will also check the real market price. So nobody is willing to give at less than market price, and nobody is willing to buy at greater than market price, unless otherwise in certain special circumstances. For example, if those are the perishable goods, the customers are very low, then if they are unable to sell it by the seller, then he may lose the entire price. At that point of time, he may give less than market price. At that point of time, fair value is less than market price. Are you getting my point? So that's why most of the times fair value is either market value or net realizable value, is we can take it as a evidence for the purpose of deciding the fair value. But literally there is a difference between fair value and market value. There is a difference between fair value and market value. Market value is nothing but the value at which we can marketable a particular item in the outside market after incurring of related expenses is nothing but market value. So at how much price we can make it sellable, at how much price we can make it marketable in the outside market, such price is known as market value. Are you getting? There is the general price, general value having in the market is nothing but market value. You know that thing, right? Now come back here. If it is the current investment, the investment is going to be valued either at cost or fair value, whichever is lower. Then I have one doubt. Let us assume if the fair value is less than the cost price, then we are going to recognize at fair value, right? Then we are going to measure at fair value, right? Then such difference, what I should need to do? The difference, what I should need to do? The difference need to be charged to the profit and loss account. For example, if I'll write here itself, please consider it. If fair value is less than cost price, then difference is charged to statement of P&L. I'll give one example, please consider it here. So the example related to the current investment I'm giving here. So which is example related to current investment. So cost price of the investment is 10 lakhs and the fair value as on balance sheet date is only 8 lakhs. Then the investment is need to show at the rate of 8 lakhs, right? Now which entry I need to pass? Investment worth should be decreased by making the debit to the P&L. That is P&L account data 2 lakhs to investment accounts 2 lakhs. Now in your books of accounts, investment is automatically showing at the rate of fair value. At the time of purchase, always the entry is same. That is at the time of purchase. At the time of purchase, what is the entry, guys? At the time of purchase, the entry is investment account data to bank account. I don't want to go to roots of the treatment. Just the general accounting treatment we made. The real accounting treatment we are going to see through the main chapter, guys. So we are dividing into two parts, right? Part 1 and part 2. The main, the in deeper accounting treatment we are going to see through main chapter. Here only we are discussing about the measurement concept. Now, in case of long-term investment, sir, if there are temporary fluctuations are there, sir, cost price was 10 lakhs, but it declined to 8 lakh, but which is a temporary decline, again it will go up. So generally measured cost price, just the temporary fluctuations you can ignore. But if there is a decline in the value of investment other than temporary in the nature, sir, in general it is recorded cost price if there is a temporary decline. But if there is a decline in the value of investment other than temporary in nature, it should be valued at declined market price. It should be valued at declined market price. Now, at that point of time, you should also need to recognize the loss suffered. At that point of time, you should also need to recognize the loss suffered by showing such investment at the declined market price. That is the important point you have to remember. Now, come up, guys. Classification of investment I done. Along with that, I also discussed measurement as well. So here classification of investment we done, then concept of measurement also we clearly discussed, right? Then the next issue is components of cost. Components of cost I discussed in measurement itself, which is nothing but components of cost. But one thing I forgot to deal, please all of you concentrate. Knowing cost to price. Knowing cost to price of investments in these following situations. Knowing cost to price of investments. For example, if you purchase your investments by payment of cash, if you purchase your investment, purchase of investments, by cash, then cost of the investment is nothing but cash price paid to the other party. Am I right? Cash price paid is the cost price of the investment. For example, purchase of investment happened, purchase of investment by issue of securities. We are issuing our equity shares and we are acquiring equity shares of the other company, which are purchasing investment by issue of shares, by issue of debentures, by issue of bonds, anything. Purchase of investment by issue of securities. Then at which price you need to record? You need to record fair value of securities issued. Fair value of securities issued is the cost price of investment we are going to acquire. So fair value of securities issued means, for example, your issued securities are quoted in the stock exchange. Then in stock exchange, one price will be there. Na? Such price we can make it as a fair value. That is fair value of the securities issued. Purchase of investments. Purchase of investments by giving any other assets. By giving any other assets. For example, if we are giving our plant and machinery, we are acquiring investment in equity shares of X Limited. Then at which price I am going to record? That is the cost price of the investment, at which value we can assign. That is fair value of asset given up or fair value of asset taken up, whichever is more clearly evident. Whichever is more clearly evident. So if you really remember the concept of AS10, in case of exchange, in case of any PP acquired through exchange of monetary assets and non-monetary assets, some commercial substance exist or not, such all things we saw, right? But this is not an NDAS actually. So that's why simply here decided the cost to price of the investment. That is, if purchase of investment happened through giving another asset, then the acquired investment we are going to record it either fair value of the asset given up, that is fair value of the asset we are giving, or fair value of the asset taking, that is nothing but investment, whichever is more clearly evident. Out of the both the fair values, which fair value is more reliable, which fair value is more realistic, on the basis of such fair value we are going to record. Are you getting my point, guys? Just a moment. Yes. Okay. So this is related to a concept of knowing cost price of investment in certain circumstances. In certain circumstances, special circumstances. And one more thing, one more important concept just I want to deal related to investment properties, guys. You know, in case of investment properties, we already deal actually, no need to write. So investment properties, the measurement concept AS13 is not applicable, right? For the purpose of measurement concept, cost model of AS10 is applicable. I mean to say, cost model of AS10 means, for example, if you are making investment under the building, at which value it should be need to, at which value it should need to measure at the time of acquisition, which need to measure basis of cost only. Cost model means cost consisting of what are all the things, that is purchase price, directly attributable cost to bringing the PPE to location and condition, which is necessary in the manner which is necessary to operate in the manner intended by management, all the expenses you need to include, and decommissioning, restoration, and all other similar liabilities, all such things you need to include. Why? Because cost model means as per AS10 things are applicable, but the cost price means these things are not applicable. That point need to bear in your mind in case of investment properties. Okay, let it be, leave it. Then after components of cost and measurement, so the next issue we are going to deal is valuation of investment. Sir, what is this valuation of investment? Concentrate, all of you. What is this valuation of investment? Valuation of investments. All right, concentrate, guys. Sir, what is this concept of valuation of investment, sir? For example, if it is current investment, current investments. You know, at the time of subsequent measurement, we are measuring current investment on the basis of cost or fair value, whichever is lower. You need to compare cost and fair value, right? Now the question is, the comparison in between cost and investment should be need on individual basis or group basis. It should be done on each and every individual investment basis, or on the basis of, or on the basis of global, on the basis of entire classification. So in generally, current investments are going to be valued on global basis. Global basis means, what is the meaning of global basis? Global means on entire investments. On entire investment, we will compare. I'll open the clear text, just a second. Yeah, a second. Valuation of current investment on overall or global basis, it is not considered appropriate. It is not valuation of current investment on overall is not considered appropriate. Sometimes the concern of enterprise may be with the value of a category of related current investments and not with each individual investment, and accordingly the investments may carried at lower of cost and fair value computed category wise, that is equity shares, preference shares, convertible debentures, etc. However, the more prudent and appropriate method is to carry the investments individually at the lower of cost and fair value. So valuation of current investment on overall basis is not considered appropriate. Now come back. My OneNote, what he is telling, I will tell you. Please concentrate. Now, the valuation of current investments on global basis or on entire basis, global or entire basis, is not appropriate. He's telling which is not appropriate. On global basis or on entire basis is not appropriate. That is simply he is telling current investments are compared. That is the comparison in between cost and NRV. Sorry, cost and fair value, not NRV. Cost and fair value occurred on individual investment basis. He's telling individual investment basis. What is this individual investment basis? Individual investment basis means, for example, you purchased investments, you made investments in 9% preference shares of X Limited. You made investments in 5% preference shares of Y Limited. Now 9% preference shares, investment in 9% preference shares, investment in 5% preference shares, you can compare separately. You can compare 5% preference shares cost with fair value. You can compare 9% preference shares cost with fair value. That is the meaning of individual investment basis. But sometimes he given that sometimes it is prudent that comparison on category wise as well. Sometimes it is prudent that comparison on category wise. Category wise means, for example, you are comparing equity shares cost with equity shares fair value. You are comparing debentures, investment in debentures fair value with investments in debentures cost value. Maybe investments in bonds fair value with investments in cost. So that is the concept of valuation of investment. Valuation of investment means not related to measurement of investments. That is comparison in between cost and fair value, or as on which basis we need to done. That is on global basis or entire basis is completely not prudent, is completely irrelevant. So we should not made as on global basis. It should be done on individual investment basis. Actually, this is the correct accounting treatment, on individual investment basis. But sometimes it is prudent that comparison on categories wise is also okay. That is category wise means I already told you. So there is entire class, we can take it as a category. There is investment in equity shares, investment debentures, like that. Now coming to long-term investment, so no doubt about it, long-term investment always individual basis, always. Even category wise is also not possible here, always individual basis. Always individual basis. I'll read the paragraph once again for better understanding. Please concentrate. Valuation of investments, valuation of current investments on overall or global basis is not considered appropriate, is not considered appropriate. Sometimes the concern of an enterprise may be with the value of category of related current investments and not with each individual investment. Sir, if it is not overall an individual, but sometimes you can go for on behalf of each individual, you can go for related category wise, and accordingly the investments may be carried at lower of cost and fair value computed category wise, that is either equity shares, preference shares, convertible debentures, etc. However, the more prudent and appropriate method is to carry investments individually at the lower of cost and fair value. So the first preference you should give individually. After that you can go category wise, but overall basis or global basis is not at all correct. Long-term investments are usually individual importance to the investing enterprise. So the carrying amount of long-term investment is therefore determined on individual investment basis. On each and every individual investment, I will compare the cost and fair value. If there is a permanent decline, then I will record at the rate of that market value of the declined amount. Okay. If there is no permanent decline, then you can continue with the cost price. That comparison should be need to done on individual basis in case of long-term investment. That is the concept of valuation of investment, guys. All of you come here, come back to overview chart, guys. In the overview chart, what he given, let us have a look. So components of cost is also over. Just now we checked the valuation of investment. That is nothing but comparison in between cost and fair value should be need to made on individual basis or overall basis. Next, coming to disposal of investments, all of you, disposal of investments. Now we are seeing the concept of disposal of investments. So at the time of disposal of investments, any profit or loss arised, make it transfer to any profit or loss arised, it should be make it transfer to statement of P&L. We know, even though the provision is not given in AS13, we know that, right? Statement of P&L. That means what is the journal entry you need to provide? You can provide the journal entry like this. Please allow me to concentrate. I can give an example. Example, cost of investments is worth 10 lakhs. Now, sale price, A, sale price is 12 lakhs. B, sale price is 9 lakhs. Then how you should provide the accounting treatment? So coming to case A, what is the journal entry, guys? Bank account debtor. At which price you are going to sell? 12 lakhs. To investments account, 12 lakhs. Now you can compare sale proceeds with the cost price. Then you are getting profit, right? Now such profit you can make it transfer to P&L. That is investment account debtor to P&L. Out of this 12 lakhs, 2 lakhs is related to profit, right? So such profit you can make it transfer to P&L account. So rather than passing two entries, you can also pass one combined entry, that is bank account data to investment to P&L. But at the time of giving the posting, it's quite difficult. So that's why we are making it into split into two different entries: bank to investment, investment to P&L, nothing else. Now coming to case number B. In case of B, bank account data, you are selling at the rate of 9 lakhs, right? So the cost of investment itself is, investments cost is 10 lakhs, right? Now the difference, you can make it directly debited here. In case of debit, you can pass only one journal entry. That is more than enough. So in case of sale also, you can pass one journal entry, but for the purpose of giving posting, we are make it split into the two entries, nothing else. That is bank to investment, investment to P&L. Here bank P&L to investment. That is the concept of disposal of investment. Any profit or loss derived, it should need to be transferred to statement of profit and loss account. The next concept is reclassification of investment, which is highly important, number of times tested in the examination. Please all of you concentrate. Reclassification of investments. What it means, reclassification of investments. You know, reclassification means previously which is current. Now we are reclassified to long term. Current to long term. Is current to long term. In the same way, long term to current. So current to long term and long term to current. So in case of current to long term, all of you concentrate. At the time of reclassification of current to long term, so now till now, those investments are treated as current investment, right? Now, once if you convert it into long term, then you can never compare with the fair value. Once if it go with the long term, I mean to say, never compare with fair value means unless otherwise there is a permanent decline in the value of investments, you are not carrying the investments at such declined market value. Am I right? So the temporary declines, the temporary fluctuations, you may not consider once such investment becomes the long-term investment. That's why you will never get a chance to decrease the value of investment in future if there is a temporary decline. So that's why what you will make right now itself, if at all any temporary decline is there, I mean to say at the time of comparison of cost with fair value, if fair value is less than the cost, then you can decrease the cost value of the assets at fair value right now itself, even though if it is a temporary decline. Why in future you may not get a chance for such temporary decline. You may not get a chance for accounting for such temporary decline. That's why at least right now you can made it for the account for such temporary decline. That's why from current to long term, at which price you need to carry in the books, it should carry that is investments need to carry cost or fair value, whichever is lower. If it is in case of long term to current, sir, in future you are always comparing with cost with fair value only, but right now, which is a long term investment, you are converting into the current investment. So that's why investments need to carry at cost or carrying amount, whichever is lower. Cost or carrying amount, whichever is lower. You know the meaning of carrying amount, right? Carrying amount means the price at which it is shown in the books of accounts. Now in your books, how much? The cost price is how much? You can compare cost or carrying amount, whichever is lower. At price you can carry in your books of accounts. Why you are not comparing with fair value here? In any way, it is a converting into current investment means you are making comparison with the fair value as on balance sheet date. Why you are hesitating right now? Why? Because it is becoming as a current investment in future. You should always comparing the cost with fair value only in future. So that's why no need to compare the fair value at right now at the time of reclassification of long term to current. So how you can remember, how you can interpret this, don't be by heart simply, okay? But this concept is highly important. Why they are asking so many number of times? So people are in generally confusing. But how you can appreciate the concept is, if an investment is going to convert, reclassify from current to long term, in future we will never get a chance to compare cost with fair value. Why? Because once if it become long term, unless otherwise if the decline is a permanent decline, we may not carry the investment at such declined market value. So that's why we may not get any chance to account for such investments by making comparison with the fair value in the future. So that's why at least you can make compare right now with cost with fair value, whichever is lower you can record. So that's why investment need to carry at cost or fair value, whichever is lower. Now, in case of long term to current, in future, you are getting always a chance of comparison with cost and fair value. Now, right now, you can record, you can carry such investment at cost or carrying amount, whichever is lower. That is investment need to carry at cost or carrying amount, whichever is lower. Hope you get the content, guys. So you can remember in the same way how I interpret it. Next, and the last issue, guys. So last issue, we completed reclassification of investment as well, and the last issue is disclosures. So now let us going to disclosures, guys. So certain contents we not yet discussed with text, I know. So once I finished it, then I will discuss such issues with my text as well. In disclosures, what we are going to disclose, accounting policy or accounting method used for valuation of investments. Used for valuation of investments. Accounting method used for valuation of investments means what is that on individual basis na or category basis na or on global basis na. In generally global basis is not possible, it was clearly given. So on either individual basis or category base, how you are making the comparison, that policy you should need to give. That policy you should need to give. Accounting method used for valuation of investments. Number two, in statement of P&L, in statement of P&L related to investments. So related to investments, interest, dividends, rentals, etc. How much credited? Be profit or loss on disposal of current investments you need to disclose. In the same way, profit or loss on disposal of long-term investment also you need to disclose. Next, you need to provide a disclosure of quoted and unquoted investments as well. You know the difference of quoted and unquoted? Quoted means those investments which are traded in the stock exchange, which are coding on the general basis, which are nothing but quoted investment. Unquoted investments means, sir, if the enterprise is not a listed company, if you are invested in the equity shares, such equity shares are never quoted in the stock exchange, which are nothing but unquoted investments. Maybe the investment in the lands, investment in the buildings, all are unquoted investments only. That is quoted and unquoted investment also you can clearly provide as a disclosure, guys. So these all disclosure you need to provide under notes to accounts with respect to AS 13. Okay, now all of you come back for my text. So I don't want to give any mind map, guys. The standard is very small. We started our journey with introduction or objective. In case of introduction, what we learned, the basic objective of introduction of this standard is for the purpose of providing accounting treatment related to investment in case of financial statements. So it will also discuss things related to the measurement of such investment as on balance sheet date as well as at initial time, that is at the time of acquisition. In definition, we check the definition of investment. Investments are the assets held by an enterprise with an intention to earning interest, dividend, rentals, or capital appreciation, but not used for production of goods or rendering of services. Assets held as stock in trade or not treated as investment. This is inventory. We are valuing as per AS2. In scope or applicability, income generated by such investment doesn't deal by AS13. AS9 is applicable. Related to investment properties, the measurement concept is applicable based on AS10. AS13 measurement concept is not applicable. Next, mutual fund companies, venture capital fund companies, asset management companies, banking companies, that is life insurance companies, and financial institutions who are established through the separate act by through central government or state government for all such investment held by such enterprises. AS13 is not applicable. Such specific rules or regulations or the specific acts are applicable. Entities making investment for funds related to retirement benefits, AS15 employee benefit expenses is applicable. Sir, investment made in case of leases, AS19 is applicable. Accounting standard 13 is not applicable. Here AS19 is applicable. AS13 is not applicable. This is related to scope paragraph or the applicability paragraph. Then we discussed about the classification of investment for measurement purpose, current investment and long-term investment. Current investments are those investment held by an enterprise with an intention to resell within 12 months from the date of purchase. Long-term investment is simply other than current investment. Now we discussed the concept of measurement, that is measurement at the time of recognition, that is initial recognition, that is initial measurement. At the time of acquisition investment, we are going to measure at cost to price only, that is whether it is current or long term, we are going to measure at cost to price only. Such cost to price comprising of purchase price, non-refundable duties and taxes and brokerage charges. But as on balance sheet date, that is subsequent measurement, we are going to measure either measure based upon the investment is current investment or long-term investment. If the investment is the current investment, it should be measured at cost or fair value, whichever is lower. If the investment is a long-term investment, generally measured at cost price. But if there is a permanent decline in the value of investment or the decline is other than temporary, then it should be valued at the declined market price. Am I right? Next, what is the meaning of fair value? Fair value is the price entered between knowledgeable, willingful buyer and knowledgeable, willingful seller in an arm's length transaction. So either market value or net realizable value is acting as a best evidence for knowing the fair value. Then we discussed the concept of knowing the cost price in special circumstances. If you made purchase the investment for cash, then cash price paid is the cost price of the investment. If you purchase the investment by issue of your securities, then fair value of the securities issued you can assign as a cost price of investment. Then purchase of investment by giving any other asset, then fair value of the asset given up or fair value of the asset taken up, whichever is more clearly evident, we can assign as a cost price of investments. Then we discussed the concept of valuation of investment, how you should need to compare cost price with fair value. In case of current investment, you need to compare on individual basis especially, but in certain cases category wise investment comparison is also tenable, which is also prudent. In case of long term investment, you should always made on individual basis. Am I right? Coming to the disposal of investment, any profit or loss arised at the time of disposal, it should need to be transferred to the statement of profit and loss account. We saw the journal entries as well. Coming to the reclassification of investment, if it is current to long-term investment, then you should need to measure, or then you should need to carry the investment at cost or fair value, whichever is lower, because in future you will never get a chance with comparison of cost with fair value. Now coming to long-term to current investment, you will get a chance to comparison in future with cost with fair value. That's why right now you can carry with cost with carrying amount. You can compare cost with carrying amount, whichever is lower at such price, you can make it carry in the books of accounts. Then finally we end up with the concept of disclosures. In disclosures, what we made, sir, accounting method used for valuation of investments, we should need to disclose. Then in the statement of P&L, interest, dividend, rentals, how much you recorded, that is how much you credited, profit or loss on disposal of current investment, profit or loss on disposal of long-term investment, and quoted and unquoted investment, you should need to provide as a separate disclosure under notes to accounts. Now let us have look into our text. What are the parts we missed in our text? Let us see here, guys. Yeah, now please concentrate. We already discussed some issues. Objective over, definition is over, fair value. I told you we will discuss it later. Now let us see. Fair value is the amount for which an asset should be exchanged between a knowledgeable, willing buyer and a knowledgeable, willing seller in an arm's length transaction. Under appropriate circumstances, market value or net realizable value provides an evidence of the fair value. So definition of the market value, it is quite in general. It is the amount obtainable from the sale of an investment. That is simply sale proceeds of an investment in an open market, which is net of expenses necessarily to be incurred on or before disposal. So scope paragraph you already discussed earlier. Then classification of investment. Current investment is an investment that is by its nature readily realizable and is intended to be held for not more than 1 year. Not more than 1 year from the date on which such investment is made. The intention is to hold for not more than 1 year is to be judged at the time of purchase of investment. So the judgment, the intention is important. So in real, whether we are not holding for 12 months or not, no need to check. So the intention, the judgment is important only at the time of purchase of investment. At later, the judgment may change. For that purpose only, we are inserting the concept of reclassification of investment, right? If your intention is changed to holding as a long-term investment, then you may reclassify it into the long-term investment. Then reclassification provisions are applicable. Then coming to long-term investment is an investment other than current investment. Now coming to the concept of measurement, at the time of initial measurement, both current and long-term investment measured at cost price only. At the time of subsequent measurement, the carrying amount of current investment is the lower of cost and fair value. Any reduction to the fair value debited to the profit and loss account. However, if fair value of the investment is increased subsequently, the increase in the value of current investment up to the cost of investment is credited to the profit and loss account. What he is telling, for example, as on balance sheet date, cost is 10 lakh, fair value is 8 lakh. Now you are comparing cost with fair value. Now you are recording the investment at 8 lakhs, right? At a later point of time, let us assume the investment increased to 12 lakhs. In the next balance sheet date, so the cost will not change, which is 10 lakhs, right? Right now the fair value is 12 lakhs. Now what I need to do, cost or fair value, whichever is lower, means I need to record at 10 lakhs. But earlier we recorded 8 lakhs, right? Now from such 8 lakhs to 10 lakhs, you can increase by making credit to the P&L by passing the entry investments to P&L account. You can increase up to the cost of the investment only. However, if fair value of investment is increased subsequently, the increase in value of current investment up to the cost of the investment is credited to the profit and loss account. Any excess portion is ignored. Okay. Long-term investments are usually carried at cost, but if there is a permanent decline in the value of long-term investment, the carrying amount is reduced to recognizing the declined amount. The reduction in carrying amount is charged to the statement of profit and loss account. The reduction in carrying amount is reversed. We can be reversed at later point of time when there is a rise in the value of investment, as like point number 2 of point A. The same point is given at later point of time. If there is a reverse, then we can make it reverse. If there is a rise, we can make it reverse up to the cost value of investment only. Okay. Now in the diagrammatic representation, I simply given investment, current investment, long-term investment, initial recognition, both are at cost only, but subsequent recognition lower of cost and fair value. Here cost only, but provision for other than temporary diminution. In case of permanent diminution is there, we may create a provision. That provision we need to reduce. Okay. Next, cost of investment. Cost component contains, that is, if you are acquired through cash or bank, cash price including charges such as brokerages, fees, and duties. Cost includes brokerages, fees, and duties, and initial purchase price. If you are making issue of shares or other securities, then cost of investment recorded at fair value of the securities issued. In exchange for another asset, fair value of the asset given up or fair value of the investment acquired, whichever is more clearly evident. I discussed all these things in detail through diagrammatic representation. Next, coming to investment properties. Sir, for investment properties, AS 13 is not applicable related to the measurement concept. AS 10 is applicable with respect to the cost model. An investment property is an investment in land or buildings that are not intended to be occupied substantially for use, or it is only acquired for the purpose of earning rental, not for the purpose of use or operations of the investing enterprise. For the purpose, if it is used in the operations of the investing enterprise, it will become a PPE actually. Then it will not become investment property. Am I right? That is the only difference between PPE and investment property. If such investment property If such PPE is used for the purpose of earning rentals, then which is treated as investment properties. If the same is used for in the operations, then which is treated as PPE. That itself creates the difference. An investment property is accounted for in accordance with cost model as prescribed in accounting standard 10, property, plant and equipment. Next. So this point I ignored in my OneNote. Now I'm going to discuss. Please concentrate, guys. The cost of any shares in a cooperative society or a company, the holding of which is directly related to the right to hold the investment property, is added to the carrying amount of investment property. For example, our company is X Limited, guys. We are going to purchase a building or an apartment. Let us assume which is an apartment. We are going to purchase an apartment. Okay. So why you are going to purchase such apartment? Just you are make it as a investment for the purpose of earning the rental income or capital appreciation, anything. Now for such apartment having society, who can buy or sell the apartments in the society? The party who want to buy that apartment, or if any party who want to sell that apartment, first such party should become member of the society. That is the rule of such society. Member of society. You know why such type of rules and regulations are framed by the society? At the time of purchase or sale, that fact should be first known to the society members. Why? Because which is an apartment culture. If any person want to buy, if he is not a right person, then they may not accept. So related to the society, may they have the community feelings, or may they have the cultural impacts. So such all things they are maybe taken into consideration. So the same level of persons also they may take, maybe. So due to checking of all these rules and regulations, so just initially such party should become the member of the society. When at the time of become the member of the society, only they can buy or sell such apartment. Now X Limited want to buy such apartment. First it became a member by paying certain membership fee. Now this membership fee is also form part of cost of apartment. You know why? This membership fee is necessary to bringing, necessary to make such investment. Any cost which is directly attributable or necessary for acquisition of investment is also form part of the cost of investment. That's why in this case, the cost of any shares, that is becoming a membership fee in a cooperative society or a company, the holding of which is directly related to the right to hold the investment of property. If you holding such a membership, if you are holding any shares in such society, then only you can become the owner of that apartment. Then the cost of such membership fee or the cost of such shares is added to the carrying amount of the investment property. That is the general point he is given. Okay, let it believe it. Next, coming to disposal of investment. On disposal of an investment, the difference between carrying amount and disposal proceeds, net of expenses, is recognized in the profit and loss account. We already done with that. Reclassification of investment, where long-term investments are reclassified as current investment. In future, you will get a chance of comparison with cost and fair value. That's why right now you can make it carried at cost or carrying amount, whichever is lower. Transfers are made at the lower of cost and carrying amount as on date of transfer. When the investment reclassified from current to long term, then in future you will not get a chance to compare of cost with fair value. Now you can compare transfers of made at lower of cost and fair value. Here cost and fair value given, here cost and carrying amount is given. That is important, guys. Next, reclassification diagram given. So that is long term to current, transfers made at cost and carrying value, whichever is lower. So current to long term, so which is cost or fair value, whichever is lower. Valuation of investment we already done. Then finally we end up with disclosures, guys. And the disclosures, the accounting policies followed for valuation of investment, that is made on individual basis or category wise. The amounts included in profit and loss account, interest, dividends and rentals, you should need to show separately. Profits and losses on disposal of current investment, profit on disposal of long-term investment, the aggregate amount of quoted and unquoted investment also you should need to segregate separately. So this is the content just they are given. So from this, the content related to the main chapter actually. So we divide into two parts, right? This is the part one content, guys. Purely we discussed on accounting standard 13 theory. In the next video lecture, what we are going to discuss, I am not dealing with theory of part two. First, let me complete problems based on AS 13. We are approximately having 4 problems. So once I will finish these 4 problems, then I will entering into the part 2 discussion, that is the main chapter discussion. So this is for the day, guys. This is for the end of the lecture. This is end of the lecture. We are going to discuss problems in the next forthcoming lecture. Until bye, have a nice day. Hi students, welcome to the main chapter, investment accounts. In last couple of lectures, we discussed about AS13 content. Now this is the time to discuss about the content related to the main chapter, investment accounts. Sir, uh, I already told you at the inception of this chapter, as a part 1, we are discussed AS13. As a part 2, we are going to discuss the main chapter, investment accounts, right? Sir, how AS13 is quite different from main chapter? AS13 is majorly focuses their entire their entire provisions on that measurement principles, valuation mechanisms, okay, that is initial measurement, subsequent measurement. On such all issues, it gives their focus. Treatment at the time of disposal, am I right? But the major accounting treatment, I mean to say, journal entries. So we are going to deal through the main chapter, investment accounts. So for the purpose of providing accounting treatment, on the basis of providing the accounting treatment, on accounting treatment purpose, for accounting treatment purpose, investments are broadly classified into two types. Investments are broadly categorized into two types, that is fixed income bearing securities and variable income bearing securities. One is fixed income bearing securities and another one is variable income bearing securities. Fixed income bearing securities, variable income bearing securities. I mean to say how this classification is going to occur based on the income generated by such assets. For example, the income generated by such assets is fixed over the period, constant is over the period, consistent over the period. Then we can call it as fixed income bearing securities. The income generated by such investments are variable in nature. Then such investment we can call it as variable income bearing securities. If I will give certain examples, then you can understand very clearly. In case of fixed income bearing securities, examples are investments in debentures. We will get fixed amount of interest. Bonds. Bonds may be issued by the government or bonds may be issued by the company. Any bonds. Investments in debentures, bonds, extra. Here, the classic example is investment in equity shares. In case of equity shares, the dividend is not constant. So depending upon the profitability of their enterprise, they may declare the dividend. According to their dividend making policy, they will declare the dividend. Am I right? So that's why for variable income bearing securities, we can take investment in equity shares as classic example. Next, guys. Now, first, we will discuss things related to fixed income bearing securities entirely. After that, we are going to discuss about variable income bearing securities. Sir, what are the issues we are going to deal, sir? At the time of purchase of fixed income bearing securities, what is the treatment we need to do? At the time of disposal of such fixed income bearing securities, what is the accounting treatment we need to do? In between, as on due date, if at any point of time we are getting interest on such investment, what is the accounting treatment we are need to do? So simply the following accounting treatment we will see in case of fixed income bearing securities. So what are such treatments, you know? What are such treatments, you know? That is, we are going to see treatment at the time of acquisition, at the time of acquisition or purchase, at the time of receipt of interest. We are getting that fixed income is nothing but interest, right? At the time of disposal, at the time of disposal of such investments. Now consider all of you one by one. So I'll discuss one by one in very in detailed way. Now, first we are going to see at the time of purchase of investment, guys. At the time of purchase of investments. I'll explain the entire accounting treatment through a small illustration, guys. Please all of you concentrate here. So our company is Rani Limited. Our company is Rani Limited. We hold investments in Razu Limited. Let us assume we hold investments in Razu Limited. Which investment, you know? Investments in debentures of Razu Limited. Investments in debentures of Razu Limited. You know, the rate of debentures is 5%. Let us assume the rate of debentures are 5%. So in case of Razu Limited, the interest is going to be due. The interest actually due dates for the interest. So the due dates are which is 30th September and 31st March. These are due dates for payment of interest. These are due dates for interest payment. Okay. Now all of you concentrate one by one. Now we are purchasing investment in 5%. We are making investment in 5% debentures of Razu Limited as on 1st May 2021. We are in the year 2021-22. Let us assume 2021-22. Now, as on 1/5/2020-21, we are purchasing. We are purchasing 1,000 debentures. We are purchasing 1,000 debentures. You know, each and every debenture having face value, right? You know that, right? So the face value of the debenture is 100 rupees. So here itself, just we are mentioning face value is 100 rupees per debenture. Face value is rupees 100. So we are going to purchase 1,000 debentures at the rate of 102 rupees per debenture. At the rate of 102 rupees per debenture. Now all of you please concentrate. For example, we are purchasing these debentures not from Razu Limited, right? If Razu Limited debentures are quoted in the stock exchanges or not quoted in the stock exchanges, these debentures were already issued in the past. That means these debentures are held by some other parties. We are not directly purchasing. We are making investments in the debentures of Razu Limited, but we are not going to purchase from Razu Limited. That point you have to remember in your mind. Unless otherwise in the primary issue, unless otherwise in the primary issue, we never held investments, we never purchased the investment, sorry, we never purchased the investments directly from the investee company. We may purchase such investment from the other party who hold such investments. Am I right? Okay, now we are purchasing these debentures from other party. Okay, now concentrate. The other party we are going to purchase as on 1st May 2021, right? Now, if he holds such investment in the hands of the other party only, as on 30th September, as on 31st March, he will get interest. Now, if the other party sold out such investments to me as on 1/5/2021, he will lose entire 6 months interest. He will lose entire 6 months interest. But one thing is sure, the other party will think that, sir, out of such 6 months, I holded this investment for 1 month already. That means the last date of payment of interest is 31st March. After 31st March, up to 1st May 2021, 1 month expired, right? So to that time period, so out of the entire 6 months, for this time period of 1 month, the other party holded such investments. That means the other party will think that I am foregoing such interest, will ultimately giving that interest part is also to Rani Limited. Because once I purchase such investment, as on the next due date of the interest, as on 30th September, I will get 6 months interest, even though I am holding only for 5 months. Even though I am only holding for 5 months, I am getting 6 months interest. That's why the other party will expect, apart from the value of investments, he will also expect interest component as well. Interest component as well. This point is clear to all of you guys. I'm writing the same one. Please consider here. Other party will expect interest from last date of payment to up to date of purchase, of investments. The other party will expect interest from last date of payment to up to date of purchase of investment by investor. That means it is the responsibility of the investor to make payment of this interest along with the value of investment. Am I right? Now all of you please concentrate. Now, how can I pass the journal entry? Now I am purchasing the investments, right? That is investments account debtor. How many number of units I'm going to purchase? 1000 number. Each debenture is going to purchase at 1 or 2 rupees. Face value is different. So maybe the debenture is going to purchase at more than face value or less than face value or at face value is also possible, right? So 1000 into 1 or 2 rupees, which is 1,02,000. Am I right? Which is 1,02,000. Next, I need to pay interest also, right? Interest in expenditure, which is debited, right? So interest is an expenditure. So interest account debtor. Now I need to check the interest amount. Interest should be always calculated on face value. Even dividend is also always given by the company on face value only. Interest will never calculated on the purchase price. So interest will be always calculated on the face value. So 1000 debentures, face value 100 rupees into rate of interest 5%. For how many number of months I need to compensate to the other party? Only for the time period holding of such investment by the other party. That is only for 1 month out of 12 months. That is into 1 by 12. I need to pay only for one. Why? Because this 5% is per annum, right? That is 1 month interest only need to compensate to the other party. That is 1000 into 100 into 5% into 6 by 12. How much, which is 2500 I need to compensate. So the total amount need to pay right now to bank account, which is 1 lakh 4,500, which is 1,04,500. All of you please concentrate. For example, he told that that is the other party who willing to sell such investment right now. He told that I want to sell this investment at the rate of 104.5. At the rate of 104.5. I'm telling the another scenario. So which is as on 1/5/2021. Now we are going to purchase the investments. Now we are going to purchase the investments. Thousand debentures at the rate of 104 per the debenture. So that is, sorry, 104.5. 104.5 per debenture. No need to pay interest foregone by investing. No need to pay interest foregone by other party. For example, if he told like that, then he included the interest component also here, right? If we given 104.5 as a quotation price, even though he is telling that no need to pay interest foregone by the other party, he already included, right? Why? Because the original cost is 102 rupees per debenture. Now interest is 2500 rupees, means 2500 divided by 1000, which is 2.5 rupees. 102 plus 2.5, that is 104.5. That means what it means, that is what it means, you know, interest foregone by other party included in the quotation price. This is known as quotation price. Always the price which is quoted by the other party is known as quotation price. Interest foregone by the other party included in quotation price. Sir, in this case, what is the journal entry? The same journal entry need to pass. The same journal entry you should need to pass. That is investments account data. Now all of you please concentrate here. Now what is the cost value of the debentures? You know, 1000 into quotation price, first 104.5, which is not the real cost of investments, right? Interest component is included in that, right? How much interest component is included? That interest component you can reduce to get the cost value of the investment. You know, the interest component is already 2500. You know that. So which we are getting 1,02,000 here. Now interest component you should need it calculate separately. That is interest account debtor, which you reduced here out of the total quotation price, na, which is 2500 to bank account, which is 1,04,500. Why I'm mentioning in two different cases? Why I'm mentioning as two different cases, you know, If the other party is provided the quotation price as 1 or 2, this quotation price is exclusive of interest. We are known such quotation price as X interest quotation price. Such quotation price we will make it termed as X interest quotation price. If the other party will tell the quotation price inclusive of the interest, so interest foregone by the other party included in the quotation price, then such quotation price we will make it termed as cum interest quotation price. Cum interest quotation price. The intention of the other party is same in case of X interest quotation price or cum interest quotation price. The thing is, in case if he coding the X interest quotation price, apart from the quotation price, he will also expect interest separately. If he code the cum interest quotation price, he will not expect interest separately. He already included interest in such quotation price itself. It is simply to telling the terms. Here I'm explaining the terms differently related to the quotation price as well as interest. Here I'm explaining the terms, the cost as well as interest by clubbing into the quotation price. That is the only difference. Ultimately, here also he is getting the total 1,04,500. We are paying 1,04,500. Here also we are paying total 1,04,500. There is no difference in journal entry as well. But in the problem, how they are mentioning the quotation price, based upon that, we should need to estimate the cost value of the investment as well as interest and the amount payable to the other party. Now, if the quotation price given in the problem is X interest quotation price, then cost of the investment itself is the quotation price. Am I right? Cost of the investment itself is the quotation price, which is the cost of investment. Interest we need to calculate from the date of last date of payment to up to date of purchase. This is same, which we are going to calculate from last to date of payment to date of purchase. In the last date of payment to date of purchase, we need to calculate the interest. Then what is this bank amount? That bank amount, we can get it as a balancing figure. That bank amount is, we can get it as a balancing figure, which is combination of quotation price plus interest actually. Am I right, guys? Now come here, all of you. Now the amount, if the quotation price given is the cum interest quotation price, the amount payable to the other party itself is quotation price, which is a cum interest quotation price. Anyway, you need to calculate interest from last date of payment to last date of payment to date of purchase. Last date of payment to date of purchase. What about the cost of investment, which is actually, you can derive it as a balancing figure, which is quotation price. The cost value of investment is nothing but quotation price minus interest, which is quotation price minus interest. You can check all these things, guys. What I put in boxes, all are important. Don't by heart anything. So just to understand the concept. That means if the other party is providing the quotation price on X interest basis, that is without adding the interest, if it will tell the quotation price, then cost of investment is the quotation price. Interest need to calculate from last date of payment to up to date of purchase. Then the bank balance we will derive as a balancing figure, which is a combination of quotation price as an interest. If the other party is providing the information which is inclusive of interest, which is nothing but cum interest quotation price, then bank balance itself is the quotation price, and cost of investment we will get as a balancing figure, which is the difference between quotation price as well as interest. Interest in the as usual way we will calculate from last date of payment to up to date of purchase. One thing is sure, always interest should be need to calculate on the face value only from the last date of payment to up to date of purchase at the time of acquisition of investments. This is the concept of ex interest quotation price as well as cum interest quotation price. How would you deal at the time of acquisition of investment? Just now we discussed the concept of acquisition of investments. Am I right? Now, at the receipt of interest, what is the treatment? All of you please concentrate. At the receipt of interest, at the time of receipt of interest. For example, in the given situation, they told that the due dates are as on 30th September and 31st March, right? Now we are as at 1/5/2021. Now let us go to 30th September 2021. That is the due date as on 30th September 2021. Then we will get interest on the debentures hold as an investment, right? So bank account data. How many debentures we hold? 1000. Face value how much? 100. Rate of interest how much? 5%. How many number of months we need to get? For 6 months. They will only pay for the 6 months into 6/12. So now which is 1000 into 100 into 5% into 6/12, which is equal to 2500. Then how the interest earlier also we get 2500? One second. Here actually this is not 2500 yeah. This is I got 417. Sorry. Okay, I got 417. I don't want to change the example now. What I will do, just a second. One second. I'll change the figures. I wrongly mentioned the amount of interest. If I calculated, I got, which is 417 only. Am I right? You would have you would have observed such point at the time of calculation of interest itself, but we are in the recording mode, so that's why I'm changing now itself. So the total is 1,02,417. Here it is how much? 1,02,417. So now 1000 debentures not at the rate of 104.5, which is 417 divided by 1000 means 102.417, which is 102.417 per debenture. Okay, now everything will settle. Here also you can change, which is 417, which is 1,02,417. The concept is same, guys. Just I'm changing the figures. The interest calculation part is changed. The concept is same. That is, earlier we quoted 102 rupees in case of ex interest quotation price. In case of cum interest quotation price, we are quoting at the rate of 102.417 per debenture. That's it. Nothing is different. The concept is same. That is how we are mentioning the quotation price, the last date of payment, up to date of purchase, and the balancing figure. Quotation price is interest and ex interest. In cum interest also, all the content made it under the boxes are exactly same what I discussed earlier. Now, as on 30th September 2021, I'm getting 6 months debentures, 6 months interest, right? That is 1000 into 100 into 5% into 6/12, which is total 2500. Bank account data to interest on investment. Actually, this is interest on investments in debentures account, which is 2500. Now you can observe one thing, sir. We are holding only for, sir, we hold it only for 5 months, but how you can recognize interest for 6 months? Is it correct, sir? Yes. we are recognizing the 5 months interest only. How we are recognizing, either in case of ex-interest quotation price or in case of com-interest quotation price, you recognize the interest of 417 as an expenditure. Here also you recognize the interest of 417 as an expenditure, which is 1 month interest. 1 month interest you recognize it as an expenditure. 6 months interest you are recognized as an income. The net interest is, consider all of you. The net interest is 6 months interest income minus 1 month interest as an expense. So which is 2500 minus 417, which how much? 2500 minus 417, which is equal to 2083. 2083 interest only you may credit it to P&L. You may credit it to profit and loss account. So that means you are recognizing 6 months interest as an income and 1 month interest as an expense. That is net 5 months interest as only the income. 5 months interest is only the income you are recognizing. Only you are recognizing as income. That point you need to remember, guys. Just a second, just a moment, guys. So hope you understand the content. That is, at the time of receipt of interest, what is the accounting treatment need to provide it, how we should deal, and how much amount of interest we are really recognizing the statement of profit and loss account. Also you understood, right? Now the next issue is at the time of disposal. Please allow me concentrate. Now coming to the concept, the accounting treatment need to follow at the time of disposal. At the time of disposal, it is simply at the time of sale, right? Now first let us assume, I'll give one scenario. Our company is Rani Limited, right? Now Rani Limited selling 500 debentures at the rate of 103 per debenture. Rani Limited is selling 500 debentures at the rate of 103 per debenture. Sir, at the time of purchase, we are asking the other party, right? It is ex-interest quotation price or com-interest quotation price. We are asking the other party. In the same way, at the time of selling, the other party will also ask us, sir, you are coding this 103 per debenture, right? Sir, is it ex-interest quotation price or com-interest quotation price, sir? Let us assume this is ex-interest quotation price only. In the actual practice, if nothing was mentioned, which is ex-interest quotation price, if something is mentioned it as a com-interest quotation price, then only you can consider it as a com-interest quotation price. If nothing was mentioned at all, then you can call it as ex-interest quotation price. You can call it as ex-interest quotation price. Now, as on which date this is happened, actually, this is going to happen as on, let us assume 1st December 2021. Am I right? Now what you should know, now what should you do, right? First, you are selling your investment means first you need to calculate profit or loss derived through sale of investment. How much profit or loss you derived? First, let us calculate profit or loss derived through this sale. Can you please tell me, all of you, sale proceeds, how much you are getting here? Profit or loss means you are always comparing sale proceeds with cost price of the investment. That is, sale proceeds is equal to, sir, I'm selling 500 debentures. In such debenture, interest component is not included. In such quotation price, interest component is not included. That is 500 into 103 towards for the purpose of valuation of investment, I'll get 500 into 103 rupees. That is 500 into 103. How much I got? 51,500. Now you should compare with cost value of investment, huh? Less cost price of the investment. Now all of you can tell me 1000 debentures cost how much? 1,02,000, right? 1000 debentures cost how much, guys? 1,02,000. For 1000 debentures cost, if it is 1,02,000, then for 500 debentures cost, how much? Which is equal to cross multiplication. You can do 500 into 1,02,000 divided by 1000, right? Divided by 1000, which is equal to 51,000. So sale proceeds 51,500. Cost price of the investment is 51,000. Now, may I know profit or loss here, guys? Profit of rupees. Difference is how much? 1,500. So difference is 1,500, guys. So which is 1,500. 1,500 or 500, guys? 51,500 minus 51,000. So simply you are getting 500 rupees. That's it. Okay. 1 rupee per debenture, 1 into 500 equal to 500. Okay. 500 is the profit. Now all of you concentrate. First you calculated the profit or loss, right? Now total you are getting 51,500. Out of 51,500, 500 is for profit. Remaining 51,000 is the real cost of investment. Now apart from this 51,500, you are also get interest as well, right? Why? Because you are holding such investments from 30th September to 30th November. That is up to 1st December. I mean to say October, November, 2 months. 2 months you are holding the investment, but the other party will get 6 months interest as on the due date. But right now, the other party should needs to compensate. How you compensated at the time of purchase of investment? In the same way, the other party should needs to compensate for the 2 months interest. For such 2 months you holded the investment, right? That means how much interest you are getting. I'll directly write with the journal entry. Please all of you concentrate. What is the journal entry? Bank account data. First you are getting. So how much worth we are getting? That is 500 debentures into 103 sale proceeds. Am I right? Sale proceeds you may get. Apart from this, you will also get interest. Interest for these debentures. 500 debentures into 100 rupees face value into 5%. How many number of months of interest you are foregoing? 2 months, 2 by 12. Am I right? So which is total how much? I'll write the total at later. Bank account data to investments in 5% debentures account. So which is nothing but 500 into 103, which is sale proceeds, which how much we got? 51,500. 51,500 for interest. Interest is an income, na? Interest should be created, na? Bank to investment to interest. At the time of purchase, you debited the interest component, right? You debited the interest component. Now you should need to credit the interest component. How much interest? That we already represented in a bracket. 500 debentures into 100 into 5% into 2 by 12. Which is how much, guys? 500 into 100 into 5% into 2 by 12. So which is 417. I got 417, guys. Yes, it's correct figure, which is 417. So the total amount is 51,500 plus 417, which we got 51,917. That is the total, right? 500 plus 417 is 917. 51,917. So which is the total of sale proceeds plus interest component. But till now you not recognize the profit or loss, right? Now at the time of sale of investment, how to recognize the profit? Bank to investment, investments to P&L, right? Now you can recognize the profit by writing the entry investments out of this 51,500. 500 is related to profit, right? Investment in 5% debentures. That is investments in 5% debentures account debtor to profit and loss account, which is the profit 500 rupees. Am I right, guys? Sir, if it is the last situation, what I should do, sir? In the first entry itself, you can make debit the P&L. You can make debit the P&L. If it is the profit situation, in case of profit situation, for the purpose of making posting, I am dividing a single entry into two entries: bank to investment, bank to investment, investments to P&L. If it is the last situation, bank account are profit and loss account are to investment account. Okay, so interest component is additional, guys. Interest component is additional you are getting. So that's why for interest related, the bank component I included here, as well as interest, the credit aspect also I included here. Now, please all of you concentrate. This quotation price is X interest quotation price, right? Now, in case of X interest quotation price, which is sale proceeds is nothing but quotation price. Interest you should need to calculate from last date of payment to date of sale. Date of sale. There, from last date of payment to date of purchase. Here, last date of payment to date of sale. Now, bank we can derive as a balancing figure, which is sale proceeds plus interest. Which is sale proceeds plus interest. Am I right, guys? Are you with me, all of you? Now, just now we saw if the sale happened for X interest quotation price. Am I right? If the same sale is happened for cum interest quotation price, how it would occur? Now let us have a discussion. Concentrate, all of you. Now the same concept I'm explaining. 500 debentures going to sell at the rate of 103.834. 103.834 per debenture. In bracket, which is X interest quotation price. Sorry, cum interest quotation price. We done already X interest, right? In bracket, we can mention which is cum interest quotation price. The same issue I'm going to deal, guys. First, you should calculate profit or loss, right? First, in the same way, calculation of profit or loss. First, you need to calculate profit or loss. That is calculation of profit or loss. Consider it, guys, all of you here. While calculating profit or loss, you should need to compare sale proceeds with cost price. Then only you are getting profit or loss. Sale price with cost value. But this quotation price is cum interest quotation price. That point bear in your mind. The quotation price is cum interest quotation price. That means in such quotation price, interest is also included. First, to get the real sale proceeds towards the value of investment, you should reduce the interest component. Now, all of you, please consider it here. First, you should start with cum interest quotation price of investments to be sold. Cum interest quotation price of investment to be sold. Total, I am selling 500 investments. that is 500 debentures into 103.834. How much? 500 into 103.834. So I got 51,917. 51,917. So which includes the interest component, guys. First, you should reduce interest from last date of payment to sale is equal to 500 debentures into 100 rupees into 5% into 2 by 12. Am I right? Last date of payment to up to date of sale. Sir, interest, the same amount of interest we already calculated here. 500 into 100 into 5% into 2 by 12, which is 417. We got 417. First, if you reduce the interest, then you are getting sale proceeds. Sale proceeds, which is 51,500. Now you can compare the sale proceeds with cost price of the investment. Cost price of investment. You know the cost price of the investments in the same way how you calculated here. For 1,000 debentures, 1,02,000. For 500 debentures, how much? Which is same, which is 51,000. I'm directly writing. Which is 51,000. Earlier we already calculated. Now profit how much? 500. Same. Earlier how much you got the profit, here also same. But earlier you told the quotation price of 103 excluding interest. Right now you are telling the quotation price 103.834 including the interest. That is the only difference. Okay. Now, how to present the journal entry? Bank account data. You are selling 500 debentures. You are getting 103 point. Common interest quotation price how much? 103.834. Simply. Which inclusive of interest as well as sale proceeds. Total 500 into 103.834. 51,917 total you are getting. Two investments in 5% debentures. The sale proceeds you are getting 500 into just a second. I'll calculate later to interest. First, let me calculate the interest to interest account. Okay. So interest is 500 into 100 into 5% into 2 by 12. So the interest component, same interest component you are getting, which is 417. How you know the sale proceeds, guys? How you know the sale proceeds? So the sale proceeds, you know, from the common interest quotation price. If you reduce the interest component, you are knowing the sale proceeds towards sale of investments. That is nothing but 51,917, which are common interest quotation price minus interest, which is 417, which is sale proceeds of 51,500. Now all of you, please concentrate here. So the bank is nothing but quotation price here. In case of common interest quotation price, the bank, how much amount you are getting is nothing but quotation price. Interest you should need to calculate from last date of payment to date of sale. Sale proceeds, how you are getting, which is nothing but sale proceeds, right? Sale proceeds is balancing figure you are getting, which is the difference between quotation price and interest. Don't by heart anything, guys, just to understand the concept. So once if you are habituated to write these journal entries, these will automatically coming into your mind. So there is no difference of profit, there is no difference of interest, there is no difference of writing the figures as well. But the only difference is in case of X interest quotation price, Sale proceeds itself is the quotation price. You calculated the interest total you are getting as a bank, which is a balancing figure. In case of commenter's quotation price, bank itself is the quotation price. You calculated the interest in the normal way. Now sale proceeds itself is the balancing figure, which is the difference of quotation price and interest. That is the way of recording the figures itself is different, but the ultimate amount of figures are same, whether you follow the commenter's quotation price or ex-interest quotation price. Why all such differences occurred in between ex-interest quotation price and commenter's quotation price is, in case of ex-interest quotation price, they are telling the quotation price exclusive of interest. We are adding the interest somewhat addition to the quotation price. In case of commenter's quotation price, they are included the interest and the quotation price itself. So at the time of knowing the real proceeds throughout for the purpose of sale, you are reducing the interest component from the quotation price as like this. That is the only difference. So otherwise there is no difference in between ex-interest quotation price and commenter's quotation price. Entries are same, amounts are also same, but the way of writing such amounts are quite different from ex-interest to commenter's. Now, sir, at the end, what you should need to do, right? That is, we acquired, we are getting interest, we are selling something. So like this up to the last date of the current financial year, so many transactions are going to occur. Now, as on balance sheet date, you need to measure the investments. That is subsequent measurement. Now, subsequent measurement, you know, right? Already we learned it through AS 13. That is the reason why both the chapters combinedly we are doing. The measurement of the investment as on subsequent date is completely depending upon whether the investment are current investment or long-term investment. If the investment is a current investment, we are going to measure at cost or fair value, whichever is lower. You can take the basis reference of market value as on 31st March of such particular year. Then you can compare the cost price of the investments which are holded by you. Now, in this case, you already sold out 500 debentures. Now, on your hand as an investment with you, you are only having 500 debentures. For these 500 debentures, you need to value the cost price of the investment. It should be compared with the market value of the investment. That is cost price or fair value, whichever is lower, you need to record. For example, if the fair value is less than the cost price, you need to record the difference as loss on valuation of investment, which should be debited to profit and loss account. No. If the fair value of the investment is more than the cost price, you need to continue the value at cost price. You need to continue the value of valuation of investment at cost price. That thing you already know through accounting standard 13. That's why I don't want to disturb at this stage for the valuation of investment or the measurement of investment as on balance sheet date, guys. Okay. If you want, I'll write that one as well. What is that? So, you know, measurement as on balance sheet date, right? So as on balance sheet date, you can check the investments are current investments or long-term investments. You can check investments are, yeah. So you can check investments are current or long-term. So if the investments are current, you need to record cost or fair value, whichever is lower. You need to record cost or fair value, whichever is lower. In case of long term, in generally at cost, unless there is permanent decline. Now here, just a moment. For example, if fair value is less than cost, what is the consequence? So if fair value is less than cost, And if fair value is greater than cost, tell me guys, if fair value is less than cost, loss on valuation of investments, loss on valuation of investment debited to P&L, right? Debited to P&L by passing the entry P&L account debtor to investments account. If fair value is greater than cost, then as on balance sheet date, what I need to do? Continue to show investments at cost to price. Okay, so like this you should need to account for. So now coming to the long-term investment, it is cost unless there is a permanent decline. So that's why if nothing was given, simply we should measure it at the cost price only. But if it is at recorded permanent decline, then again we should need to we should need to recognize the loss on valuation of investment. The same thing. That's why I don't want to again repeat the same point for the long-term investment. So in general, we can make it recorded cost price. Now, all of you please concentrate. We started our journey here by discussing accounting treatment at the time of purchase of investments, both in case of X interest quotation price given or cum interest quotation price is given. At the time of receipt of interest, which accounting treatment need to do, also we discussed. At the time of disposal as well, what is the accounting treatment need to follow, we discussed. Am I right? Then finally, we discussed the concept of valuation of investments as on balance sheet date. That is measurement of investments as on balance sheet date. If the investments are current investments, if the investments are long-term investments. So this measurement concept is not only applicable for fixed income bearing securities, the same measurement concept is applicable both in case of variable as well as fixed income bearing securities for both. So this is applicable both for fixed income bearing securities fixed income bearing investments and variable income bearing investments. For both, measurement principles are same. That is current or long term. It will depends not on fixed or variable. Okay, guys. Next, some important implications here. Just I want to tell you. Now, the implication is at the time of disposal. Where is the disposal? Here at the time of disposal. Please all of you concentrate. So at the time of disposal, now we have different investments purchased as on different dates. Now in the problem, if we given that particular investments we are going to sell, then we can easily calculate the cost price of such investment. Am I right? But in the problem, if he was not mentioned which investment you are going to sell. For example, in opening balance, we are already had certain investments. In between, we purchased one lot. After that, we purchased after 1 month, again, we purchased another lot at different prices. Now he simply told that we are selling certain number of debentures at the rate of certain price. Then we can assume which debentures they are going to sell. Which debentures they are going to sell. If that instance is occurred, if that is the situation we are in, then how should we deal, you know? Then how should we deal? We should apply average cost method. What we will apply? Average cost method. What is the meaning of average cost method for the purpose of calculation of cost of the investment to be sold, we assume that on an average, selling investments from all different lots acquired at different dates. In case of average cost method, we assume that on an average, selling investments from all different lots acquired at different dates. So then how to calculate cost price of investments at that point of time? We will check total number of debentures. That is total number of investments. For such total number of investments, what is the total cost? Then for number of investments sold, cost price is how much? That's very simple. For all the existing total investment, what is the total cost now? Now the number of investment to be sold, cost is how much? That is nothing but simple average cost method. Here I'll tell you one more point, guys. What is that? For example, if the shares are held as stock in trade, I mean to say, if investments are held as stock in trade, if investments are held as stock in trade, which we are treated as inventory, but still the valuation mechanism and accounting treatment AS13 is applicable. Only for the purpose of knowing the definition, we are trading as inventory, but for the purpose of valuation and measurement, all such things AS13 is applicable. If investments are held as stock in trade, then we will use cost formula as per AS2. Then we will use cost formulas as per AS2. Do you remember the cost formulas which are used in AS2? We may use FIFO method. We may use weighted average cost method. That's why if the investments are held as stock in trade, then FIFO method is also possible. Cost formulas includes FIFO method, weighted average method as well. Weighted average. As per AS2, we may use FIFO or we may use weighted average. You already know what is the meaning of average cost method. FIFO method means we can assume that at the time of sale of investments, we are selling from the first purchased lot. We can assume that in case of FIFO method, we are selling the investment right now out of the investments which are purchased from the first lot. Are you understand? Now, in case of average cost method, we can assume that on average, we are selling from all the lots of investment. That is the only difference. So we will come across these scenarios while doing the problems as well. I'll discuss such things in detail once again at the time of doing problems. So now the crux of the things, what we learned in case of main chapter is at the time of providing accounting treatment, investments are broadly categorized into two types: fixed income bearing securities, variable income bearing securities. Related to fixed income bearing securities, at the time of acquisition, at the time of receipt of interest, at the time of disposal, we learned the accounting treatment both for common interest quotation price as well as ex-interest quotation price. We also done with the measurement as on balance sheet date, that is depending upon the current investment or long-term investment. So if fair value is less than the cost price, you need to provide the loss on valuation of investment debited to the profit and loss account. If fair value is greater than the cost price, then you are continue to shown at the cost price. In case of long-term investment, simply at cost, unless there is a permanent decline in the value of investment. But for the examination purpose, they are asking to prepare ledgers of a particular investments. They are not asking to pass any journal entries. In the examination, just they are asking to provide ledgers of a particular investment. But till now, in my entire discussion, I only deal the journal entries, right? If you have good command on the journal entries, you can simply draft the ledger related to a particular investment. That is not a big matter or a big deal for you and for me as well, because once you have good conceptual clarity on journal entry, we can simply make it post into the respective ledger, nothing else, right? So I'll show you the magic of preparation of the ledger and how we are going to prepare a particular investment account through problem number 5. Through problem number 5, I mean to say 4 problems we completed as form part of AS13. Now this is the first problem we are dealing based upon the main chapter. And one more thing, at the time of sale of investment, to calculate the cost price of investment, you should be a little bit cautious which method we are using. So unless otherwise anything is not mentioned, if anything is not mentioned, or unless otherwise something is mentioned, you should apply that method. Unless otherwise something is mentioned, you should apply that method. If nothing is mentioned, then you may apply average cost method. In the problems, at the time of doing problems, if you clearly given that you should need to value the cost value, you should calculate the cost value of investment based on FIFO method, then you can use the FIFO method. If nothing is mentioned, then you can apply the average cost method. You know why? Sir, if nothing is mentioned means you are holding the investment not as stock in trade, then you should apply the cost value method. Then you can apply the average cost method. If something is mentioned like FIFO method means then he is holding such investments as stock in trade, then at that point of time only we can apply the FIFO method. Those are the provisions actually given in the standard itself. Okay. Now, without wasting much time, let me entering into the problem, that is problem number 5, guys. Or before doing the problem, it is better to read the content in the text as well. So first, let me quickly see the content given in my text. After that, I will start with problem. Please, all of you have a look, guys. Here, classification of investment on the basis of income, categories of investment on the basis of income, fixed income bearing scripts, variable income bearing scripts. In case of fixed income bearing scripts, the examples are investment in government securities, debentures, or bonds. Here, example is investment in equity shares. Investment in equity shares. Next, coming to fixed income bearing securities. These refer to securities having fixed return of income. Investment in government securities or debentures comes under this category. Transaction for fixed income bearing securities may occur on the following basis. They may quote on ex-interest basis or they may quote on cum interest basis. Exclusive of interest they may quote, or inclusive of interest also they may quote. You know, interest means at the time of purchase from the last date of payment to up to date of purchase. At the time of sale, last date of payment to up to date of sale. In case the transaction is on ex-interest basis, the amount of interest accrued to the date of transaction has to be paid in addition to the price of the security. Simply, apart from the cost of the investment, you need to pay interest from the last date of payment to up to date of purchase of investment. That is the point he's conveying. So the following entry, investment account at R, interest account at R to bank account. We already done all these things with my OneNote. I don't want to once again giving a reference. Okay, we already done. Okay, this star marks, what is the meaning? Actually, he is explaining all such things, or how you should need to account for all such things. I already explained in my OneNote. Now coming to point number 4. In case the transaction is on a common interest basis, a part of the purchase price is related to the interest accrued from last date of payment to the up to date of purchase. That is, date of transaction means either date of purchase or date of sale. Hence, in this case, the cost of investment has to be calculated by subtracting that interest part from the quotation price. Okay, so the following entry, same investment interest to bank, but how you can derive the cost of the investment, which is quotation price minus interest component. Bank balance here itself is the total quotation price, which is the total amount paid. Next, when the interest amount is actually received, so he is discussing about the treatment related to interest. It is entered in the income column of the credit side. That is, in our journal entry we made, we till not made any discussion related to the ledger. He is telling in ledger point of view, we already made, we should give a credit to interest account itself. So the net effect of these entries will be that the amount credited to the income will be only the interest arising between the date of purchase and the one on which the next falls due. So I already explained this through my OneNote, guys. Sir, how much interest we are going to recognize ultimately under credit side, which is actually we are going to recognize the net interest only. Am I right? The net interest only. We are going to recognize the net interest only into the statement of P&L account. So 6 months interest we are recognizing as income, 1 month interest we are recognizing as an expenditure. That difference we are going to make it credit to the profit and loss account. Am I right? Next. Coming to the note point. Interest amount is always calculated with respect to the face value. Interest or a dividend, whatever the case may be. In case of fixed income bearing securities, interest. In case of variable income bearing securities, which is dividend, we should value on the basis of nominal value, face value only. In case the quotation does not specify whether it is X interest or cum interest, the same will be treated as X interest quotation price as per the general practice. So I already told you this issue as well. If nothing was mentioned in the problem, whether the quotation price is X interest quotation price or cum interest quotation price, we should always it as a X interest quotation price. No, don't read the variable income bearing securities. We will check the later. But one thing, disposal part is here pending. Please all of you consider about the disposal part. Difference between the carrying amount and the disposal proceeds, which are nothing but sale proceeds and the cost price of the investments. Net of expenses. What is this net of expenses, sir? For example, at the time of sale, you may incur certain brokerage expenses. If you incur any brokerage at the time of purchase of investment, you may include such brokerage into the cost of investment. You know, already we saw in accounting standard 13 cost of investment comprising of purchase price, non-refundable duties and taxes and brokerage. Now, at the time of purchase, any brokerage expenditure incurred, it is form part of cost of investment. You should add back. Now, at the time of sale of investment, if you incur any brokerage expenses, to know the net sale proceeds, you should make it net of the expenses. So now sale proceeds less brokerage, then you will get net sale proceeds. Now such net sale proceeds you can compare with the cost value of the investment to get the profit or loss. So difference between the carrying amount and the disposal proceeds net of expenses is recognized in the P&L statement. When part of the investment is disposed, carrying amount is allocated to that part on the basis of average cost method. Average cost method, I mean to say, sir, different lots we purchased. Out of this, only part of the investment only we sold out. Then which part we are going to sell out? Which part we can assume? Sir, you should apply the average carrying amount method. That is simply average cost method you can apply. If investments held as stock in trade, cost of stocks disposed is calculated as per cost formula as per AS2. That is, you can apply the FIFO method in that case as well. That means simply how we are following at the time of resolving the problems. If nothing is mentioned, we will follow the average cost method. If something is mentioned, we will follow that method. If nothing is mentioned, we will follow average cost method. Why? Just we assume that investments are not held as stock in trade. But if something is clearly mentioned like FIFO method, then we can assume that investments are held as stock in trade. Then we will apply the cost formula as per AS2. Okay, next. So still he is discussing about fixed income bearing securities, something. Please all of you concentrate at the time of disposal only. In case the transaction is on cum interest quotation price, the amount of interest from the last date of payment to up to date of sale is credited to the income column. We already made bank account data to investment account to interest account. Income column means here interest column. Only the sale proceeds net of accrued interest. This is cum interest quotation price, na? Out of the total quotation price, interest is also there, na? Now to get the sale proceeds, you make it separate the interest column. Now you are getting the sale proceeds. It is credited to the capital column of the investment account. Actually, he is again telling in ledger point of view what we will make the entry bank account data to investments to interest. Now interest will, sorry, you will made interest separate credit. Now the sale proceeds, you will make it credit to the investment account. Investment account, which column? That is nothing but capital column he is telling. Okay. Next. What is this capital column? All such things I am going to explain through problem. No worries. That we know we should make it credit to investment account. In case the transaction is on X interest basis, entire sale proceeds is credited into the investment column itself. So the capital column you can replace with investment account itself. And the amount of accrued interest from the last date of payment to the up to last date of sale separately received from the buyer will be taken to the credit of the interest column of the investment account. Here also entry same, bank to investment to interest. Here sale proceeds itself is the quotation price in case of X interest quotation price. Now the interest component you should need to calculate separately. The total amount is nothing but the bank balance. Okay. So we will see this value in capital column of investment after discussing the ledger. So let us, for the time being, you can ignore this table, guys. So once I'll finish it off, the problem number 1, that is, I mean to say, problem number 5, based on this fixed and comparing securities, again, we will discuss this table. Then I can correlate each and everything. Come back, guys, all of you. So what we discussed in my OneNote, the same thing just now we saw through our text. Now this is the time for discussing problem number 5. Please all of you concentrate, guys. The following information, once again, the following information is presented by Mr. Jed, who is a stockbroker. You know, in general, in stockbroker, who is holding the stocks on as stock in trade actually. Maybe he may calculate the cost price of the investments by applying the cost formula as per AS2. I mean to say FIFO method, I think so. So it is given under FIFO method at the end as well, because he's a stockbroker. Anyway, that and all actually irrelevant information for us. In which method, if it is given, we will do the problem in such method. If nothing is mentioned, we will do it under average cost method. That is another issue. The following information is presented by Mr. Z, a stockbroker, relating to its is holding in 9% central government bonds. Okay, bonds are also classic examples for fixed and comparing securities. Opening balance, that is face value rupees 1,20,000, cost price 1,18,000, face value of each unit is rupees 100. So in generally how the investments are going to represent, just given through second sentence, that is 1,20,000 face value, the total face value, cost price is 1,18,000, per each government bond is at 100 rupees. So like this, in generally the investment account information is given. Next, as on 1/3/2011, 1/3/2011, purchased 200 units, X interest at 98 rupees per debenture. As on 1/7/2011, sold 500 units, X interest out of virginal holding at 100 rupees. Now he have the virginal holding of rupees, a total 1200 units, right? 1,12,000 divided by 100 means 1200 units. Out of this 1200 units, he sold 500 units. That is nothing but FIFO method, first in first out. The first purchased investments from which only he is selling right now. As on 1/10/2011, purchased 150 units at 98 rupees come interest quotation price. As on 1/11/2011, sold 300 units, X interest quotation price at the rate of 99 rupees out of virginal holding. Virginal holding out of 1200, you already sold out 500 units, right? Still 700 units are there now. Out of such 700 units, now he is selling 300 units. Still, how many number of units are there at the year end? That is 700 minus 300 means still 400 units are there out of the virginal holding. Interest dates are 30th September and 31st March. Mr. Jed close his books every 31st December. So calendar year they are following, but the interest dates are 30th September, 31st March. Show the investment account as it would appear in the books of Mr. Jed follows FIFO method. Now they're asking to prepare investments in 9% central government bonds account. Now all of you concentrate how we are going to present the investment account. We will discuss through illustration number 5 or problem number 5. Problem number 5 answer. So the title is investment in 9% central government bonds. That is the title. That is the ledger account title name. Sir, in brackets, we will represent due dates, guys. In brackets, investment in 9% central government bonds account for the year ended 31st December, actually. Okay, no need to represent. So as on which date we are going to maintain this as on 31st December, actually, for 31st December date, for the period 31st December. But the due dates, interest due dates, guys, interest due dates, we will mention in brackets. So given 30th September as well as 31st March. 30th September, 31st March. Those are the interest due dates given. Now all of you please concentrate here, guys. You know the general ledger format, that is date, particulars, amount rupees, right? Date, particulars, amount rupees. Here also we will start with date, then particulars, amount column. Amount column is the final column, right? Now, along with amount column, just I want to represent face value as well. This is informative in nature, not the real column. Face value column is not the real column, just informative in nature. Okay. Just a second. So face value column is just informative in nature. Then I will represent cost column, or you can make it as capital column as well. You can call it as capital column, or some persons they will call it as cost column also. Capital or cost. You will show interest account as well along with investments. This is interest account actually. Now the interest related to investment, you can inculcate it onto the investment accounts itself. I mean to say, along with the investment account, you need to present interest account as well. Interest column represents interest account actually. If you want to prepare interest account separately, how you are going to prepare in the same way by putting as a separate column, you are maintaining the interest account. So face value is just for informative in nature. Real investment column is cost or capital column. Interest column is related to interest account actually. Now in the same way, you will represent date this side, then particulars, face value, interest, and a capital or cost column. Am I right, guys? So like this, you need to represent clearly. Yeah. So consider it, guys, all of you. Now just I increased the line space, nothing else. So please all of you make it ready, the format from your end as well, guys. Yeah, start with date, then particulars, okay. So then face value, then interest column, so after interest, capital or cost column. In the same way, you can represent the debit side. Just now we completed debit side, you can represent the credit side as well. So start with date, then particulars, sorry guys, one second. So which is date, particulars, so then face value, then interest, and finally capital. Okay. Yeah, now my entire format is ready, guys. Hope you also completed the format from your end. Am I right? Can I start, all of you? Investments in 9% government bonds account. Can we start? So first, all of you, please follow me. Don't write anything. So after completion of the entire content, you can record the things, guys. Now in the problem, first we are starting with opening balance. They are following the calendar year. So ending with 31st December means it will start with 1st Jan 2011. So the first transaction is 1st Jan 2011. Am I right? Now, as on the date, opening balance is there. Opening balance means always we will show it to balance brought down. To balance brought down. Now, how much face value you have? 1 lakh. 20,000 worth of face value is there. Next. Just a moment. Don't write anything under interest column. I will tell you it later. Okay. Coming to the capital or the cost column. Capital column or the cost column. Now the cost of the investment is how much? Which is 1 lakh 18,000 directly given. Which is 1 lakh 18,000. Which are opening balances, guys. No need to check about is it X interest quotation price, come interest quotation price under opening balance. Why? Because it's directly given, which is a cost. That's it. You can directly represent under capital cost column. Sir, anything need to record under interest column? Now anything need to record under interest column? Now all of you please come here, come to the below. Sir, he told that the due dates of the interest are 30th September and 31st March, right? In the last year, I'm talking about last year. Last year means the year which is related to 2010. I'm talking about the previous year 2010. All of you concentrate here. In previous year 2010, what you will do, you know, as on 31st December 2010, what you will check with respect to interest. I'm talking with respect to interest. The last date of payment was 30th September 2010 in the last year. In previous year, the last date of payment is 30th September 2010. From 30th September 2010 to 31st December 2010, you need to recognize the interest as per the accrual concept. Am I right or wrong, guys? As per the accrual concept, as per accrual concept need to recognize interest from 1st October 2010 to 31st December 2010 as interest accrued on investments. Sir, even though the actual due date is in the year 2011, 31st March, that is the actual due date is 31st March 2011, but I need to recognize the interest based on the accrual concept. So the 3 months interest is accrued but not due. Even though the due date is in the year 2011, which is accrued, that's why I need to recognize in the year 2010 itself. Which entry I need to pass at that point of time? The entry is interest receivable account at R or interest accrued account at R. Interest accrued account at R or receivable account at R. Anything is possible to interest account. This entry I would pass it in the year, in the last year itself. The same entry I already passed in the last year itself. That is the amount of interest is actually how much face value I hold, 1,20,000. How much percentage of government bonds? 9%. How many number of months from 1/10/2010 to 31st December 2010 means 3 months. That is how much? 1,20,000 into 9%. 1,20,000 into 9% into 3/12, which is equal to 2,700. That means in the last year, at the time of closure of the investment account, I recorded this entry as per the accrual concept, that is interest accrued account at R to interest account. That means in the last year, like this interest column is there, I recorded by interest accrued, that is by balance carried down. At last, I recorded that. Am I right? In the last year, I'm talking, not in the current year. Now I'm in the current year, right? Now in the year 2011, at the beginning. Now I am the year 2011 at the beginning, that is at 1st January 2011. What I should do, the entry which I passed need to be reversed. Otherwise, now as on 31st March, I will get 6 months interest. Now, as on 31st March due date in the year 2011, I will get 6 months interest. Is it 6 months interest is related to the current year? No, only 3 months interest is related to the current year. Now, at the time of receipt of interest, I will recognize 6 months interest as my income. That's why I need to reduce 3 months interest first by reversing the entry. That is reverse entry interest account at R to interest accrued account which is 2,700. Are you getting my point? Now, really, at the time of getting the real interest as on 31st March 2011, I'll pass the entry bank account at R to interest account for 6 months, not for 3 months. Entire for 6 months, I will recognize. Now 3 months, I already reduced. Automatically here 6 months under credit, 3 months under debit. The net interest is going to be recognized only to the extent of 3 months interest. Do you agree with me? So whenever the interest due dates are quite different from date of closure of the financials, this problem will arise. But interest due dates are matched with the date of closure of financials, then that problem will not arise. The accrual concept is applicable. The accrual concept come into arise only if the actual due dates are quite different from date of closure of the financials. The same thing happened here. So that's why just I am mentioning under working note number 1 why I am recording this. I mentioned here. Okay, so you can give 2,700 debit here by providing in bracket working note number 1. Okay, next guys. So whenever anything is required, I'll go to the working note only. Next, opening balance recording, everything is over. Do you understand? All of you agree with me? Why I recorded 2700 by making a debit? This is not for the purpose of purchase. This is for the purpose of nullifying the amount of interest recognized in the previous year. That's correct only. Why you recognized as per the accrual concept only you recognize, that is correct only. Why I reversed? In the current year, I need to recognize the 6 months interest, then but the actual amount of interest is only related to the 3 months period as per the current year. That's why I need to reduce the 3 months interest first, then I will recognize 6 months interest as on the due date. That is the reason, guys. Now coming to the next issue, as on 1/3/2011, purchased 200 units ex interest at 98 rupees. All of you please follow along with me. Now as on 1st March 2011, what he told, we are purchasing means to bank account. How much worth of debentures you purchased? 200 units. Face value 100. 200 into 100 is equal to 200 into 100 is equal to 20,000. Am I right? 20,000. At the face value, you can represent in number of shares as well. Nobody will object you. So if you want, you can represent the number of shares as well. For example, if you want the number of shares, I'll write here. Just a moment. So I'll reduce the face value component. I'll reduce the number of shares. That is up to you guys. Why? Because this is informative in nature. So if you want to write in number of shares, you can represent this is number only. Sir, we already recorded, sir. Number of times you are rubbing. No worries. If you already recorded in the face value, you can continue. Nobody will object. So just I'm seeing. Just I am mentioning all the possible methods or all the possible items in which you can present the answer. That's it. Nothing else. Okay. Which is 1200, not 12,000. Sorry. Which is 1200 shares. So here 200 shares. You can mention like this as well. So here also, if you want, you can put number of shares. Simply number. Okay. Now 200 shares or 200 into 100, 20,000 face value. Both are same. Now all of you please concentrate here. X interest. First, the interest should be separately calculated. The given amount itself is the quotation price. First, you need to write the quotation price directly. 200 into 98. In case of X interest quotation price, interest is not included in such quotation price, right? First, 200 into 98, which is equal to 19,600. I got here 19,600, which is 200 into 98. In such quotation price, interest is not included. That's why I directly reported under the cost column. Now you can calculate interest separately. Interest need to calculate from last date of payment to up to date of purchase. What is the last date of payment? 30th September. 30th September to 1st March. How many number of months? 5 months. That is 200 into 100 into 9% into 5 by 12. Am I right, guys? 200 into 100 is the face value, into 9% is the total interest, into 5 by 12. Last date of payment to up to date of purchase. 200 into 100 into 9% into 5 divided by 12. So I got 750, guys, here. 750. Next. In the chronological order, you need to complete the entire ledger. After 1st March 2020, after 1st March 2011, as on 31st March, you will get interest, right? Interest as on 31st March 2011. Interest only you can check the interest column. Don't think about the number of shares column and capital column. Only you can bother about the interest column. What is the entry? Bank account data to interest. Under interest by bank. Under interest by bank account. So how much is the interest amount? You need to calculate. So total as on 31st March 2011, you are having total 1400 shares, right? 1200 shares in opening, 200 shares in purchased as on 1/3/2011. So total number of shares you have 1400 shares. Sorry, here under interest column, right? So which is 1400 shares into 100. into 9% into 6 by 12. You need to calculate interest for 6 months right now. So if you assume here 1200 shares, also you calculated for 6 months now. 1200 shares you already debited for 3 months now. The net on 1200 shares is only you are going to recognize for 3 months. That is the essence of the story. So 1400 into 100 into 9% into 6 by 12, which is equal to 6300. You got 6300. Here hyphen, not all relevant. Next in the chronological order, as on 1/7/2011, sold. Now all of you please consider, come here, 1/7/2011. Now, whenever sale transaction occurred, you need to find out profit or loss, right? Now come to the working note below here, working note number 2. Working note number 2. What is such working note? Calculation of profit or loss on sale of how many number of units, guys? 500 units. On sale of 500 units at the rate of X interest quotation price. Or not an issue, just 500 units. You can write like this: calculation of profit or loss on sale of 500 units. Please concentrate, all of you. Now the given quotation price is X interest quotation price. In such thing, interest is not there, right? That means the quotation price itself is sale proceeds. But if in such quotation price interest is included, first you need to reduce the interest. After reduction from the quotation price, after reducing the interest component from the quotation price, then you will get the sale proceeds. When if the given quotation price is the come interest quotation price. But right now the given quotation price is itself is the X interest quotation price. That's why which is nothing but sale proceeds. Now all of you concentrate here. X interest quotation price is equal to sale proceeds is equal to, you are selling 500 units at the rate of 100. 500 units into 100, that is 500 into 100, which is equal to 50,000 less cost price of investments. Now consider, guys, all of you. At the time of calculation of cost price of investment, either you may adopt the average cost method if nothing is given. If something is given, you have to adopt based upon the given mechanism. That is FIFO method. These 500 units you are purchased from the original holding. I mean to say, you hold the original holding 1200 shares, right? Out of 1200 shares, you are selling. How to calculate the 500 shares cost? First, for 1200 shares, cost how much? For 1200 shares, the cost is 1,18,000, right? For 1200 shares, the cost is 1,18,000. Now you are going to sell 500 units. Then for, sorry, these are not shares, 1200 units. Now for 500 units, cost is how much? That equal to cross multiplication, guys. 500 into 1,18,000 divided by 1200. How much? You can tell me, guys, how much it is? 500 into 1,18,000 divided by 1200. So we got 49,167. 49,166.66. So approximation 49,167 I made. Is it right, guys? All of you, is it right? Yes, it's absolutely correct. Okay. Now you can find out profit. How much profit? That is 50,000 minus 49,167 is equal to 833 is profit. Now all of you please observe here how to write the journal entry. How to write the journal entry for the first time. I'm writing the journal entry as a first transaction. From the next time onwards, directly I will post it. Bank account data to investments account to interest account. Now you are getting 50,000 as sale proceeds. Interest from the last date of payment to up to date of sale, that is 50,000. Am I right? 500 units into 100 means 50,000 into 9%. As on which date you are going to sell? As on 1/7/2011, right? As on 1/7/2011 you are selling. Okay. Okay, so how many number of months from the last date of payment to up to date of sale? What is the last date of payment? Last date of payment has happened as on 31st March. Then April, May, that's it. Only April, May, June also, sorry. April, May, June. This is first 7 means July, na? April, May, June. That is 3 months. 3 by 12. We can calculate it, guys. 50,000 into 9% into 3 by 12. So interest is 1125. So total you will get 50,000 1125. Now out of this 50,000, 833 is profit na. You need to pass one more entry, right? That is investments account data to profit and loss account, which is the profit situation, which is 833. You can give the posting of these two entries in the ledger. First entry under investments by bank. Bank to investments means by bank. By bank. First, all of you please concentrate. How many number of shares you are selling? 500 shares. Now, capital is nothing but towards the sale proceeds. You can put under the capital column, which is nothing but 50,000. You are getting 50,000 now. This you can put under capital column. Out of this 50,000 profit, how much? Out of this 50,000 profit, you can make it transfer to the P&L account, guys, directly. That is to profit and loss account. As on the same date, that is 1/7/2011. Profit how much? Profit investments to P&L. The entry investments to P&L 833. Where you should record? Here you should record. All of you concentrate in which column? So number of shares is informative, sir. Is it interest column? No. You should need to reduce from the capital column. Why? Because in capital 50,000, out of this 50,000, 833 is the profit. Am I right? Now you are out of this sale proceeds, you can transfer 833 to profit and loss account. Now interest column is how much? How much interest you received? 1,125, right? Bank to interest, which is 1125. Like this, you need to give posting at the time of sale of investment. You sold out 500 shares. At the time of sale, you are getting 1,125 as interest. That is from the last date of payment to up to date of sale. You need to collect from the other party. Now the sale proceeds are 50,000. Now out of such 50,000, profit is 833. For example, loss is there. Sir, if loss is occurred, what I need to do? Here itself, you should record the loss at that point of time. Then there are no two entries will come, right? At that point of time, only one entry, bank account data, P&L account data. Then in investment itself, you are recording the P&L as well. Then in investment itself, you are going to record the by profit and loss account under capital column. That means if it is profit situation, you are make it to transfer to profit and loss. You can make it transfer to P&L profit and loss by making debit to the capital column. Why? Because the entire sale proceeds you are creating to the capital column. Am I right? Are you with me, all of you? Next. As on 1/10/2011. What is the next due date? 30th September. That is before that or after that? This was given after that. So that's why first you can recognize as on 30th September interest first, guys. 30th September 2011. By bank account are to interest account. All of you please concentrate here. You can only check about interest column. No need to check remaining all columns. Now how many number of government bonds with you? Out of 1200 plus 200 1400, you sold 500 rupee 500 numbers, means still you have only 900. That is 900 into 100 into 9% into 6 by 12. I'm recording here itself. So now you can tell me guys how much it is. 900 into 100 into 9% into 6 by 12, which I got here 4050. Am I right? 900 into 100, which is, I think so, 90,000 into 9% into 6 by 12, which is absolutely 4050 guys. Next, in the chronological order, the next transaction is as on 110-2011. Now all of you come to 110-2011 here. 110-2011 to bank account. We are purchasing how many number of debentures here? Sorry, how many number of bonds here? 150 units. That is 150 units. Given quotation price is the commenter's quotation price. Now the quotation price is not the cost of the investment. Out of such quotation price, you should need to reduce the interest first. First, let me calculate interest portion is how much. All of you, 150 units into 100 into 9% into how many number of months? From the last date of payment to up to date of purchase. 0 into 0 by 12. Tell me guys, from the last date of payment to up to date of purchase, last date of payment is 30th September. 30th September to 1st October, 0 days. That's why the amount is nil here. Interest amount is nil. Am I right or wrong? If the interest amount is nil, then out of the total commenter's quotation price, you need to reduce 0. That means 150 units into 98 itself is the cost of investments. 14,700. How you got? 150 into 98. If you really have any interest component, you will reduce from 14,700, then you will get the net amount as cost price of the investment. But here in the given case, from the last date of payment to up to date of purchase, our number of days are 0 months. So that's why 0 months divided by 12, you are getting interest as 0. Next, as on 1/11/2011, guys, again you are selling as on which date? 1. You are selling as on 1/11/2011. Now all of you come here, working note number 3. In the same way, how we calculated earlier, in the same way. Calculation of profit or loss on sale of investments as on which date? 1/11/2011. So calculation of profit or loss on sale of investments as on 1/11/2011. Now first all of you, what is the given quotation price? Given quotation price is the commenter's quotation price. Am I right? So now sale proceeds are not the commenter's quotation price. First you need to reduce the interest. All of you, interest quotation price. Interest quotation price is equal to how much guys? 150 units into 98. We already done that. So you need to check as on 1/11. Sorry, I'm checking this wrongly. These are purchased values. So please come to the last line item, 300 units into 99. Sorry, 300 units into 99, which is the commenter's quotation price, right? 300 into 99, 2 lakh 9, sorry, 29,700, 29,700 guys, less interest from last date of payment to up to date of sale, guys. Now we have certain interest, guys. Interest from last date of payment is 30th September. That is 1st October 2011 to 1st November 2011. Interest is how much? Which are 300 units into 100 into 9%. October, only 1 month. That's why divided by 1 by 12. Am I right? Now, how much is the interest component? You need to reduce the interest now. In the quotation price, interest is there. After reduction of interest only, you will get the sale proceeds in case of commenter's quotation price. Because the given quotation price is here. I'm completely sorry, guys. What is the given quotation price? X interest. I'm always in my mind, the older transaction already stored. That's why I'm telling that, which is also commenter's quotation price. Sorry. So he was given that sold 300 units X interest at 99 out of the original holdings. So that's why no need to reduce the interest. Sorry, I'm extremely sorry. So the given quotation price is X interest quotation price. So in case of X interest quotation price, which is equal to sale proceeds, right? Sale proceeds. We done now in the same way here. X interest quotation price is equal to sale proceeds. Okay, is equal to 29,700. Are you with me, all of you? Given quotation price is X interest quotation price. I'm extremely sorry. So I'm seeing the whole transaction. So we are purchased the investment for a commenter's quotation price. Now we are selling for X interest quotation price. Now 300 units into 99, which is absolutely fine. 29,700, which is sale proceeds as well. Now it should be compared with cost price of the investment. Cost price of the investments. How to calculate cost price? I need to apply the FIFO method. You know one thing, right? You know one thing. What is that? Out of the first time holded investments only you are selling for 1,200 number of debentures. The cost price is 1,18,000. That is government bonds. I mean to say, for how much is the number? For 1,200, which is 1,18,000. For 1,200, which is 1,18,800. Is it 1,18,000 or 1,18,800? Only 1,18,000. Sorry, which is only 1,18,000. Then for how many number of government bonds you are selling right now? How many number of units? 300 units you are selling. Then how much? In bracket you can calculate, which is 300 into 1,18,000 divided by 1,200. How much? So I got 29,500, guys. So again, this is a profit situation. So profit 29,700 minus 29,500. We got 200 rupees as profit. Now, what is the journal entry, guys? Can you please tell me, all of you? So for the last time sale, we already made the posting. Now for the current sale, what is the journal entry? Bank account debtor to investment accounts. Sale proceeds how much? 29,700. To interest account. Interest last date of payment to up to date of sale. That is 300 into 100 into 9% into, now you can calculate last date of payment to up to date of sale. Last date of payment is 30th September. That is 1st October to 1st November is 1 month. Which is how much? 300 into 100 into 9% divided by 12, which is 225. Now the total amount you are getting 29,700 ex-interest quotation price plus 225 interest. You are getting 29,925. Now you can make it transfer to profit and loss account. Investments account at R. How much profit? 200 to P&L. Now let us go for posting, guys. I'll ask you this entire thing. On 1/11/2011, buy bank, selling 300 units. So interest getting 225 rupees, right? Interest I am getting 225 rupees. So total sale proceeds I am getting 29,700. Sir, here this is working note number 2, I think so. Here this is working note number 3. You can give the reference. Now out of this 29,700, profit is there for 200, right? To profit and loss account. Out of this 29,700, 200 is the profit. One second. This is also right here. To P&L account. 1/11/2011, guys. Okay, are you with me, all of you? Now, after this, the next due date is 31st March, but before that 31st December came. Now, as on 31st December, 2011, buy balance brought down. I should need to check the subsequent measurement at this point of time as on balance sheet date. Now, out of the total number of bonds, this is not the shares, sorry. Out of the total number of bonds, given our number of bonds, na, central government bonds, na. So which are bonds? Okay, out of the total number of bonds, that is 1400 plus 150, 550 bonds. I sold 800 bonds. So remaining with me 750 bonds are there. Remaining with me 750 bonds are there. Is it okay, guys? All of you, 500 plus 300, only 800 bonds you sold out of 1550 bonds. Out of 1550, if you sold 800 bonds, you have 750 bonds. That is matching of bonds column. Actually, how to match the first column, either face value column or number of shares or number of bonds column, like this you should match. Next, if any balance is there under interest account, the net interest account should be closed and transferred to P&L account, na, where interest should needs to go. Ultimately, interest should needs to go to profit and loss account. Now all of you can check under credit side. 6,300 plus 1,125 plus 4,050 plus 225. So total is 11,700 I got here. 11,700. Once again. So total how much we got? 11,700 up to here. Just I'm providing, don't write anybody. Sir, 11,700 total you got. That's okay. That 11,700 minus the interest you need to check. Before that, you need to do one more thing. You know, what is that? From the last date of payment of interest to date of closure of the financials, you need to provide interest now. How you provided interest in the last year? From 1st October 2010 to 31st December 2010, how you recorded the entry interest accrued to interest? In the same way, you need to record the entry that is interest accrued account data to interest account. To interest means by interest accrued, which is nothing but by balance brought down on 750 bonds. 750 into, please consider all of you, 750 into 100 into 9% into last date of payment is 30th September. So up to the date of closure is 3 months. Now 750 into 100 into 9% into 3/12. So I got 1687.5. Is it right? You can cross check one more time. I got 1687.5 guys here. Now you can put the difference here guys. You can put the difference to the profit and loss account as on 31st December 2011. The difference you can put under P&L account to P&L related to the interest. Now what is the total amount of interest after adding this? After adding this 6,300 plus 1125 plus 4050 plus 225 plus 1687.5 minus, all of you reduce the component interest components on the debit side, minus 2700 minus 750. That's it. I got 9937.5, which is a balancing figure actually. This is a balancing figure. Now interest account is also closed, right? Next, coming to the capital column guys, all of you first make it debit the make it total the debit side of the capital column, that is 1,18,000 plus 19,600 plus 833 plus 14,700 plus 200. So total of the debit side is 1,53,333 guys. I got 1,53,333. Now all of you can reduce the credit side of the capitals, minus 50,000 minus 29,700, which is 73,633 I got, which is 73,633, which is balancing figure. Sir, how you write directly 73,633 as a balancing figure? You are not value, you are not measuring. If you want, you can measure as on 31st December. As on 31st December, that is simply measurement of investments as on 31st December 2011, right? What is the cost price of the investment? Just now you calculated, right? Cost price of investment equal to 73,633. But in the problem, now we got as a balancing figure now, which is only cost price only. But in the problem, nowhere they mentioned about the fair value. Nowhere they mentioned about the market price as on 31st December. We can assume that here, we can assume that fair value is greater than cost price and the investments are current investments. These are assumptions. Nowhere information is providing. We assume that fair value is greater than cost price and the investments are current in nature. Investments are current in nature. Investments are current in nature. Therefore, value of investments as on 31st December 2011 is equal to 73,633 only. So I wrote here 73,633. You can give the total figures. I'm not making the totals here. You can complete the totals from your end, guys. So like this, you need to present entire total problem. Now all of you see the highlights of the problem, guys. All of you please concentrate. This is the first time you are come acrossing, right? Like this, the big problem. But the problem is very simple. Sir, initially you purchased 1,200 bonds. Sorry, initially you already with you to the extent of 1,200 bonds. the cost price they given per each bond. In the problem, the cost price they given for each bond, they are giving the total cost of the bonds, that is 1,18,000. That's why you may represented entire 1,18,000. Why you make the debit interest of 2,700, which was the interest accrued in the last year. So which was already accrued, you was already created to the P&L in the last year. Now to get the correct amount of interest in the current year, we are making debit of the 3 months interest. Why? Because at the time of receipt of interest, we are making credit of 6 months interest, but current year 3 months interest only need to recognize on this 1,200 bonds. That's why I need to debit such 1 lakh, the interest on such 1,200 bonds. Are you with me, all of you? Next, we purchased 200 bonds, guys. Next, if you observe, we purchased 200 bonds at the rate of X interest at the rate of 98 rupees. Now interest component should need to calculate from last date of payment to up to date of purchase. Now first you calculated the interest component. Last date of payment is as on 30th September. From 30th September to up to till now, that is as on 1st March 2011, total 5 months. So 200 into 100 into 9% into 5 by 12, you got the 750 interest. Anyway, quotation price is X interest quotation price. That's why the quotation price itself is the cost of investment 200 into 98, which you directly represent under cost column 19,600. After that, as on 31st March 2011, you got interest on total 1400 bonds. That is 1400 into 100 into 9% into 6 by 12, which is 6,300. Next, in chronological order, you sold the bonds as on 1/7/2011. How many number of bonds you sold? 500 bonds you sold out. Now you are calculating profit or loss on sale of 500 units as on 1/7/2011. So the given quotation price is X interest quotation price, which is equal to the sale proceeds. In such quotation price, interest is not included. That's why directly you can make it termed as sale proceeds. So 500 into 100, which is 50,000. You can compare with cost price of the investment. Now it is clearly given that for the purpose of calculation of cost price of investment, you can apply the FIFO method. That means out of the first existing bonds only we are going to sell. The first existing bonds was cost 1,18,000, number 1,200 units. For 1,200 units, if it is 1,18,000 cost, for 500 units, how much cost it would be? Then we got 49,167. Then we derived the profit of 833. How we made the postings? First, we recorded the journal entry, bank to investment to interest, then investments to P&L. Now here investment is nothing but sale proceeds. You can make it credit the investment account with the sale proceeds 50,000. Interest amount you need to calculate from the last date of payment to up to date of sale. That is on 50,000 into 9% into last date of payment of dividend is as on 31st March. From 31st March to 1/7/2011, which is 3 months. Now you calculate the interest component as well. Now the profit 833, you should make it separate by making credited to the P&L, investment account data to P&L. The same thing you make the posting, that is buyback under number of bonds 500, under interest component interest amount, sale proceeds total capital amount. Then the profit on such thing you are separated, you are make it debited to the 833 under capital column and transfer it to the profit and loss account. Next, in the same way, in the chronological order, as on 30th September 2011, you need to receive the interest. Now on how many bonds, how many number of bonds you will get the interest? 1400 minus 500, you will only get the 900 bonds only interest. You should need to calculate interest on only 900 units of bonds for entire 6 months. After that, as on 1/11/2011, again we sold out. Again we sold out. Sorry, before that, as on 1/11/2011, before that, we purchased the investments, right? It was given clearly as on 1st October 2011. As on 1st October 2011, we purchased the 150 units of bonds, which are come interest quotation price, guys, which is come interest quotation price actually. In quotation price, interest component is there from the last date of payment to up to date of purchase. Number of months or number of days are 0. So that's why interest amount is 0. If anything interest amount is there, we need to reduce from the quotation price for such interest, then we will get the cost price of the investment. Here, due to 0 interest, the quotation price itself is the cost amount. The quotation price itself is the cost amount, which is 150 into 98, which is 14,700. Now you sold the second sale, that is you are selling at 300 units, which are also you are selling at X interest quotation price. Now we made another working note, calculation of profit or loss on sale of investment as on 1/11/2011, 300 units into 99, I got 29,700. Earlier this one only I made a mistake, that is I thought that which is come interest quotation price. I read like that, right? Later on, I realized that which is ex interest quotation price only. Okay, sir, if it is come interest quotation price, what should I need to do? First, you should need to reduce the interest included in such quotation price. Then you will get the sale proceeds. Then you can compare with the cost price. Then you'll get the profit or loss. But here the quotation price is the ex interest quotation price. No need to reduce the interest component, which is already exclusive of interest component. You can directly compare with cost price of investment by applying the FIFO method once again. Then you are getting the profit of 200. Then this is the journal entries. You made the posting, right? Then after completion of all these things, as on 31st December 2011, as on balance sheet date, first you should make it close the number of bonds at the face value column. Okay, so the total number of bonds are 1550, out of which 800 is sold out, 750 is the balancing figure. Sir, before closing the interest column, as per the accrual concept from the last date of payment to up to date of closure of the books of accounts, you need to provide the interest. You need to provide the interest as an income by passing the entry interest accrued account data to interest, or interest receivable account data to interest account. That is under by balance brought down on 750 bonds, 750 into 100 into 9% into 3 by 12. Then you can close the interest column. The difference amount you can make it transfer to the profit and loss account, which is 9937.5. Then you can finally close the capital column, which is represented at cost price. Here there is no information regarding the market value of investment, on the assumption that market value is greater than the cost price and the investments are current investments. Then we can represent such investment at cost price, which is 73,633. This is the end of the problem, guys. So like this, you should make it present the relevant working notes as well at the time of doing the problem. This is a full-fledged problem related to fixed income bearing securities. Here always you should need to calculate interest on face value only. Profit calculation, if it is the come interest quotation price, then you need to reduce the interest, then sale proceeds can be compared with cost. If it is the ex interest quotation price, no need to reduce the interest component, which is already exclusive of the interest component. That's why which itself is treated as sale proceeds. You can directly compare with the cost price, you will get the profit or loss. Okay, if it's the profit situation, 2 entries will come. If it is the loss situation, only one situation will come, one entry will come. And one more key point in this problem is the due dates of the interest and the date of closure of financial is quite different. That is the reason why in the opening as well as in the closing, you recognize the interest accrued part. Okay, that's it, guys. In the next lecture, we are going to meet with variable income bearing securities. We'll deal entire theory part related to variable income bearing securities. Then we'll discuss lot of problems based on variable income bearing securities. So in examination, which type of problems have the more probability? I mean to say, is it fixed income bearing securities, variable income bearing securities? So if we check the past trend of the examination, they are giving more probability to variable income bearing securities. That's why we will give our entire focus on variable income bearing securities. That means fixed income bearing securities are not important. Okay. Okay, guys. Bye. Have a nice day. Hello, friends. In last lecture, we started the main chapter related to investment accounts. We completed entire fixed income bearing securities related concept, right? Now this is the time for variable income bearing securities. I already told you in examination point of view, we can give more importance to variable income bearing securities rather than fixed income bearing securities. And one more thing, fixed income bearing securities is a little bit lengthy. So a lot of calculation parts are involved. Okay. So after discussing the variable income bearing securities, you can compare both the things. So which takes in generally more time period as well as which involves the more calculations. Okay, right. So variable income bearing securities is generally a conceptual things are more while compared with fixed income bearing securities. Calculation part is a little bit less, not like fixed income bearing securities. Okay. Apart from all those things, first let me entering into the topic variable income bearing securities. Variable income bearing securities. Now, how for fixed income bearing securities, we saw different accounting treatments, that is with respective to acquisition of investments, respective to acquisition or purchase, then at the time of here receipt of dividend, right? Not at the time of receipt of interest, that is dividend related issue, and at the time of disposal. At the time of disposal, what is the treatment need to be done? As on balance sheet date, I don't want to check because as on balance sheet date, the valuation of the measurement is applicable both in case of fixed income bearing securities as well as variable income bearing securities. For both which is applicable, that's why measurement as on balance sheet date, no need to check. Now come here, all of you. First, let us deal with acquisition or at the time of purchase of variable income bearing securities. What is the treatment? Let us have a look, guys. Now, at the time of purchase of fixed income bearing securities, we may check that how much interest is foregone by the other party. To that extent, we are going to compensate. Am I right? Now, here at the time of purchase of variable income bearing securities, I mean to say the classic example is equity shares. Equity shares. At the time of purchase of equity shares as an investment, we are not in a situation to decide. We are not in a situation to tell how much amount of dividend is foregone by the other party. So, in case of fixed income bearing security, the amount of income generated on such investment is fixed. But in case of variable income bearing securities, the income generated on such investment is variable. Nobody can predict that how much amount of dividend can be declared by the investee company. Am I right? Nobody can predict. Nobody can predict. It's completely quite different from the concept of interest. That's why at the time of purchase of investment, nobody will predict how much dividend is foregone by the other party, because the other party holded such variable income securities for certain time period. So for that period, how much he would expect, nobody knows. Then at least as an investor, at least how much need to be payable as a compensation for dividend foregone by the other party. I don't know at the time of acquisition. I know that part at the time of declaration of dividend by the company, not at the time of acquisition of investments. Do you agree with me, all of you? So like in the fixed income bearing securities, we may not record any dividend accrued from the last date of payment to the till date of purchase, because we don't know how much amount of the dividend accrued from the last date of payment to the up to date of purchase by the other party. That's why we will write as simple as acquisition entry, as simple as the general purchase entry we will record, that is investment in equity shares account data, investment in equity shares account data to bank account. Here no need to ask, sir, whether it is cum dividend quotation price or ex dividend quotation price, as like ex interest quotation price or cum interest quotation price. No need to ask. This is always a cum dividend quotation price. I mean to say the other party will quote the amount inclusive of dividend foregone by him. Nobody knows. He also don't know. Me also don't know. But he will tell ultimately the quotation price by inclusive of dividend amount foregone by the other party from the last date of payment to the till the date of purchase by me, or from the last date of payment to till the date of sale in his point of view. In my point of view, it is purchase. In his point of view, it is sale. Am I right? So nobody will knows, but the quotation price is always the inclusive of dividend. But how much dividend, sir? If I know, I will record right now itself, which is dividend dividend payable account at R2 bank account. But I don't know, na. I don't know. That's why in the cost of the investment itself, dividend related to the last date of payment to up to date of purchase is included. That's why, which is known as cum dividend quotation price. In case of variable income bearing securities, cost of investments is nothing but cum dividend quotation price only. No need to check whether it is cum dividend quotation price or ex dividend quotation price. If they are given ex dividend quotation price directly, then I would may split here itself. I would may split here itself investment and equity shares account or dividend account or to bank account. But I don't know the ex dividend quotation price at the time of acquisition of investments. Are you agree with me, all of you? Now, I'll highlight this point. We don't know dividend related to last date of payment to date of purchase. So dividend foregone by other party, dividend foregone by other party is included in cost of investments. That is very, very important point you need to remember. Am I right? Now all of you come to the dividend issue. That's such a simple entry, guys. Now come to the dividend issue. Now the dividend I can broadly divide it into two types, which is I already explained in cash flow statement chapter, somewhat related to the dividend. The dividend we are going to issue, we are going to divide into two parts. One is pre-acquisition dividend, another one is post-acquisition dividend. One is pre-acquisition dividend, another one is post-acquisition dividend. Pre-acquisition dividend, post-acquisition dividend. You know, right? What is the difference between pre-acquisition and post-acquisition dividend? I already explained in cash flow statement. One more time, I'm taking the opportunity to explain things related to dividend entirely. Concentrate, guys. Pre-acquisition dividend is nothing but dividend declared out of pre-acquisition profits. Post-acquisition dividend is nothing but dividend declared out of post-acquisition profits. Post-acquisition profits. What is this pre-acquisition profits and post-acquisition profits is all about? I'm going to explain through small example. Please concentrate, all of you. You know, our company is Rani Limited. The same example I'm going to continue. My company is Rani Limited. So Rani Limited hold investments in Razu Limited. Now, Rani Limited hold investments in equity shares. Investments in equity shares, which are investment in equity shares. How many number of equity shares? So let us assume 1000 equity shares, which is 1000 equity shares. Face value, how much? Face value is 10 rupees per share. Face value is 10 rupees per share. Cost price, we acquired these 1000 equity shares. This is year related to 2021. This is the year related to 2020-21. In 2020-21, these 1000 equity shares we acquired as on, let us assume, 1st January 2021. We acquired as on 1st January 2021. So 1000 equity shares, the cost price is we acquired at the rate of 12 rupees per share. This is the cost price. Okay. This is the information given by me. So face value is 10 rupees. I acquired at the rate of 12 rupees per share as on 1/1/2021. Now all of you please concentrate. At the time of acquisition, what is the journal entry you need to pass? That is very simple. Investment in equity shares accounted are to bank account. That is 1000 into 12 rupees. So I'll write the entry as well for better understanding here. At the time of acquisition, the entry is investment in equity shares of Raju Limited, account data to bank account. Such a simple entry. So 1000 into 12, which is equal to 12,000 is the cost. 12,000 is the cost of investment. That is the acquisition entry. Now, in generally, how the dividend is going to declare, you know, for the year 2021, I'm talking about for the year 2021, how the dividend is going to declare. I'm explaining here, concentrate. This is the year 2021. So the financial year ending is 31st March 2021. You know, already as on 31st March 2021, the financials are not yet ready. Practically, I'm speaking. So these financials may be ready in the month of April or in the month of May, as the case may be. But such financial statements are prepared for the date 31st March 2021. You know that, right? Now, how in generally the dividend process is going to occur, or what are the procedures it may come across for the purpose of declaration of the dividend? You know, after preparation of financials as on some date, like let me take as on April 15th. Let me put April 15th, 2021. Board of Directors proposed the dividend. Board of Directors propose the dividend. Am I right, guys? It is ultimately declared by whom? It is ultimately declared by whom? It is ultimately declared by shareholders in the general meeting. Let us assume shareholders declared as on 15th May 2021. In general meeting, shareholders declared the dividend at the rate of 20%. At the rate of 20%. So, you know, as an investor, I'm holding such investment. This entire things I'm talking about, Raju Limited, not related to Rani Limited. Rani Limited is just an investor. Rani Limited is just an investor. This all information is related to Raju Limited only. So because who will issue the dividend? Raju Limited. To whom? Rani Limited. As an investor, we are getting. That's it. So declared dividend at the rate of 2 rupees each. Sorry, not 20 rupees, because face value is itself is 10 rupees, right? So 2 rupees each. Now concentrate. If Raju Limited declared the dividend, then only Rani Limited have a right to receive established. As per accounting standard 9 revenue recognition, when revenue related to the dividend need to be recognized in the books of accounts, when right to receive establish, here, if the investee party declares the dividend, if the other party declares the dividend, then only the right to receive establish. Now the point is here, Razu Limited will declare from which profits. At the time of declaration of the dividend, Razu Limited can declare the dividend. Razu Limited can declare dividend from 2021 profits. It may not declare a dividend from 21-22 profits, guys. Even though we are in the year 21-22, we may not declare the final dividend from 21-22 profits. If we declare the dividend from 21-22 profits, 21-22 profits, which is known as interim dividend, actually. I'm talking about final dividend here. I'm not talking about interim dividend. Now, for the year 2021 related dividend, I'm going to declare in the year 21-22. Due to procedural issues, it becomes late. Once the financial year completed, then after board of directors will conduct a board meeting, then they will propose a dividend. Ultimately, it is declared by the shareholders in the general meeting. Then only as an investor, I have a right to receive established. Then I will treat it as an income in my books of accounts. Am I right? Now, Razu Limited will declare the dividend. They can declare the dividend either from 2021 profits or from previous year profits as well, or from previous year profits as well. Previous year profits before 2021 means 19, 20, 18, 19, 17, 18. Those are accumulated profits. So now I can declare the dividend either from 2021 profits or from previous to 2021 profits. Am I right? Will you agree? Now let us assume in this case, Razu Limited is going to declare the dividend from 2021 profits. Let us assume. Okay. Now, in 2021, as an investor, Rani Limited, how much time period I hold at the investment? How much time period I hold as an investor? I acquired the investments as on 1/1/2011. As on 1/1/2011. That means the post acquisition period is, after acquisition, the period in the current year is 3 months. Pre-acquisition period is 9 months. Pre-acquisition period is 9 months. Post-acquisition period is 3 months. Will you agree, all of you? Which is 9 months, which is 3 months. Now, you are getting the dividend on these 1000 equity shares. That is 10 at the rate of 2 rupees each. That is 1000 into 2000, right? Out of such 2000, related to pre-acquisition period is 2000 into 9/12. Related to post-acquisition period is 2000 into 3/12. They declared a dividend out of the profits of pre-acquisition period. Now, what is the meaning of pre-acquisition profit? Pre-acquisition profits are related to profits of the investee company in pre-acquisition period. Now, the pre-acquisition period profits are nothing but pre-acquisition profits. Out of pre-acquisition profits, I received 2000 into 9/12, which is how much? 2000 into 9/12 means, which is equal to 1500. Out of the post-acquisition profit, after acquiring, the investee company achieved certain profits, right? Out of such profits, I received 500 rupees dividend. Sir, why you are differentiating the pre-acquisition profits and post-acquisition profits that much, sir? We already seen the treatment in cash flow statement. Pre-acquisition dividend should need to be reduced from cost of investment. It is need to be reduced from cost of investments. If it is post-acquisition period dividend, treated as revenue receipt and credited to P&L and credited to profit and loss. Now, you may have a question in your mind that why you are reducing from cost of investment. The same question I raised in cash flow statement, but I told at that point of time that is not the right time. Am I right? Now I'm going to now I'm going to resolve such questions, guys. Please, all of you concentrate. Now I'm going to reveal the answer as well. Why you are reducing the pre-acquisition dividend from cost of investments? At the time of purchase, that is, at the time of acquisition of investments related to variable income bearing securities, if I know dividend from last date of payment to up to date of purchase, that is last date of payment to up to date of purchase is nothing but up to 31st December 2020. Up to December 2020, the dividend 1500, if I know at the time of acquisition itself, then the cost of investment I may record it as 12,000 minus 1,500. Are you with me, all of you? If I know the pre-acquisition period dividend, that is pre-acquisition dividend, that is before acquisition dividend, before purchase such investment, how much dividend the other party will get, the other party how much dividend is foregone, if I will know at the time of purchase of investment, I would reduce this 1500 from the cost of investment. I showed the real cost of investment as 12,000 minus 1500, which is 10,500. I don't know, right? At the time of acquisition of investment, I don't know, right? That's why I clearly told that which is a cum dividend quotation price. I clearly told that which is a cum dividend quotation price. Now, at least after declaration, how much dividend is included in such quotation price before acquisition of investment, which is nothing but 1500. Now you can reduce at the time of receipt of dividend. Now you can reduce from such cost of investment. Now, what is the journal entry need to be passed at the time of receiving the pre-acquisition dividend? Please concentrate. At the time of receipt of dividend, if it is pre-acquisition dividend, the journal entry is reduced from cost of investments, means bank account debtor to investments in equity shares. If it is post-acquisition dividend means, credited to P&L, that is bank account debtor to profit and loss account. You can write two entries: bank to dividend, dividend to investment. Here also bank to dividend, dividend to P&L. You can write two entries, but I skipped the dividend. So bank to dividend, dividend to investment, bank to dividend, dividend to P&L. Dividend set off with each other. So that's why I skipped the two entries. Just I wrote a single entry. So which is, in case of post-acquisition dividend, bank account debtor to investment account. In case of pre-acquisition dividend, in case of pre-acquisition dividend, bank to investments. In case of post-acquisition dividend, bank to profit and loss account. Are you agree with me, all of you? Now, once again, I am linking the provisions. Please, all of you concentrate. At the time of declaration of dividend by investee company, as an investor, I should check how much dividend is related to pre-acquisition period, how much dividend is related to post-acquisition period. Pre-acquisition period dividend should be reduced from cost of investment. The reason is, at the time of acquisition of investments, I don't know the how much price need to pay to the cost of investment, how much amount should be need to pay for dividend foregone by the other party. At that point of time, the dividend foregone by the other party as well as cost of investment both clubbed into the both clubbed and put it into the cost of the investment in equity shares. But that is not the real cost of the investment in equity shares, because the pre-acquisition dividend is nothing but dividend foregone by the other party. That is you are reducing to know the real cost of the value of investments right now at the time of receipt of the dividend. That is the reason why you are reducing pre-acquisition dividend from cost of investment rather than creating to the profit and loss account. Now, at the time of declaration of the dividend foregone by the other party from the date of last declaration to the date of purchase, from the date of last declaration to the date of purchase, how much dividend he is foregone, I know at that point of time. So I'm going to reduce now at least itself. If I would know the same dividend foregone by the other party at the time of acquisition, I may reduce at that point of time itself, but at the time of acquisition, I don't know such dividend. That's why I awaited up to the time period of declaration of dividend, up to the time period of declaration of the dividend. So when the dividend declared, then I will find out the pre-acquisition dividend. I will find out the post-acquisition dividend. So then the pre-acquisition dividend is reduced from the cost of investment to know the real cost of investment. Post-acquisition dividend should be simply credited to the profit and loss account. Okay. Next important issue, guys. Sir, this dividend is all about final dividend. I mean to say this dividend is all about final dividend. Final dividend. This is related to final dividend, year-end dividend. Sir, what about interim dividend, sir? Interim dividend, you can always treat it as a post-acquisition dividend. So there is no confusion related to interim dividend. So you can thought that after acquiring the investment profits only, they declare the dividend in case of interim dividend. So that point also I'm mentioning here, this is only for final dividend. If it is for interim dividend, if the dividend is for interim dividend, you can simply treat that if the dividend is related to interim dividend, we can treat the interim dividend as pre-acquisition, interim dividend as only post-acquisition dividend. We can assume that the dividend is declared after acquisition of profits only. Why? Because in between profits, out of in between profits, they are declaring the dividend, right? What is the meaning of interim dividend? That is current year profits declared in the current year profits. Dividend is declared out of current year profits in the current year itself. That is nothing but interim dividend. We can assume that after acquisition of investment profits only, they are declaring such interim dividend. So that's why we can treat it as post-acquisition dividend. That means always interim dividend credited to P&L, always which is credited to P&L. That point you need to remember. So the pre-acquisition and post-acquisition dividend concept is only applicable in case of final dividend. Pre-acquisition dividend is reduced from cost of investment. The reason is earlier, which is not reduced from cost of investment. Now I am going to reduce to know the real value of cost of investment. Post-acquisition dividend, after acquisition of profits from which the other company declared the dividend, which I am going to credit to profit and loss account. That is the story related to dividend, guys. Next. Still my discussion is not yet over related to acquisition concept. So I don't want to go to disposal directly. So still there is a discussion related to acquisition or purchase. Please all of you concentrate. I'll discuss the disposal concept at the end. Nothing is there under disposal. It is very easy. Now let me introduce the concept of right shares. All of you understand the concept of right shares. You already saw the concept of right shares under issuer point of view in the chapter bonus and rights issue. In the chapter bonus and rights issue, at the time of issue of right shares, what are the implications arised? You already seen under the chapter bonus and right shares. Now we are going to discuss about right shares from investor point of view. From investor point of view. For example, in the given case, we purchased 1,000 shares as on 1/1/21, right? As on 1/1/21, we purchased 1,000 equity shares of Razu Limited. Now in the year 21-22, let us assume in the year 21-22, I'm continuing the same example. In the year 21-22, we are getting one right share for every 2 shares. One right share for every 2 shares at the rate of 11 rupees per share. Now you know how many number of shares are there. This issue is also happened in the year 21-22. The date also I'm mentioning, which is occurred, let us assume, as on 1st September 2022. As on 1st September 2022, one right share for every 2 shares at the rate of 11 rupees per share offered by Razu Limited. Now as an investor, how many number of shares you would get? You hold 1,000 shares. One right share for every 2 shares means you will get 500 shares. Am I right? Now the number of right shares are, therefore, number of right shares are 500. That is 1000 into 1 by 2, which is equal to 500 shares. Now all of you consider it, guys. With these 500 right shares, what you can do? You know, already such issues we already saw in the bonus and right issue chapter. As an investor with such right shares, what you can do? You can subscribe. You can subscribe such right shares. Subscribe means we can purchase. We can purchase directly such shares from the company. So at the time of subscribing such right shares, you are purchasing. That is the normal journal entry. Again, which are also treated as investments. So investment in equity shares of RAS Limited account data. Now you are getting 500 equity shares, right? 500 into for each equity share 11 rupees. 500 into 11, how much? Which is 5,500. Which is 5,500 to bank. To bank, which is 5,500. This is option number 1. You have this option, which is option number 1. You can subscribe. Sir, on behalf of subscribing these shares, you may renounce. Am I right, guys? Tell me. So let me put option number 2 first. Option number 2, you may renounce. You can go for rights renouncement. What is the meaning of rights renouncement? Rather than subscribing such shares, I'm going to sell my right to the other party. I'm going to sell my right to the other party. For example, now I have a right to subscribe 500 shares from my company, right? Such right I am transferring to other party, which is popularly known as transferring right to others, or selling rights to others, not the right shares. We are only transferring the rights. We are only transferring the right to others. Now, what is the journal entry? For example, in this case, let us assume if you are transferring the rights for 1 rupee. Sir, at how much price, sir, you are transferring? Let us assume at the rate of 1 rupee, I am transferring 1 rupee per right. I am transferring. Now, what is the journal entry? Simply you are getting 500 rupees. Bank account data 500, which is a gain to you. You can transfer to the profit and loss account, to P&L account, which is 500. Nowhere it is impacted to the investment account. Nowhere it is impacted the investment account, but due to which we are getting the profit, there is bank account data to profit and loss account. Option number 3. We have another option as well. What is that option? We are not subscribing. We are not entering into the rights renouncement agreement. We will simply reject the rights. Reject. Sir, if you are simply rejecting the rights, no impact. That's it. No impact. You are rejecting the rights. Nowhere investment is increased. You are rejecting simply, as well as you are not entering into the rights renouncement agreement as well. You are rejected such right shares. Simply there is no impact. Now here my conclusion is, at the time of issue of right shares by investee company, you may get such right shares. If you really subscribe such right shares, then investment account is impacted. How many number of right shares you are going to subscribe, to that extent your investment is going to increase. So the entry need to be passed is investment account data to bank account. If it is in the ledger, then cost price of the investment need to increase, and the number of shares also need to increase. Am I right? But if the rights, if the shareholder, if as an investor is going for rights renouncement concept, then investment account may not impacted. Due to proceeds of the rights renouncement, you will get certain profit. Such profit you may transfer to the profit and loss account, that is bank to P&L account. But if the right shares itself is tried to be rejected, there is no impact at all under the investment account, as well as P&L account also there is no impact. Am I right? Sir, is there for certain number of shares can we subscribe, certain number of shares can we go for rights renouncement? Yes, it is also possible. Nobody will object you to either go for option 1 or option 2. In combination of option 1 or option 2 also you can do. I mean to say, for example, out of 500 shares, 250 shares you can subscribe, remaining 250 shares you can go for rights renouncement. Nobody will object you. That is up to depending upon your liquidity and your decision. Okay, now please all of you concentrate. I'm explaining one more provision which is related to the right shares only. Concentrate here, guys. Now, as on which date actually we are issuing the right share? As on 1/9/2020, right? Please concentrate. Just a second. So this is the year 21/22. As on which date right share is going to issue? As on 1/9/2021, right? 1/9/2021 only we are going to issue right shares, right? That is 21/22 means this is 1/9/2021. Sorry. So that is 1/9/2021. We are going to issue right shares. You know what happened at the time of issue of right shares? Up to the issue of right share, the existing share price is increased a lot. Before the issue of right share, the existing shares are known as right share price. You know, already I discussed all such things actually under bonus and right shares, right share. Once the right shares are issued, which is actually a cutoff date, on such cutoff date, right shares are issued. So once the right shares are issued, after that, the share is known as X right share. After that, the share is known as X right share. In generally, once the right share got issued, the share price is declined like anything. The share price is declined like anything for the existing shares. Why? The right is issued now. Now nobody is interested to buy such shares at that price. So that's why the price is slowly declining, which is known as X right share price. Now the difference between right share price and X right share price is known as value of the right. If you really remember the concept of right shares, the difference between right share price and X right share price is known as value of right. Am I right or wrong, guys? Now the difference between right share price and X right share price is value of right, right? Now, sir, if decrease is the if the existing share price decreased, then what would occur, sir? Now you should recognize such a loss under profit and loss account in generally. Now the decrease in share price the decrease in existing share price after rights issue, the decrease in existing share price after rights issue is recognized as a loss in statement of P&L. In statement of P&L. As an investment point, as an investor point of view, I'm telling you. So once the share price decreased due to becoming of right share into the X right share, the loss derived, such a loss in generally, the decrease in existing share price after right issue is recognized as loss in statement of profit and loss account. Now all of you concentrate. Still the provision is not yet over. Sir, through rights renouncement concept, you got certain proceeds through sale of such rights, right? Approximately for 500 you got. If you have any of the proceeds through, rights renouncement, the proceeds from rights renouncement can be used to set off this loss. I'm repeating one more time. Please concentrate. If proceeds from rights renouncement, if proceeds from rights renouncement exist, then such proceeds can be utilized to set off loss occurred above. Can be utilized to set off loss occurred above. You know why? Sir, if there is a decline in the value of existing share that is due to becoming of come right to X right, you are recognizing the loss in the statement of P&L, right? What is the entry you may pass at that point of time? That is P&L to investment account, to P&L to investment account. You are debiting the P&L here, you are crediting the P&L here. Rather than debiting and crediting, you can net off. For example, loss we are getting only 200. Now you can set off this 500 profit with 200 loss. The excess of 300 profit you may credit to the P&L. Are you getting my point? Now here it is credit, here it is debit. Rather than making crediting and debiting, the net figure either you can debit, you can credit. Do you understand? That is the point they are giving as an additional point. When come right share becomes the X right share price, the loss occurred can be set off with the proceeds out of rights renouncement. If still there is a balance under rights renouncement, you can make it transfer to the profit and loss account. Okay. So this is the concept of right shares. Okay, sir. Sir, ultimately, what is the impact due to right shares? Can you please tell me? So due to purchase of such right shares, simply due to subscribes of the right shares issued by the company, the cost of investment will increase. The number of right shares are also got increased. If you go for the rights renouncement concept, the proceeds can be created to the P&L. It is nowhere impacted to the investment account. If you are rejecting such right shares, there is no impact to P&L as well as no impact to investment accounts. Now, when come right share price becomes X right share price, due to which if any loss arises, such loss, you can make it set off with the proceeds from the right renouncement. The remaining or the surplus proceeds only you can make it transfer to the profit and loss account. That is the story, guys. This is related to right shares. Now, let me explain things related to bonus shares. Bonus shares. So in detail, we discussed the concept of bonus shares in issuer point of view. At the time of issue of bonus shares, which reserves need to use. Okay. So such all things, the Companies Act 2013 provisions, we simply discussed at that point of time. Am I right? Now we are discussing the bonus shares in investor point of view. When bonus shares issued, by the company to investor, definitely bonus shares will be subscribed, no doubt about it, because they are offered at free of cost. Am I right, guys? They are offered at free of cost. When bonus shares are issued, such shares subscribed by investor, right? Such shares subscribed by investor. Now, whenever investor subscribe the shares, what is the impact? Whenever investor subscribe the shares, there is no increase in total cost of the investment. There is no increase in total cost of investment. You know why? Sir, we are paying nil amount to subscribe such bonus shares. No need to pay any single rupee to subscribe such bonus shares which are offered at free of cost. So that's why there is no increase in total cost of investments. But there is increase in number of, but there is increase, but there is increase in number of shares held as investments. Number of shares held as investment. So that means at the time of issue of bonus shares, we will write two investment in bonus shares, simply two bonus shares. Under cost column nil, but under number of shares, we will increase. Are you getting my point? Are you with me, all of you guys? So now we started the journey with explaining the things related to variable income bearing securities at the time of acquisition or purchase of investment. The common or the as usual journal entry investment in equity shares to bank, but such price is inclusive of pre-acquisition dividend as well. That's why which is known as cum dividend quotation price. Actually, at the time of receipt of the dividend, you should split the dividend into the pre-acquisition dividend as post-acquisition dividend. Pre-acquisition dividend is reduced from cost of investment. Post-acquisition dividend is credited to the profit and loss account. If the declared dividend is interim dividend, we can treat it as post-acquisition dividend and credited to profit and loss account. Then I discussed the concept of right shares. Sir, if the right shares are subscribed by the investor, then the cost of investment will increase, number of shares also increase. If such right shares are not subscribed by the public, then investor have an option to go for rights renouncement. Then the proceeds of rights renouncement is make it simply credited to profit and loss account. If the right shares are rejected, there is no impact. And one more thing, sir, due to becoming of come right to X right share, due to becoming of X right share from come right share, if there is any loss occurred, such a loss, we can make it set off with the proceeds from the rights renouncement. The net surplus only we can make it transfer to the profit and loss account. That is things related to right shares. Sir, bonus shares offered completely at free of cost. That's why there is no increase in cost of investment, but there is increase in number of shares held as investment, because which is offered at free of cost. That's it, guys. With this background, let us discuss certain problems. And before going to problems, let us see the content given in my text. All of you please observe here, variable income bearing securities. So in the last lecture, we only read the content related to fixed income bearing securities. Now this is time to a content related to confirming the content related to variable income bearing securities. Just it is a confirmation, everything I discussed. These refers to securities having variable return of income. Investment in equity shares comes under this category. The following points should be noted with respect to investment in equity shares. Dividends from investments in shares are not recognized in the statement of profit and loss until a right to receive payment is established. When you should need to recognize the dividend? When right to receive is established. When right to receive is established? At the time of declaration. At the time of declaration. That point also discussed. The amount of dividend accruing between the date of last dividend payment, that is from the last date of payment, to the date of purchase, cannot be immediately ascertained at the time of purchase of variable income bearing securities. This is not possible like fixed income bearing securities. At the time of purchase of fixed income bearing securities, from the last date of payment of interest to up to date of purchase, we know. But in case of acquisition of variable income bearing securities, from the last date of dividend payment to the up to the purchase of investment, we don't know at the time of purchase of investment. That's why entire both cost to price and the dividend accrued up to the date we are putting under the cost column only. That is in the following way, the information is incorporated in the books of the investor at the time of purchase. That is investment account at to bank account with the entire purchase price. Sir, with the entire purchase price means I already told you, which is inclusive of pure cost as well as dividend accrued up to this period. But we don't know how much dividend accrued. Next, the amount will appear in the capital column of the investment. You know, capital or cost column, as like how we prepared the ledger of the fixed income bearing securities. In the same way, we are going to prepare the ledger of variable income bearing security. That is date, particulars, number of shares, and on behalf of interest, we will represent here dividend, which is income column, and the last column is capital column or cost column. So that's why which is we are going to record under capital or cost column of the investment account. The adjustment with respect to the dividend is made when the dividend is actually received as under. So if the dividend is related to pre-acquisition dividend, bank to investment. In the single entry, they recorded both bank to investment with the amount of dividend for the period for which the investor did not hold the share. For the period for which the investor did not hold the share is nothing but pre-acquisition dividend, which is reduced from the cost of investment. That's why investment account is credited. Bank to dividend account, which is actually ultimately created to P&L with the amount of dividend for the post-acquisition period. So the period for which the investor held such investment, sorry, the period for which investor is exist in the last year is known as post-acquisition period. So which is ultimately created to P&L. Okay, next. Here, sir, those should be need to give adjusted under the ledger. I will tell you in at the time of discussing the problem. So that's why I don't want to read the star marks. Just leave it for the time being. We are seeing such things at the time of dealing problems. The important point with respect to the investment in equity share is that the amount of dividends for the period for which the shares were not held by the investor should not be treated as revenue received, but they should be treated as capital receipt. That is, when dividends on equity shares are declared from pre-acquisition profits, the amount of such dividend received by the investor is entered on the credit side of the capital column so as to reduce the acquisition cost. You know only one thing, right? That is bank account that are to investment account. Sir, bank to investment account means you should need to reduce the cost. Where is the cost? Debit side. Sir, the entire cost column of the investment is under the debit side. If you want to reduce the cost column, you should need to write under credit side, right? So that's why he is given that at the time of receipt of pre-acquisition dividend, it should need to be credit side of the capital column. Under the cost column or the capital column, you need to make it credit. For example, if this is the investment, cost is here at the time of acquisition. Now, if you want to reduce that, you should need to write here, which is nothing but credit side of the capital column. Do you understand? If it is related to post-acquisition dividend, you will record under dividend column. That is nothing but interest column. Okay, we'll deal once again all such things at the time of dealing the problems. No worries. Next, coming to point number 4, guys. When right shares offered are subscribed for, the cost of the right shares is added to the carrying amount of the original holding. So simply cost of investment will increase, number of shares as well also increase. If rights are not subscribed for but are sold in the market, which are nothing but rights renouncement, the sale proceeds are taken to the statement of profit and loss. I told this point as well. Where the investments are acquired on cum right basis and the market value of investments immediately after becoming the ex right is lower than the cost for which they were acquired. The difference, it may be appropriate to apply the sale proceeds of the right to reduce the carrying amount of such investment to the market value. Now the sale proceeds we can apply to nullify such loss, where an investment is acquired by way of issue of bonus shares. No amount is entered in the capital column of the investment because cost is zero, since the investor has not paid anything. That's it, guys. Now coming to the disposal of investment, guys, all of you, the last topic, disposal of variable income bearing securities. Where it is? Here it is exist. It's very simple. At the time of disposal, the journal entry is bank account at R2, investment in equity shares. So if it is profit, you will write one more entry, right? Which is investment in equity shares to P&L. You will write two entries. If it is profit situation, one entry is bank to investment in equity shares. Another entry is investment to P&L. If it is the loss, you will record here itself bank account at R, profit and loss account at R to investment in equity shares. Such a simple accounting treatment at the time of disposal. So that's why I don't want to spend much time for disposal, guys. Okay. So now the concept of variable income bearing securities is very simple. To put it simply, at the time of acquisition of variable income bearing securities, the journal entry is investment to bank. Here, the price you are paying to acquire such investment is inclusive of both cost as well as dividend foregone by the other party till that period, but we don't know such dividend. Now, at the time of receipt of the dividend is broadly categorized into two types: pre-acquisition dividend, post-acquisition dividend. Pre-acquisition dividend is reduced from cost of investment. Post-acquisition dividend is credited to profit and loss account. Now, If at the time of issue of right shares, if such right shares are ultimately subscribed, there is increase in number of shares as well as cost. If such right shares are not subscribed by you, then you may go for the rights renouncement process. Now the proceeds from rights renouncement, you can make it credit to the profit and loss account. If such right shares are completely rejected by you, then there is no impact. The loss arises due to conversion of cum dividend shares to the ex-dividend share price, or to put it simply, to reduce the existing share price to the current market price. The carrying value of the existing share price is reduced to the current market price. The loss arises, you can make it set off with the proceeds from the sale of rights. That is proceeds from rights renouncement. If there is any balance on the rights announcement, you can make it transfer to the profit and loss account. Coming to the bonus shares, there is no increase in the total cost of investment, but there is increase in the number of shares held as investment. At the time of disposal of investments, bank account data to investment, investment to P&L. If it is loss situation, bank profit and loss account data to investment account. So if at any point of time dividend is declared out of current year profits itself, such dividend is known as interim dividend. Interim dividend, we are always treated as post acquisition dividend. That's why created to the profit and loss account. That's it, guys. We saw the parts, the entire content in my text as well. Now this is the time to discuss about problems, guys. Let us see one problem in this video lecture. The remaining problems I'm going to discuss in future classes. Please all of you open. Completed up to problem number 5, right? Now all of you please see problem number 6, guys, which is the basic problem related to variable income bearing securities. On 1/4/2011, Mr. Kishan Murthy purchased 1,000 equity shares, which are not opening balance. He is purchasing 1,000 equity shares, face value 100 each, in Telco Limited at the rate of rupees 120, each from a broker. Who charged 2% brokerage. Always brokerage should be calculated on quotation price, guys. Maybe interest or dividend is calculated on face value, but brokerage is always calculated on QP, quotation price. You know why? Really, at which value you are going to entering into the transaction, for that value only, broker will expect the brokerage. Sir, you may be purchased at that price at more than face value. Are you paying brokerage on face value? No, nobody will accept. No broker will agree for that. Broker will expect that on the basis of the value of the transaction, he want to get the brokerage, right? So that's why nobody will accept if you want to calculate the brokerage on the face value. That's why such brokerage should be always need to calculate on quotation price. He incurred 50 paisa per 100 rupees as cost of shares. This is also you need to going to calculate on quotation price. Always the expenses, whether it is brokerage, whether it is cost of stamps, whatever the case may be, he incurred 50 paisa per 100 rupees quotation price. For 100 rupees quotation price, he incurred 50 paisa as cost of share transfer stamps. So actually earlier in past, for the purpose of transferring of the investments, the transfer agreements, all physical agreements, and fixing the stamps, all such things are there. Right now the transactions are happened through dematerialized form. So at present brokerage is applicable, but share transfer stamps are not applicable in the present scenario. So which is actually old problem. So that's why they are giving the share transfer stamps, all other issues. On 31st/1/2012, bonus was declared in the ratio of 1:2. In the ratio of 1:2 means for every 2 shares we got 1 share. For 1,000 equity shares we got 500 shares at free of cost. After issue of bonus shares, number of shares will become 1,000 plus 500, 1,500. Before and after the record date of bonus shares, the shares were quoted at rupees 175 per share and 90 rupees per share respectively. So indirectly he is telling that before issue of bonus shares, the share price is 175, but after issue of bonus share, the share price is decreased to 90 rupees per share. As like how the cum right share price becomes X right share price, how the share price is going to decrease, in the same way before issue of bonus share, the share price is very high. So once the bonus share is issued, the share price will be declined. On 31 March 2012, Mr. Krishnamurthy sold bonus shares to a broker. At which price he is going to sell? 90 rupees is given now. After issue of bonus share, the share price will become 90 rupees. Even though he is not mentioning, as on 31st March 2012 means after issue of bonus share, these are sold to a broker at the rate of 90 rupees per share. Why? Because he is clearly given that after issue of bonus shares, the share price in the market is 90 rupees. Who charged 2% brokerage? Who charged 2% brokerage? So there are no shares transfer stamps. Maybe shares transfer stamps will be beared by the broker, not by me. I think so. But right now only brokerage is there. Show the investment account in the books of Mr. Krishnamurthy, who held the shares as current invest assets, and a closing value of investment shall be made at cost or market value, whichever is lower. Anyway, there is no market value given in the problem. Am I right? No, market value is given. What is the market value? 90 rupees per share. He simply told that after declaration of the bonus shares, bonus were declared in so and so ratio, the shares were quoted before and after the record date of bonus share, the shares were quoted at 175.90 share. That's why as on 31st March 2012, also the market value per share is 90 rupees. You should need to compare the cost price with the market value. If any difference is there for such loss, you need to debit to profit and loss account. We'll see one by one point item through my OneNote, guys. Please, all of you, observe here. Let me open problem number 6. So what is the title, guys? Investment in equity shares of Telco Limited. Investment in equity shares of Telco Limited. As like in case of fixed income bearing securities, you can start doing the format, guys. You can start make it ready the format. So the first thing is date, particulars, number of shares. Here dividend, you can call it as income as well. Either income column or a dividend column, both are same. Then capital column or cost column, both are same. Either capital or cost. Next, date, particulars, number of shares, dividend or income, then finally capital. Yeah, this is more than enough for me. Consider it, guys. So which is date column, and particulars, number of shares, dividend or income, capital or cost. In the same way, credit side as well. So quickly complete the format from your end as well, guys. Yeah, no consider all of you. So one by one, we will start in chronological order. We will complete the problem. As on 1/4/2011, the date is 1/4/2011. Mr. Krishnamurthy purchased 1,000 equity shares of rupees 100 each in Telco Limited at the rate of rupees 120 each. Face value is 100, cost price is 120, brokerage is 2% and 50 paisa per 100 rupees quotation price as cost of shares transfer stamps. Am I right? You know already cost of the investment includes brokerage. Okay, that all the expenditure which are directly attributable for the purpose of acquisition and purchase price all are form part of cost of investment. We already read in accounting standard 13. Now to bank. So number of shares, 1,000 equity shares, 1,000. Dividend or income column nil guys, nothing is there. Okay. So there is no interest accrual as like how the interest accrual concept is there. There is no dividend accrual concept because after declaration of the dividend only we can right to receive is established. So that's why there is no dividend accrued. Next, cost of the shares. All of you please concentrate. So 1,000 shares are there, right? 1,000 shares are there. Each share is 120 rupees. 1,000 into 120. Next, 2% brokerage. 2% brokerage means I'll put into 102%. If you can calculate on this price only, you should need to calculate na into 2% plus into 2% you should need to do. On behalf of that, I will just multiply with 102%. And he incurred 50 paisa per 100 rupees. That means 0.5%, 0.5%. On behalf of 102, you can provide 102.5%. That's very simple calculation. That is why you are multiplied with additional 2 point, why you are adding additional 2.5%, 2% for brokerage, 0.5% for share transfer stamps. You can calculate it, guys. 1,000 into 120 into 120 into 102.5%. 1,000 into 120 into 102.5%. How much I got? 1,23,000. Okay, next. On 31/1/2012, bonus was declared in the ratio of 1:2. What is the date given here? As on 1/1/2012. Am I right? Sorry, 31/1/2012. 31/1/2012. Bonus shares. 2 bonus shares. So 2:1 means in bracket you can mention 1,000 into 1/2, which is equal to 500 shares. Cost column nil, guys. Bonus shares cost column is nil. Next, before and after the record date of bonus shares, the shares were quoted at 175 at the rate of 90 per share respectively. You can only remember one thing: after issue of bonus shares, the market price for the throughout the year is 90 rupees. That is the meaning of that sentence. Now, as on 31st March 2012, Mr. Krishnamurthy sold bonus shares to a broker who charged 2% brokerage. Now go to working note, all of you. What is the working note? You know, at the time of sale of investment, always you should need to calculate profit or loss, right? Working note number 1. Calculation of profit or loss on sale of bonus shares as on which date you sold out? 31st March 2012. Am I right? 31st March 2012. 31st March 2012. They sold as on 31st March 2012. Now to know profit or loss, what should you need to compare? Sale proceeds with cost value of investments. Am I right? First, let us check the sale proceeds, guys. At which price you sold out? 90 rupees, right? How many number of shares you sold out? Bonus shares only. Now, all of you, please concentrate. proceeds through sale of bonus shares. Proceeds through sale of bonus shares. How many number of bonus shares you sold out? 500. You got 500, the entire 500 shares you are going to sell out. So each share price is how much, guys? Each share price is at the rate of 90 rupees. So you get here 5,000 into 90. How much? Sorry, 500 into 90. Got 45,000, right? But one thing you need to remember, guys, here you paid the brokerage. If you paid the brokerage to the broker, then your sale proceeds decreased. Am I right? That means to get the net sale proceeds, you can reduce brokerage. Brokerage, you need to calculate on the 45,000, which is 45,000 into 2%. Am I right? Brokerage is how much? 2%. That is 45,000 into 2%, 900, guys. No, may no net sale proceeds is how much? Net sale proceeds. So net sale proceeds is equal to 44,100. That is the net sale proceeds. Now you can compare these net sale proceeds with cost of investments. Can you please tell me, guys, all of you, cost of investments how much? Nil, right? Should not take like that. If nothing was given, how to calculate the cost of investment? You should apply the average cost method. That is very, very important. Sir, if it is specifically given that the cost of investment you can take for the bonus shares nil, then you can take. But if nothing was given, we already made a thumb rule, right? Which policy you should need to adopt? Average cost method. We already wrote. Where it is, where we discussed. That is before discussing fixed and comparing securities itself, we discussed it, right? Here itself, we assume that on an average selling the investment from all different lots acquired at different dates for the purpose of knowing the cost, for the purpose of knowing the cost of investment to be sold. Cost of investment sold. If the investments are held as stock in trade, then cost formula we may use as per AS2, that is maybe FIFO method or weighted average method. We already done with such issues. So that's when nothing was mentioned means how to calculate the cost value of investments. We are applying the average cost method. We are applying the average cost method. In case of average cost method, how to value the total number of shares we have in our hand, 1500 shares. The total number of shares we have 1500 shares. For such 1500 shares, cost price is how much? 1,23,000. 1,23,000. Now you are going to sell how many number of shares? 500 shares. Then for 500 shares, cost is how much? Like this, you need to calculate, guys. So which is 500 into 1,23,000 divided by 1500. So I got 41,000 rupees. Now profit is how much? Now profit is 3,100. Now profit is 3,100, right? Now, what is the journal entry you should need to pass? We know at the time of sale of investments, bank account debtor, how much you are getting? 44,100 you are getting to investment in equity shares, which is 44,100. Now you can make it transfer to P&L. Investment in equity shares to profit and loss account, which is 3,100. Now you can make it post such entries under investment account. As on which date, guys? You are selling as on 31st March, I think so. 31st March 2012, right? So as on 31st March 2012, buy bank 500 shares here under the dividend column nil. So the sale proceeds is how much? 44,100. 44,100. Now you can make it transfer the profit here 31st March 2012 to profit and loss account. How much profit, guys? 3,100. Out of this 44,100, 3,100 profit, you can make it transfer to P&L. This is important. So now all entries are over. Now we are as at 31st March 2012. All of you please concentrate. Now we can measure the investments as on balance sheet date. This is working note number 2. What is working note number 2? Measurement of investment in equity shares as on 31st March 2012. So in the problem, it is clearly given that those are current investments. If those are current investments which are measured at cost or fair value, whichever is lower. Cost or fair value, whichever is lower. Now consider, guys, all of you. You know, market price is the best estimate for the fair value. The market price after issue of bonus share is 90 rupees, right? Now, how many number of shares exist on your hand after sale of bonus shares? 1,000 shares, right? Now the fair value is 1,000 into 90. 1,000 into 90, which is nothing but 90,000, which is actually 90,000. Bracket I am mentioning, which is actually 90,000. You can calculate the cost price as a balancing figure easily. That is 1,23,000 plus 3,100 minus 44,100. In bracket, you can show the cost price, guys. What is that? 1,23,000 plus 3,100 minus 44,100. Am I right? 1,23,000 plus 3,100 minus 44,100. So how much is the cost price? So which is 82,000, guys. Cost price is 82,000. So 90,000 or 82,000, whichever is lower. That is, cost price is lesser than fair value. Not the fair value is lesser than cost price. Therefore, investments continue to disclose on cost price. That is 82,000. There is no need to recognize any profit or loss. So now you can go for final disclosure 31st March 2012 buy balance carried down. So here this is 1,000 dividend nil, which is total is 82,000. So you can make its total from your end, guys. So which are totals? Okay, so like this, you need to present variable income bearing securities. So which is investment in equity shares of Telco Limited. So let us cross check the answer with our printed solution as well. Problem number 6, right? So if you check here, So the closing value of investment is 82,000. So working notes also we can give reference, which is working note number 2, which you can give reference of working note number 1. Okay. So sale happened and the closing balance and all figures are 3,100 transferred to profit and loss account. Sorry. Okay. So all are same as it is, just they given. So with this, we completed concept on variable income bearing securities as well as problem number 6. In the next forthcoming lectures, we are going to do as much as problems as we can. Okay. Then this chapter will be over. I think so. I required 2 more lectures to complete this chapter. Maybe certain problems are very bigger, which are combination of fixed income bearing securities or variable income bearing securities. Sometimes they may ask. In the recent examination, once upon a time, they asked, they both combine fixed income bearing securities and variable income bearing securities. Such type of problems also I covered in our material. So don't bother about anything. Everything is covered in my material. Just peacefully you can listen my classes and follow my material. You will get good marks. Okay guys, I'll meet with further more problems in the next video lecture. Until bye, have a nice day. Very good morning, soldiers. So this video lecture, we are going to start with a new chapter, redemption of debentures. So at the time of starting up of accounts, we started with chapters related to companies. I mean to say a company related accounting treatments we done initially. That is, if you take financial statements of companies, profit or loss pre or post incorporation, bonus and right shares, redemption of preference shares. Am I right? Then we move on to accounting standards and certain chapters along with accounting standards, including one of the financial statement, cash flow statement that we made as per AS3. Am I right? So redemption of debentures chapter is also one of the company related chapter actually. But why we are dealing right now rather than discussing at the time of dealing the other company accounts related chapters? You know, the one of the part of the redemption of debentures topic having some interconnection with investment accounts. So that's why after completion of investment accounts, we are dealing redemption of debentures. That is the reason I already told you at the inception itself. So I arranged all the chapters in such a way that one and the other chapter are interlinked with each other. So ultimately it will give benefit to the student. That is the idea behind the arranging of chapters. Okay. Apart from all such things, let me entering into the topic, redemption of debentures. So the title is redemption of debentures. We already saw provisions of Companies Act 2013 related to redemption of preference shares. Am I right? Do you remember? Do you remember, guys? I mean to say, at the time of redemption of preference shares, which resource can we utilize? So can we utilize the existing resources, or can we issue fresh issue of securities like fresh issue of equity shares? Then from such proceeds, can we make it redeem? Okay, so if you want to utilize the existing resources, then you need to transfer certain amount to capital redemption reserve. If you are utilizing fresh issue of equity shares, then no need to transfer any amount to CRR. So like that, certain issues we learned in the chapter redemption of preference shares. Am I right? So here also in case of redemption of debentures, we will learn certain provisions of Companies Act 2013 as well. So now in the chapter overview, what we are going to discuss, meaning and types of debentures. So what is the meaning of debenture and what are the different types of debentures exist before knowing about the redemption of debentures? So, you know, the concept of redemption of debentures is nothing but paying amount back to the debenture holders. Company required certain funds as a form part of the procurement of funds or the procurement of finance, company have an option to issue one of the instruments so called as debentures. How they can procure loans from the bankers in the same way they can issue the debentures, they can procure amount from the public. As a result, they are paying interest for certain period up to the date of redemption. Am I right? So simply redemption is a process of repaying of money back to the debenture holders. Okay, let it be. So meaning and types of debentures we will see. Then after that, provisions of Companies Act 2013 and accounting for such provisions also we will see. Methods of redemption of debentures. What are the different methods possible? What are the different methods exist for the purpose of redemption of debentures? Also we will see. This is the three major issues we are going to see. One is related to meaning and the types of debentures. Another one is provisions of Companies Act 2013 and accounting treatment based on such provisions. And finally, we will see methods of redemption of debentures. First, let me take first topic for the discussion, which is meaning and types of debentures. Concentrate, guys, all of you. Sir, only the relevant and important points I'm going to record under my OneNote. Okay. So remaining all the things we are seeing through our text. Meaning, a debenture is an instrument issued by a company under its seal, acknowledging a debt and containing provisions as regards repayment of the principal and interest. Just a second. Here I'll open. Debenture. It's okay. Yeah. So you can see debentures will look like this actually. So this is like a bond only. If you observe, all these are debentures. So mortgage debentures, all these are debentures. It's almost like a bond paper. Am I right? So debentures will be like this only. But right now, on behalf of in paper mode, it is in the dematerialized form. Am I right? Now, a debenture is an instrument issued by a company. This document is ultimately issued by a company under its seal. If you see in each and every document, it have their company seal, and it is there. Such paper, such document is in the letterhead of the company name. That is common seal and letterhead of the company name is there. Acknowledging a debt and containing provisions as regards repayment of principal and interest. Acknowledging as debt means, yes, we received so and so amount from you. As a result, we need to repay such amount as on so and so due date, and containing provisions as regards repayment of principal as well as interest. For example, interest they are paying off yearly as on 30th September and 31st March. They will mention such dates on such instrument as well. Now such instrument is technically known as debenture. So debenture is an instrument issued by a company under the common seal of the company and acknowledging a debt and containing the provisions related to repayment of interest as well as principal. Okay. Types of debentures. So based on the security, secured debentures, unsecured debentures. At the time of issuing the debentures, for the debenture holders, if you offered any of the assets as security, then such debentures are known as secured debentures. If you are not offered any security, then at the time of liquidation of the company, you may pay along with unsecured creditors. Then at that point of time, the debentures are called as unsecured debentures. In generally, debentures are issued by offering a security on floating charge. So that's why debentures are known as debentures are known as creditors with floating charge. you may know all such issues in liquidation of companies in group 2. Actually, there is a separate chapter called liquidation of companies in group 2. So where debentures in generally we are going to classify under secured creditors with floating charge, because whenever you are issued your debentures, so you may offer all of your assets as a security under the floating charge. So that's why in generally debentures are issued by offering a security. Okay, next, convertibility. If the debentures are going to convert into either preference shares or equity shares, which are known as convertible debentures. So debenture holders are not at all converted into either preference shares or equity shares, then such debentures are known as non-convertible debentures. Next, permanence. In the order of permanence. Permanence means whether such debentures are redeemable or irredeemable. You know, in India right now, as per Companies Act 2013, there is a no scope to issue irredeemable debentures in India, which is not possible right now. Redeemable debentures means we should make repay after certain point of time. In case of irredeemable debentures means we will only repay at the time of liquidation of the company. Till the liquidation date, no need to pay any single rupee in the form of principal, but you should need to pay interest. That is different story. Irredeemable preference shares, irredeemable debentures means you may pay at the time of liquidation of the company only. But redeemable debentures means after a certain point of time, as per the instrument entered date, in such instrument itself, we should clearly specify the redemption date itself. Next, coming to negotiability. Registered debentures, bearer debentures. What is the difference between registered debentures and bearer debentures? Bearer debenture means earlier I showed one certificate, right? For example, if such certificate is on my hand, I will become the owner of such debenture. That is nothing but bearer debenture. Registered debentures means no, you need to register under the debenture holders register. Then only you can become the registered debenture holder. Even though such debenture certificate is stolen by any person, he will not become the owner if such debenture is a registered debenture. Right now, all the debentures are only registered debentures only. Bearer debentures are not exist. Why? Because after dematerialization concept came into existence, whenever you purchase your debenture, it will be automatically got registered under debenture holders register, and it is added to your dematerial account, that is demat account. So that's why in generally right now all the debentures are registered debentures. But in case of the bearer debentures, so if such debenture certificate is in the hands of who, in the hands of whom such person is become the owner of such debenture. Okay, next, priority. First mortgage debentures, second mortgage debentures. What about this, sir? Sir, at the time of repayment, first to whom you should need to pay, that is first mortgage debentures. You are offering all the assets as security to all the debentures, but you are grouping certain debentures as first mortgage debentures, you are grouping the other debentures as second mortgage debentures. First, you should need to pay the amount to first mortgage debentures after disposal of assets at the time of liquidation. So then after making payment of first mortgage debentures, you will make repayment to second mortgage debentures. Or at the time of redemption, that is different. At the time of redemption, that is always depending upon the redemption due date, you may make payment to the debenture holders. If both the debenture holders is having the same due date, first you should need to pay the first mortgage debentures. After that, you can make payment to the second mortgage debentures. And at the time of liquidation of the company also, you should need to pay first mortgage debentures, then second mortgage debentures. Just in the common parlance, now we saw now we've seen certain types of debentures, that is on the basis of security, secured and unsecured debentures, on the basis of convertibility, convertible debentures and non-convertible debentures, and in the basis of permanence, redeemable and irredeemable debentures. Then on the basis of negotiability, registered debentures and the bearer debentures, and on the basis of priority of payment, first mortgage debentures and second mortgage debentures. Hope you understand the meaning of debenture as well as different types of debentures under the first issue. Am I right? Next. Provisions under Companies Act 2013. Provisions under Companies Act 2013. Section 71(2) further provides that no company can issue any debentures which carry any voting rights. So debenture holders will not have any voting rights in the general meetings. Only equity shareholders will have the voting rights. That's why equity shareholders are the real owners of the company. And preference shareholders will also have the voting rights in their class meetings only. If any meeting is especially arranged for the purpose of protecting the rights of the preference shareholders, then preference shareholders will get voting rights in that particular meeting. But in general meetings, preference shareholders also will not get any right. Okay, that's why only equity shareholders are only having a real voting right in the company. That's why equity shareholders are called it as real owners of the company. Okay, come back. In the same way, debenture holders also will not have any right in to speak or to participate in the meetings. So that's why it is completely void ab initio issue debentures with voting rights as per the Companies Act 2013, as per section 71 subsection 2. Next, an issue of secured debentures may be made provided the date of its redemption shall not exceed 10 years from the date of issue. In generally, the maximum redemption period for any of the debentures are 10 years. Maximum redemption period as per the Companies Act 2013 is 10 years. That means you cannot hold the money of the public in the form of debentures not more than for 10 months, not more than for 10 years. Am I right? That is the essence of the uh, issue. That is the essence given for the maximum redemption period, provided that the following class of companies, but certain exceptions are there for certain class of companies, may issue secured debentures for a period exceeding 10 years, but not exceeding 30 years. They can issue for greater than 10 years, but it should not exceed again 30 years. Which type of companies? Companies engaged in setting up of infrastructure projects, infrastructure finance companies, infrastructure debt fund non-banking finance companies. If you observe in every point, infrastructure is the common word, right? So simply speaking, the infrastructure projects are much more longer. Construction of bridges, canals, dams, roads, railway slidings, it took so much of time. So that's why company required a huge amount for a longer period. So at that point of time, we may not put the burden on the companies to repay within 10 years. That's why for such companies, they can repay more than, that is exceeding 10 years, but not exceeding 30 years. So one more category is there, companies permitted by a ministry or a department of the central government, or by the Reserve Bank of India, or by the National Housing Bank, or by any other statutory authority to issue debentures for a period exceeding 10 years. That means for those companies who permitted either ministry or department of central government, simply central government permission is there, or RBI permission is there, or NHB, National Housing Bank permission is there, or any other statutory authority permission is there, then we can make it redeem after 10 years is also possible for such companies. So majorly infrastructure companies and companies having permission from either central government or from RBI or from National Housing Bank can only eligible to redeem for more than can only eligible to redeem after 10 years. Okay, that is second provision of Companies Act 2013. The first provision we saw, debenture holders are not allowed to participate in the meeting through voting rights. And in the second issue is maximum redemption period for the debenture holders for different class of companies. Then coming to the third point, guys, which is very, very important. A company issuing debentures may be required to create a debenture redemption reserve. In case of redemption of preference shares, if redemption happened through existing resources, to the extent of face value of preference shares redeemed should be transferred to capital redemption reserve. Am I right? Now here, a company issuing debentures may be required to create a debenture redemption reserve account out of the profits available for distribution of dividend. Simply, profits available for distribution of dividend means free reserves. Free reserves means either profit and loss account or general reserve. And amounts credited to such account cannot be utilized by the company for any other purpose except for redemption of debentures. Such an arrangement would ensure that the company will have sufficient liquid funds for the redemption of debentures at the time they fall due for payment. Simply, what he is telling, for example, you issued debentures right now. For the purpose of making redemption, maybe the redemption is going to occur in the future. That is different story. But you issued certain debentures, right? Out of such outstanding debentures, certain percentage, how much percentage you need to transfer, such all things we are going to discuss at later stage. Certain percentage you should need to transfer to debenture redemption reserve from the free reserves of the company. From the free reserves means either profit and loss account or from the general reserve. For creation of debenture redemption reserve, the general entry is profit and loss account debtor or general reserve account debtor to debenture redemption reserve. How much I need to create, that is different story. We are going to see debenture redemption reserves rules 2019 at later stage. There we can clearly know how much percentage of debenture redemption reserve need to be created. Sir, why this debenture redemption reserve is created? This DRR, the fund existing under DRR, should not be utilized for any purpose. Should not be utilized for any other purpose except for the purpose of redemption of debentures. Sir, why this provision is inserted in Companies Act 2013? At the time of redemption of debentures, company may not search for the liquid funds. So already if you create in the form of debenture redemption reserve, it's very quite easy. In very smooth manner, the company can repay amount to the debenture holders as on date of redemption. With that intention only, each and every company should need to create debenture redemption reserve out of free reserves which are existing under reserves and surplus. How much percentage need to create, and such all issues we are discuss at later stage. Okay. Next, as per Rule 18 subsection 7 of the Companies Share Capital and Debentures Amendment Rules 2019. Just now I spoke. That is in point number 3. I told there are certain amendment rules applicable as per 2019. That is Share Capital and Debentures Amendment Rules 2019. Companies should comply below provisions with respect to debenture redemption reserve and debenture redemption reserve investments. Total two provisions here they are telling with respect to debenture redemption reserve and debenture redemption reserve investment account. How much percentage you should need to transfer to debenture redemption reserve, and how much amount you need to make it investment. Such fund is there na under debenture redemption reserve, such fund is there na. Such fund, how much you should make to invest in the form of debenture redemption reserve investment in the outside market. So both the issues we are going to deal through these amendment rules 2019. Now all of you please concentrate here, guys. So let me go to my OneNote first. You know, under overview, we are going to deal 3 things. So one is meaning and types of debentures. Meaning and the types of debentures. And another one is Companies Act 2013 provisions. Plus accounting treatment for such provisions. And in the last instance, we will see methods of redemption of debentures. Methods of redemption of debentures. Out of this, we already saw meaning and types of debentures. So what exactly the meaning of debenture? So debenture is an instrument, right? Debenture is instrument. So which ultimately acknowledging as debt, which also contains provisions related to, or terms I can put, which also contains terms related to repayment of principal and interest. Repayment of principal and interest. Am I right, guys? So under the types of debentures, we saw different types of debentures. What are different types of debentures we saw, guys? Okay, I don't want to write it. Redeemable, irredeemable, secured, unsecured, convertible, non-convertible, first mortgage, second mortgage. So such all different types of debentures we see. Am I right? Now coming to Companies Act 2013 provisions. So basically, few important provisions we saw. That is the first and foremost provision is, so few important provisions we saw. Number one, debenture holders not having any voting rights. Debenture holders not having any voting rights. We cannot issue debentures with voting rights simply. We cannot issue debentures with voting rights. Am I right? Next, we saw one more provision. What is that? The maximum redemption period. Maximum redemption period we saw. So what is the maximum redemption period? Maximum redemption period for is 10 years actually, which is 10 years. But for certain companies, for certain class of companies, the redemption period is also greater than 10 years, but less than 30 years is also possible. That is, which companies? Simply I'll put infrastructure companies plus companies permitted by central government or RBI or NHB, National Housing Bank. Okay, these three, or NHB right here. Okay, so central government or RBI or National Housing Bank. Next, one more important provision just now we saw, that is companies need to create debenture redemption reserve. Need to create debenture redemption reserve out of free reserves, as well as they need to invest in DRR investments, debenture redemption reserve investments. As per which rules? Share capital and debenture amendment rules 2019. Sir, which companies need to create? How much percentage need to create? Such all things we are going to deal as per amendment rules 2019. For each and every company, it is not mandatory. For which type of companies need to create and which type of companies, how much percentage need to create, we will deal as per the share capital and debenture amendment rules 2019. Now, all of you please consider, guys, here. Now I will discuss the provisions, that is share capital and debenture, share capital and debenture. So share capital and debenture amendment rules 2019. So first, these rules first let me apply to debenture redemption reserve. So in share capital and debenture amendment rules 2019, with respect to debenture redemption reserve, first we will discuss. Later at the final stage related to debenture redemption reserve investment also we need to discuss. But one thing you know, right? You know one thing, what is that? At the time of creation of DRR, what is the journal entry? I'm not having sufficient space there. Just I'm writing here. Please concentrate. So at the time of creation of DRR, before saying about the rules, first let me check the accounting treatment. At the time of creation of DRR, debenture redemption reserve, as per the provisions of Companies Act 2013, I need to create, right? Then what is the journal entry, guys? You can create the debenture redemption reserve out of free reserves. Out of free reserves means you can utilize profit and loss account, or you can utilize general reserve as well. To debenture redemption reserve account, simply DRR account. At the time of making investments in the outside market, at the time of making investments, what is the journal entry you need to pass? That is debenture redemption reserve investments account debtor, debenture redemption reserve investments account debtor to bank account. That is DRR investments account debtor to bank account. Such a simple journal entry we need to pass. Sir, for example, you made outside investments in DRR investment. If you get any interest, on such DRR investment, what is the journal entry, guys? There is a casual entry, a bank account data to interest on DRR investment. Such interest need to be transferred to profit and loss account. Such interest should not be transferred to debenture redemption reserve. Just a moment. I'll write such entries as well. Okay. We'll write the rules at later then. Just a moment. Just give some space to me. So at the time of creation of DRR, P&L to general reserve. At the time of making payments, DRR investment to bank. Now the next journal entry is at the time of receipt of interest. At the time of receipt of interest, what is the journal entry at the time of receipt of interest? Bank account debtor to interest on DRR investments account. Interest on DRR investments account. Okay. Now the interest should not be transferred to debenture redemption reserve. As per accounting standard 5, the profit or the revenue or expenditure related to the particular period should be need to transfer to profit and loss account only. So that's why interest on DRR investment need to be transferred to P&L account. Interest on DRR investments account debtor to profit and loss account. But this interest should not be transferred to the DRR. This interest should not be transferred to debenture redemption reserve. Our assumption is we are only making pure principal as an investment. If we are getting any interest on such DRR investments, we are withdrawing such interest. We are not making reinvestment of such interest. So that's why we are withdrawing such interest. Bank to interest on DRR investment. Such interest on DRR investment should be transferred to profit and loss account. It should not be transferred to DRR as per accounting standard 5. Actually, in the earlier accounting treatment, 2 years back, what we made, the interest on DRR investments, we transferred to debenture redemption reserve. So once the consequent amendments occurred in this chapter, so on the basis of assumption that the interest what we are getting on DRR investment, we are not making reinvestment in the outside market. We are simply withdrawing. That is by passing the entry bank to interest on DRR investment, and interest on DRR investment should need to be transferred to profit and loss account. Sir, these are the normal journal entries for these provisions. So here we are following two things now: Companies Act 2013 provisions plus accounting treatment for such provisions. Now for creation of DRR, P&L general reserve to debenture redemption reserve. Then for the purchase of investments in the outside market, DRR investments to bank account. Now at the time of receipt of interest on such investment, bank to interest on DRR investment, it should not be created to debenture redemption reserve as per AS5. It should be created to profit and loss account. Now, what about these rules, sir? Rules, these provisions are applicable to which type of companies? How much percentage of debenture redemption reserve need to create? How much percentage of debenture redemption investment should be made in the outside market? On which value need to be calculated? Such all things we are going to deal under amendment rules. Now, let me check the amendment rules. What are such rules? Share capital and debentures amendment rules 2019. Share capital and debentures amendment rules 2019. Consider it, guys, all of you, which are highly important. So first, I'm going to do with respect to debenture redemption reserve. This is with respect to debenture redemption reserve. So for the purpose of applicability of these provisions, entities are divided into two types. One is financial institutions. Financial institutions. Here, companies other than financial institutions. Financial institutions and companies other than financial institutions. You know the meaning of financial institutions? Financial institutions is any entity, whether it is company, whether it is established through a separate act, maybe it is a firm, anything. It is a bank, it is an insurance company, those are the stock brokers, okay. Maybe industry specific finance procurement organizations, which purely deal with lending as well as lending of the money and deposits of the money. Then such institutions, we can make it term it as financial institutions. So many financial institutions are there. All banks are coming under financial institutions only. All NBFCs are coming under financial institutions only. Certain central government certain entities evolved through the separate act passed by the central government, like NABARD, SIDBI. Okay, all those are classic example for financial institution. LIC, Life Insurance Corporation, okay, is a classic example for financial institution. General insurance company is a classic example for financial institution. All are form part of the financial institution. Financial institution is a common parlance word which is used to represent any entity who is in the process of dealing with money, either in the form of lending activities or either in the form of deposit activities, or for the purpose of development of any particular industry, it may provide loans. So anything may occur. So financial institution is very broader term. Now here, companies other than financial institution. Now in financial institutions, we divide into two parts. One is all India financial institutions, all India financial institutions. Other financial institutions. Other financial institutions. You know what is the meaning of all India financial institutions? Certain financial institutions are termed as a all India financial institutions by RBI. These are the all India financial institution term. The terminology is introduced by RBI. Which financial institution are make it termed as RBI? In the RBI, in the special act, in the specified provisions, they will in the RBI represent certain financial institutions as all India financial institutions. The major objective of all India financial institutions is they will work for the growth of such specified industries. I'll show you here certain all India financial institutions for better understanding. So which is actually form part of Reserve Bank of India official website, index to RBI circulars. Under the recent circular of the RBI, it will discuss about all India financial institutions. Revised list of all India financial institutions. IDBI, Industrial Development Bank of the India. 1 second. Yeah. IDBI, Industrial Development Bank of India, Industrial Financial Corporation of India, IFCI, Exim Bank, Export Import Bank of India. So which is majorly established for the purpose of growth of the imports and export oriented companies. Industrial Reconstruction Bank of India, that is, it will focus on industrial activities. Next, National Bank of Agricultural and Rural Development, NABARD, is especially for the purpose of providing agricultural loans. Small Industries Development Bank of India, SIDB. So for small sector oriented banks, for small sector loans, all are in generally covered under the purview of SIDB. National Housing Bank. So each and every institution who want to conduct their business activities under housing loans need to be registered under NHB in India, actually. Okay. So which is majorly for the purpose of providing loans for houses. Unit Trust of India, which is actually a mutual fund. Life Insurance Corporation of India, LIC. General Insurance Corporation of India, GIC. So like this, so many industries was given. Almost 22 companies are there. So which are recognized by the RBI as all India financial institutions. Okay. For such all India financial institutions who are recognized by the RBI, for which no need to create any debenture redemption reserve, guys. No need to create. No DRR creation. So because which are majorly managed by a government, all all India financial institutions are completely majorly regulated by the government and the RBI. So that's why there is a no scope of non-repayment to the debenture holders. That's why a creation of debenture redemption reserve rules are not applicable. We can say like that. Or in the rules, it is clearly given that for such all India financial institutions, no need to create any DRR. And for other financial institutions also, No need to create any DRR. No DRR creation. Okay, this is very important. Next, coming to companies other than financial institution. Companies other than financial institutions. Companies other than financial institutions. Listed companies, unlisted companies, listed companies, unlisted companies. In case of listed companies, they are divided into not only all India financial institutions plus banks as well. Okay, all the banks. No DRR creation. Okay, all India financial institution and banks, no DRR creation. Coming to listed companies, if the listed company is NBFC and other listed companies. So in this case also, NBFC also no need to create DRR, no DRR creation. For other listed companies also no DRR creation. For unlisted companies are there, right? Unlisted companies, they should need to create debenture redemption reserve to that extent of 10% on outstanding debentures exist. All the unlisted companies create debenture redemption reserve to the extent of 10% on outstanding debentures exist. That means, simply speaking, except for unlisted companies, either it is a listed company, either it is a financial institution related to all India financial institutions or a bank or other financial institution, no need to create DRR. DRR concept is only applicable in case of unlisted companies. In case of unlisted companies, as per the Share Capital and Debentures Amendment Rules 2019. Do you agree with me, all of you? Now let me cross check the same thing with my text, guys. So the real rules are a little bit confusing, but the diagram which I placed in my OneNote is giving much more clarity on the rules. Please let me read the content in my text. Debentures issued by all India financial institutions and banking companies. No DRR is required. All India financial institutions and banking companies, no DRR is required. Other financial institutions, DRR will be as applicable to NBFCs. In NBFCs, is given that no DRR. So that's why I directly given that for other financial institutions also no DRR. It is given that for other financial institutions, DRR we need to create as per NBFCs. But here, in case of listed companies, for all listed NBFC, is given that there is no DRR. So that's why you can simply term it as for other financial institutions, no DRR. Next, for listed companies, all listed NBFC, no DRR. And housing finance companies also no DRR. So simply I mentioned that listed NBFCs, no DRR. Other listed companies also no DRR. Now coming to unlisted companies. In case of unlisted companies, unlisted NBFC, no DRR. Other unlisted companies, DRR shall be 10% of the value of the outstanding debentures issued. So this is unlisted companies other than NBFC. That point is important. Unlisted companies other than NBFC. Because just now we saw for unlisted NBFC also there is no DRR. So unlisted companies other than NBFC, then you need to create DRR to the extent of 10% on outstanding debentures exist. Sir, as on which date I need to create, sir? Actually, so as on the first date of the current year itself, you need to create. I mean to say, for example, we are in the year 2020-21. You know, initially as on 1/4/2020 or 31st March 2020, you know how much outstanding debentures is there now. On such debentures, it is in the form of debenture redemption reserve to the extent of 10% outstanding. Or I mean to say, at the year end, you will know the total outstanding debentures is how much. You know the total outstanding debentures is how much. You need to create to the extent of 10% on such outstanding debentures in the form of debenture redemption reserve. At least as on balance sheet date, that debenture redemption reserve need to be created out of the free reserves on the balance which is appearing on the outstanding debentures. Hope you understand. On balance sheet date, you will check how much outstanding debentures are there. On such outstanding debentures, you should need to create to the extent of the 10% in the form of debenture redemption reserve. Okay. So right. So now if you check here, for all India financial institutions, no DRR. Other financial institutions, no DRR. For listed companies, listed NBFC, no DRR. For other listed companies, no DRR. In case of unlisted company, unlisted NBFC, no DRR. Other unlisted companies only, DRR shall be 10% of the value of the outstanding debentures issued. Note, this is important note, concentrate. What is this note? In case of partly convertible debentures, DRR shall be created in respect of non-convertible portion of debentures only. So in case of partly convertible debentures means convertible debentures are there for me 1 lakh. For example, convertible debentures are there 1 lakh. Out of this 1 lakh, let us assume 60% debentures are going to convert. Convertible debentures 1 lakh number. This is 1 lakh. Out of this 1 lakh debentures, 60% is going to convert in the form of equity shares. Let us assume. Then for which portion I need to check for the purpose of creation of DRR, that is unconvertible portion, that is 40,000 only. On this 40,000 debentures into 100, let us assume, which is 4 lakhs, right? 4 lakhs or 40 lakhs? Okay, 40 lakhs. On this 40 lakhs, I need to create at least to the extent of 10%, at least to the extent of 10% in the form of DRR. So that is the point he is mentioning. Sir, why you are creating the debenture redemption reserve? For the purpose of making repayment to debenture holders at the time of redemption, right? If it is going to convert in the form of equity shares, then there is no question of making repayment to equity shareholders. That's why there is no need to think about repayment to debenture holders occurred through conversion. Am I right? So that's why we may think about only making repayment to non-convertible portion of the debentures only in case partly convertible debentures exist. For example, if all the debentures are going to convert into equity share, there is no need to create any debenture redemption reserve. That is the meaning of this note. So this is very, very important. I'll mention that part as well in my one note. In case of partly convertible debentures, in case of partly convertible debentures, DRR is going to create on unconvertible or non-convertible portion only. Non-convertible portion only. So in case of partly convertible debentures, this provision is applicable only in case of partly convertible debentures. Okay, DRR is going to be created on non-convertible portion only. Right, guys. So now we saw share capital and debenture amendment rules with respect to debenture redemption reserve, right? Now we will see with respect to debenture redemption reserve investment. All listed NBFCs, all listed house finance companies, all other listed companies other than AIFI and banking companies and other financial institutions, and all unlisted companies which are not NBFCs and HFCs. Simply what he is telling except these financial institutions, that is all India financial institutions and other financial institutions, listed NBFC, listed HFC, other listed companies, other than unlisted NBFC as well. He was not covering unlisted NBFCs as well, and other unlisted companies. All listed NBFC, all listed HFC, all other listed companies other than AIFA banking companies and other FIS, and all unlisted companies which are not NBFCs and housing finance companies. Okay, that means he is not covering unlisted NBFC and unlisted HFC as well. In case of debenture redemption reserve investment, they shall on or before the 30th day of April in each year, in respect of debentures issued, deposit or invest, as the case may be, a sum which should not be less than 15% of the amount of its debentures maturing during the year. So if you check here, which is 10% on outstanding debentures exist, which is 15% of the amounts of its outstanding debentures maturing during the year. This percentage is on the total outstanding debentures. This percentage is on only to the extent of the debentures matured during the year, to the extent of the debentures redeemed in the current year, ending on 31st day of the March of that year. Now, let me explain provisions with respect to debenture redemption reserve investment. Concentrate. So these are the provision with respect to debenture redemption reserve investments. Still we are in amendment rules only. Debenture redemption reserve investments. Sir, debenture redemption reserve investments rules are applicable only to the following companies. Applicable only to the following companies. Just a second. Applicable only to the following companies. Applicable to the following entities. What are such entities? Listed NBFC or housing finance companies, other listed companies, other listed companies, these are also applicable to unlisted companies other than NBFC or HFC. Okay. So debenture redemption reserve investment applicable to listed NBFC or HFC or other listed companies, and applicable to unlisted companies other than unlisted NBFC or HFC. But these are not applicable, to all India financial institutions, all India financial institutions and other financial institutions. These are not at all applicable. Am I right? The same thing is given here, right? All listed NBFCs, all listed HFC. I covered in the same thing. All other listed companies, but these are not applicable to all India financial institutions to other financial institutions. And all unlisted companies which are not NBFC and HFC, unlisted companies other than NBFC or HFC. That's it. So debenture redemption reserve investment. What is the provision? What is the provision? Provision here I'm writing. Please concentrate. The provision is to that extent of debentures to the extent of 15% on debentures maturing during the year ended 31st March. To the extent of 15% is on debentures maturing during the year ended 31st March. Need to invest before April. That is the provision. To the extent of 15% is on debentures maturing during the year ended 31st March, need to invest before April. Sir, in which investment need to invest, sir? That is in secured debentures. In secured investment, I need to invest. So in unsecured investment, you should not invest. I mean to say government securities, government bonds, on such things you can need to invest. We already saw the accounting treatment at the time of creation of DRR, P&L, general reserve to DRR. At the time of making investment, DRR investment to bank. At the time of receipt of interest, bank to interest on DRR investment, and interest on DRR investment to P&L. That how much DRR need to create, that is 10% on the outstanding debentures exist. It is only applicable for unlisted companies other than NBFC and HFC. Now for DRR investment, you should need to create out of the debentures matured in the current year to the extent of 15% in the form of DRR investment. You need to invest in the outside market. For which type of entities it is applicable? It is applicable to listed NBFC or HFC or all other listed companies, as well as unlisted companies other than NBFC and HFC. But these are not applicable to all India financial institutions and other financial institutions. Am I right? Sir, DRR, debenture redemption reserve, is not applicable to all the institutions, that is AIFI or other financial institution, as well as creation of DRR is not applicable for listed companies as well. That to unlisted companies other than NBFC or HFC is only applicable. Okay, here listed companies, either NBFC or HFC also you can consider. NBFC and HFC. Okay, other than NBFC and HFC only, you can create the DRR to the extent of 10% on the outstanding debentures exist. Is it clear, guys? All of you, up to debenture, up to share capital and debenture rules 2019. Is it clear? Okay. So just I'll give a summary before closing this lecture. So just I want to end this video lecture. All of you please concentrate. In this chapter, we are going to deal three major situations. One is meaning and types of debentures and Companies Act 2013 provisions and accounting treatment for such provisions. We not at all discussed anything about methods of redemption of debentures till now. Now, debenture is an instrument which acknowledging as a debt by the company and the terms related to repayment of the principal and interest clearly established in such instrument itself, then such particular instrument is known as debenture. So various types of debentures exist: redeemable, irredeemable, irredeemable, secured debentures, unsecured debentures, first mortgage debentures, second mortgage debentures. Am I right? Different classes of debentures exist. Next, with respect to Companies Act 2013, debentures which are having voting rights should not be issued by any company. The maximum redemption period is 10 years in generally. For certain class of companies, it may extend up to 30 years. That is like infrastructure based companies and the companies who permitted by central government or the RBI or the housing finance companies. And as per the provisions of Companies Act 2013 and amended rules of 2019, that is share capital and debenture amended rules 2019, certain companies need to create debenture redemption reserve out of free reserves, as well as make investment in the outside market in the form of DRR investments. Now, what are such rules? As per share capital and debentures amendment rules 2019 with respect to debenture redemption reserve, only unlisted companies other than NBFCs or HFCs are need to create debenture redemption reserve to the extent of 10% of the debentures outstanding. All India financial institutions or other financial institutions, listed companies like NBFC, HFC, and other listed companies, and unlisted NBFC or HFC, no need to create any single rupee in the form of DRR. Now, to that extent of 15% of the debentures, to that extent of 15% of the debentures maturing during the year ended 31st March need to invest before April of that particular period in the form of debenture redemption reserve investment. So the percentage is 15% here. You should apply on debentures maturing during the year. That is very, very important. Here, we need to make investments on debentures maturing the year. About 10% is need to apply on outstanding debentures exist, which is quite completely different. Outstanding debentures means what are the total amount of the debentures exist. Here debentures maturing means out of the outstanding debentures, how much debentures you are going to redeem in the current year. So both are different. That is on the total outstanding debentures 10%. This is on 15% on debentures matured during the year. Both are different. Okay. So 10% you need to calculate on that overall outstanding debentures. 15% need to calculate on debentures matured during the year. Okay. Sir, debenture redemption reserve investment is mandatory for which type of companies? For listed NBFC or HFC or other listed companies. That means for all the listed companies, it is applicable other than AIFI and other financial institution. And unlisted companies other than NBFC or HFC, also these debenture redemption reserve investment rules are applicable. Okay. I'll give an example for the purpose of applicability of these provisions. To get the clarity, please allow me to concentrate. Let us assume I am in the year 2021. I am in the year 2020-21. Sir, opening outstanding debentures. We have 6% debentures. Let us assume. Sir, how much worth, sir? 10 lakh is there. 10 lakh is there. What face value is 10 lakh. Now, out of this outstanding, you need to create debenture redemption reserve, right? But when you should need to check as on balance sheet date, you come to the balance sheet date. Let us assume out of this 10 lakhs, in the current year, we are going to redeem to the extent of 2 lakhs. 2 lakhs going to redeem during the year. Now, as on balance sheet date, how much outstanding worth of debentures are there? 8 lakhs debentures are there. Now, all of you please concentrate. Now, to comply the provisions first, if you are having in the opening outstanding itself is 10 lakhs, in the last year itself, you need to create to the extent of 10% of the outstanding debentures in the form of debenture redemption reserve. How much? In the last year itself, it would be 10 lakhs into 10%, which is equal to 1 lakh. This is the required debenture redemption reserve. But in opening outstanding, let us assume in the opening outstanding debenture redemption reserve is there only for, let us assume 40,000. So opening outstanding debentures given 10 lakh. So the opening outstanding debentures given is 40,000. But as per the rules, how much I required? 1 lakh I required now. That's why I need to create 60,000 in the current year. I need to create from the profit and loss account or from general reserve. From the P&L account or general reserve, I need to transfer to DRR to the extent of 60,000. then it will become 1 lakh. Are you getting my point, all of you? Now you are redeeming these 2 lakhs worth of debentures, right? Now once redeem this 2 lakh worth of debentures, out of this 1 lakh, you need to transfer on this 2 lakh 20,000 amount. 2 lakhs into 10% is 20,000. You need to transfer to general reserve. So remaining 80,000 is balance is there in closing debenture redemption reserve. Sir, why you are transferring 20,000 to general reserve, sir? Once the debentures redeemed, then the outstanding debentures are decreased to 8 lakhs, right? Then the required amount is 8 lakhs into 10% is 80,000. Then the maximum required amount as per the rules is only 80,000. Or sorry, the minimum amount required, the minimum amount required in debenture redemption reserve is only 80,000. Excess 20,000, that is on 2 lakhs worth of debentures, we can make it transfer to general reserve. Why? Earlier you created entire debenture redemption reserve of 1 lakh either from P&L or general reserve only. Now the use is over. Now you are transferring to the general reserve. Sir, what actually happening here, sir? I can't understand literally. Can you please explain, sir? Now all of you please check here. Now I'm explaining the technicality of the provisions. Concentrate. Sir, in opening outstanding, debentures are there at 10 lakhs. In opening outstanding, debentures are there for 10 lakhs. In opening, I am having the all are opening. In the reserves and surplus, in the opening, I have debenture redemption reserve is at only 40,000. So just as an example, I given. Now, but the outstanding debentures worth is 10 lakhs, right? I need to create debenture redemption reserve 10% on this amount. The required amount is 1 lakh. So that's why what I did, P&L account balance is there here. From P&L account, I will reduce transfer to DRR. Amount 60,000 I reduced. Then such 60,000 I added here. Such 60,000 added here, it became 1 lakh. It became 1 lakh. Am I right? Now consider all of you. Now, out of this outstanding debentures, I am going to redeem 2 lakhs, right? I am going to redeem 2 lakhs. Now I am having a bank balance here. I'm having a bank balance. Or we are having a debenture redemption reserve investment. Let us assume DRR investment required now. Sir, DRR investment, how much need to require, sir? Out of the debentures maturing in the current year, to the extent of 15%, you should maintain in the form of DRR investment. Now, out of this 10 lakhs, redeemed 2 lakhs in the current year. That means on such 2 lakhs, I need to create minimum 15% in the form of DRR investments. Sir, maybe more than this is also allowable, but minimum I require 30,000. So remaining, let us assume I have the bank balance. Now, as on the redemption date, what will happen, you know? I will sell this debenture redemption reserve investment. I will sell. Let us assume I got 30,000 only. So I will sell. When I sell, debenture redemption reserve investments gone, bank balance will occur. So bank, how much amount? I got 30,000. Now with such bank balance and the existing bank balance, I will redeem the debentures. Now this bank balance gone. Now out of this bank balance, certain portion is reduced. That is to the extent of 70,000 portion is reduced. Now this debentures also gone. Out of the debentures, how much gone? 2 lakhs gone. It becomes 8 lakhs. So this is 1.7 lakhs total. Total 2 lakhs na required. So 1.7 lakhs existing bank balance decreased and the bank realized through DRR investment entirely gone. Am I right? All of you with me? Now, to the extent of the 2 lakhs worth of debenture gone. Na? Now, out of the debenture redemption reserve of 1 lakh, you can make it transfer to to the extent of 20,000 to general reserve. For example, if general reserve is there, then you can add back transfer from debenture redemption reserve. Now the DRR will becomes 80,000. What is the meaning of this, you know? What is the meaning of this, you know? Sir, earlier you are telling that the debentures outstanding amount is 10 lakhs. For that purpose, to the extent of redemption of 2 lakhs, we have DRR investment in the outside market. We are created a debenture redemption reserve of 1 lakh. Now to that extent of 2 lakhs worth of debentures you are redeeming, right? On such worth of 2 lakhs debentures, no need to create DRR. So the minimum amount required is only 8 lakhs into 10%, which is 80,000. The remaining balance, you can make it transfer to general reserve. General reserve. Why you are transferring to the extent of amount 20,000 to general reserve? If you are putting that balance under debenture redemption reserve, then people may feel that still debentures are not redeemed. But debentures were already redeemed to the extent of 2 lakhs, right? So, sir, either DRR is form part of reserves and surplus, either general reserve is also form part of reserves and surplus actually. So both are reserves and surplus only. But if you put such 20,000 is also under debenture redemption reserve, then people may feel that still you are not redeeming the debentures. That's why the balance of 20,000, you are make it transfer from debenture redemption reserve to general reserve. You can add that amount to general reserve. Are you getting my point, all of you? Okay. So actually these all things, again, I'm going to explain at the time of methods of redemption of debentures. That's why I don't want to take much pain right now, guys. Again, in the next video lecture, we will deal different methods of redemption of debentures where I am clearly explain this issue. But for today's lecture, it is very important to know share capital and debentures amendment rules 2019 with respect to creation of DRR and making of DRR investment. For which type of entities it is applicable, for which percentage, how much percentage it is need to apply, that percentage need to apply on which amount. If you understand that part, that is more than enough. Then how these provisions are working and how the actual methods of redemption are there, I'm going to explain entirely in the next video lecture, guys. Okay, so till that, we saw the text of our material as well. So before watching the next lecture, please all of you revise the content till now what I have discussed. So if you are unable to understand the last part, so the technicality part I explained, right, and under the example, if you are not understand, not an issue, I'll explain once again the same example under methods of redemption of debentures. Until bye, guys, have a nice day. Hello students, we are in the chapter redemption of debentures. We completed 2 parts in overview, right? One part is related to meaning and types of debentures, which is an instrument acknowledging as debt, and all terms related to repayment of principal as well as interest itself is disclosed on the face of the instrument. Such instrument is nothing but debenture. Various types of debentures we've seen: convertible, non-convertible, redeemable, irredeemable, secured debentures, unsecured debentures, first mortgage, second mortgage, right? Then for the purpose of redemption of debentures, or as well as for the purpose of issue of debentures, we've seen certain provisions of Companies Act 2013. That is, the main provisions are debentures cannot issue along with voting rights. Maximum the redemption period to be allowed in generally for 10 years. But in case of infrastructure companies and companies, a special permission should be required either by the central government or by RBI or the housing bank. Am I right? So if any of the companies which get the special permissions from these entities, then they can redeem after 10 years is also possible, but the maximum redemption period in such case is 30 years. Apart from that, we also discussed the need of creation of debenture redemption reserve as well as making of investments as DRR investments as per the share capital and debentures amendments rules 2019. So with respect to debenture redemption reserve, which is only mandatory in case of unlisted companies other than NBFC and housing finance companies, we need to create debenture redemption reserve to the extent of 10% on our outstanding debentures exist. In case of financial institution, that is for both all India financial institutions, banks and other financial institutions, no need to create any DRR. As well as in case of listed companies, whether it is NBFC, HFC or other listed companies, no need to create DRR. Coming to unlisted companies, for NBFC and housing finance companies, if those are unlisted, no need to create DRR. So for all the remaining unlisted companies, you need to create debenture redemption reserve to the extent of 10% on outstanding balance. Am I right? Coming to debenture redemption reserve investments, it is not applicable to all India financial institutions and other financial institutions. Simply, it is not applicable in case of financial institutions, but it is applicable for listed NBFC or HFC or other listed companies and unlisted companies other than NBFC and HFC. These are applicable. So how much percentage of investment to be made in the outside market? To the extent of 15% on debentures maturing during the year ended 31st March need to invest before April. We saw an example as well in the last class. That is where the opening outstanding debentures are 10 lakhs as on balance sheet date, which are going to be 8 lakhs. I mean to say in between 2 lakhs worth of debentures are going for redemption. So now the debenture redemption reserve required is 10 lakhs into 10%, 1 lakh, but it is there in the opening outstanding 40,000. In the current year, you need to create the debenture redemption reserve to the extent of 60,000, then it will become 1 lakh. Am I right? So once the debentures are redeemed, the debenture redemption reserve related to the redemption of debentures should be need to transfer to the general reserve. So that's why at that point of time, the balance under debenture redemption reserve to the extent of the debentures redeemed need to transfer to general reserve. How the impact is there under balance sheet also I showed clearly in the last video lecture. Am I right? Now one more thing, the important accounting intricacies as well we discussed. At the time of creation of DRR, the general entry is profit and loss account data, general reserve account data to debenture redemption reserve. At the time of making investment, DRR investments to bank. At the time of receipt of interest, bank to interest on DRR investment, interest on DRR investments to profit and loss account. But interest on DRR investment should not be transferred to debenture redemption reserve as per accounting standard 5 on the assumption that the interest we are not making reinvestment, the interest we are just simply withdrawing. Okay. Next. So let me check the same journal entries through my text as well. In the last lecture, I thought of we not read such journal entries through my text. Now in this lecture, first let us finish the text of our let us finish the journal entries in my text. Then we'll go for the last part which we left actually in the first lecture, which is methods of redemption. Okay, coming to the journal entries, guys. Accounting treatment for a debenture redemption fund, that is in case of sinking fund. The another name is sinking fund. Another name for a debenture redemption fund is sinking fund. After allotment of debentures, once you allotted the debentures, after that, for setting aside the fixed amount of profit for redemption, journal entry is profit and loss account data to debenture redemption reserve account. Am I right? Out of the free reserves, you can create 10% of the debentures outstanding as debenture redemption reserve. For investing the amount set aside for redemption, to the extent of minimum to the extent of 15% of the debentures maturing in the current year need to make invest before April of that particular accounting year in the form of secured government security in the secured government investments, that is debenture redemption reserve investment account data to bank account. For receipt of interest on debenture redemption reserve investments, bank account data to interest on debenture redemption reserve investment, such interest need to be credited to the profit and loss account. Interest on debenture redemption reserve investment account data to profit and loss account. Considering the fact that the interest is received each year through cash or bank and it is not reinvested, I told you clearly. Hence, interest on DRR investment Hence, interest on DRR investment is not credited to debenture redemption reserve account. I mean to say, in generally, the past accounting treatment, whenever you are getting interest on such investment, again, you are making transfer such amount to the DRR actually. Here, you are getting interest, right? As per the previous accounting treatment, this interest, we are making credit to again the debenture redemption reserve only. But that accounting treatment was completely abolished after introduction of the new amendments, after introduction of new amendments as per the provisions of Companies Act 2013. Okay, so hence interest on DRR investment is not credited to DRR account but taken to the profit and loss account in accordance with accounting standard 5 provisions. Now at the time of redemption of debentures, guys, so we are not dealing such entries actually. Now all of you, let me write the journal entries at the time of redemption of debentures. Concentrate. Journal entries at the time of redemption of debentures. At the time of redemption. So we already seen those journal entries related to creation of DRR and creation of DRR investment and related to interest on such investments. Up to such part only I explained. Now I am going to explain journal entries at the time of redemption of debentures, guys. All of you please concentrate. At the time of redemption of debentures, first, the redemption may be possible at par or at premium. First, you need to check. First, you need to check that such redemption is going to occur. Such redemption is going to occur at par or at premium. That is important thing. First, you want to check. You need to check. Sorry, that is redemption at par. Redemption with premium. Redemption at par or redemption with a premium. For example, if the redemption is at par, par means redemption happened at face value, then the following entry you need to pass. What is that entry, guys? Debentures account debtor. Debentures is a liability, right? Now you should cancel debentures account debtor at the rate of face value to debenture holders account. To debenture holders account. Now you are having enough bank balance through sale of investment as well as existing bank balance. You can make repayment to the debenture holders. That is debenture holders account debtor. Debenture holders account debtor to bank account. For example, if it is with premium, for example, we are redeeming the debentures, with the premium. Then what is the accounting treatment we need to adopt? Now, debentures, you again with face value, again you need to cancel, that is debentures account debtor at the rate of face value. Now you are making redemption with premium, right? How you are redeeming the preference shares with premium? In the same way, you should need to make debit premium on redemption of debentures. Premium on redemption of debentures account debtor at the rate of premium to debenture holders account. To debenture holders account. Then debenture holders account debtor. Debenture holders account debtor to bank account. So entry debenture holders account debtor to bank account. Now the question is, premium on redemption of debentures account is there now? if you remember the content of redemption of preference shares, premium on redemption of preference shares, you can only set off with free reserves. I mean to say profit and loss account. The reason is we assumed that all the companies which are covered under section 133 of the Companies Act 2013, we cannot utilize securities premium to set off the premium on redemption of preference shares or premium on redemption of debentures if the company is covered under section 133. Do you remember the content, guys? I'll explain this one more time. Okay, some gap is there actually in between redemption of preference shares chapter, redemption of debentures chapter. What we read in redemption of preference shares, the same content I'm going to explain. Section 52 of Companies Act 2013 is related to securities premium, uses of securities premium, uses of securities premium. You can utilize securities premium for the purpose of fully issued bonus shares, fully issued, that is fully paid up bonus shares. We saw that in bonus shares chapter, actually bonus and right shares chapter. We can utilize securities premium for the purpose of what is that? To write off premium on redemption of preference shares or debentures. We can utilize securities premium to write off underwriting commission, share issue expenses, discount on issue of securities, discount on issue of securities. Okay, you can utilize securities premium for the purpose of buyback of equity shares, buyback of equity shares. One more is there, actually one more utilization is there for section 52. What it is? So one more is to set off preliminary expenses. One more other utilization is to set off preliminary expenses. Preliminary expenses. So the provision we already discussed in redemption of preference shares, the same provision here I am dealing. So these are the general utilizations of securities premium as per section 52, guys. But out of which, if the company which covers under section 133 of Companies Act 2013, in generally all the companies covered section 133 except banking companies and insurance companies. Okay, so for those companies who covered under Companies Act 130, section 133 of Companies Act, such companies should not be utilized securities premium for set off premium on redemption of preference shares or debentures as well as preliminary expenses. So those companies under section 133 of Companies Act 2013 who are covered, such companies securities premium is not utilized to set off premium on redemption of preference shares or debentures and preliminary expenses. We can assume that all the companies, coming to academics, all the companies are covered under section 133. Based on such fact, we may not utilize securities premium to set off premium on redemption of debentures. That's why the premium on redemption of debentures need to set off only with profit and loss account. To tell that conclusion, I made this much of discussion. So premium on redemption of debentures need to set off with profit and loss account only, with P&L. We cannot utilize securities premium. We cannot utilize securities premium for this set off of premium on redemption of debentures. Then what is the journal entry, guys, at the type of set off? We can pass, that is premium, I mean to say, sorry, profit and loss account data to premium on redemption of debentures. Premium on redemption of debentures. Okay. Sir, once the debentures redeemed, you paid the amount to the debenture holders. Once the debentures redeemed, to that extent of debentures redeemed, should be transferred from debenture redemption reserve to general reserve. Am I right? So in the example also I mentioned the same thing, right? So finally we redeemed to the extent of 20,000 worth of debentures. That's why out of the debenture redemption reserve, we are adding to the general reserve to the extent of the debentures to be redeemed. So for that, the journal entry is this is the journal entry is for transfer of balance from debenture redemption reserve to general reserve. How much? To that extent of DRR, to that extent of DRR, sorry, to the extent of debentures, to the extent of the debentures redeemed in current year. So to the extent of the debentures redeemed in the current year, that portion debenture redemption reserve, you need to make it transfer to general reserve. Okay. Now the entry is debenture redemption reserve account data, debenture redemption reserve account data to general reserve. Okay, guys. So now I revealed all the journal entries. So once again, let me quickly check all the journal entries with my text. So first, we saw the journal entries that related to share capital and debenture amendment rules 2019. Based on that, what is the accounting treatment after allotment of the debentures to the extent of the debentures outstanding? 10% need to create in the form of debenture redemption reserve. The entry profit and loss account data to debenture redemption reserve. Then for investment, to the extent of the 15% of the debentures to be redeemed in the current year, you need to make in the form of investment before April of that particular year itself. That is debenture redemption investment to bank account. Then at the time of receipt of interest on such debenture redemption reserve investment, bank to interest to P&L. Am I right? Now at the time of redemption of debentures, for encashment of debenture redemption reserve investment, you sold the debenture redemption reserve investment account first. Bank account data to debenture redemption reserve investments. Sir, if you derived any profit or loss, such profit or loss need to be transferred to P&L account. If you derived any profit or loss on sale of debenture redemption reserve investments, then you can make a transfer to P&L. Now at the time of making payment to debenture holders, if debentures are redeemed at par, then the entry is debenture to debenture holders to bank. Then after redemption of debentures, DRR should be transferred to general reserve to the extent of the amount of debentures redeemed. That is debenture redemption reserve to general reserve. Notes: debentures sometimes are redeemed at a premium. In such case, premium on redemption of debentures will have to be set off with profit and loss account. If if debentures are redeemed with premium, then in this entry, debentures accounted are premium on redemption of debentures to debenture holders will come. Then such premium you need to make it set off, that is premium to debenture holders. Then such premium you should need to make to set off with profit and loss account only. You cannot utilize the securities premium on the assumption that the company is covered under section 133. That is profit and loss account that are to premium on redemption of debentures. Okay. Hope you understand. The same content or the same journal entries we already discussed through my OneNote. Now, all of you come to methods of redemption of debentures. Methods, different methods of redemption of debentures. Debentures may be redeemed by payment in lump sum method. Payment in lump sum method means as on the date of maturity. For example, debentures are redeemed at the end of the 5th year. At the end of the 5th year, we may pay the entire amount. Or you may not wait up to the date of maturity. In between, you can pay the total amount. In between, you can also pay the total amount. That is nothing but that is depending upon the terms and conditions agreed in between debenture holders and company. Lump sum method means entire money is paying at a single point of time. By annual drawings. Annual drawings means company is redeeming the same portion over the period of the debentures. Company is redeeming the same portion over the period of the debentures, then which is termed as a annual drawings. By conversion to shares. Sir, debentures redemption is also possible through converting into equity shares. What is the meaning of redemption? Redemption means simply cancellation of debentures. You may pay in the form of cash or you may give consideration in the form of shares. That is through conversion of shares also redemption is possible. By purchase of own debentures in open market. What about this, sir? By purchase of own debentures in open market. What it is? Your debentures, let us assume, quoted in the outside market in stock exchange. It has certain market value. Let us assume the face value of 100 rupees debenture is quoted at 105 rupees in the outside market. Now your company will directly purchase such debentures in the outside market, maybe at the rate of 106 rupees. Directly, it will go to the direct debenture holders who hold such as investments. They will directly buy such debentures from such investors, which are termed as own debentures, Once you purchase such own debentures, which are treated as investments. For example, if you are purchasing debentures of another company, which are known as investments only, right? Under fixed income bearing securities, guys, investment in debentures. Right now, you are purchasing your company debentures itself. For which purpose? For a cancellation purpose. Now, the own debentures of your company purchased by yourself is technically known as investments. Now, after purchasing these own debentures, you may cancel these own debentures with own debentures in the balance sheet. It is under asset side, which is an asset investment. Now, under liability side, you are having debentures liability, right? Now you can cancel this own debentures with debentures. The difference amount you can transfer to the profit or loss, which is profit or loss on cancellation of debentures. I will explain in detail. So just as a basic intro, just I'm telling what are the different methods exist. One is lump sum method, annual drawings method, conversion to shares method, purchase of own debentures in the open market. Am I right? But whenever you are doing these things, whenever redemption takes place, you should comply the provisions, that is amendment rules of 2019. If your company is covered, and the specific provisions are applicable, then you should need to comply. Are you getting my point, all of you? Next, under first method, by payment in lump sum, what is the treatment you should need to done? Under payment in lump sum method, at a maturity or at the expiry of a specified period of debenture, the payment of entire debentures is made in one lot or even before the expiry of the specified period also you may pay. Simply payment in lump sum means in a single shot you are paying the entire liability, you are discharging entire liability of debentures. You are discharging entire liability of debentures at a single point of time. By payment in installments means under payment in installment method, the payment of specified portion of debenture, specified portion, I mean to say equal portion of debenture is made in installments at specified intervals, which is nothing but payment in case of installments. Next he is given, actually here it is given conversion of share C. So actually next we are discussing purchase of own debentures in the open market. Please all of you concentrate. Purchase of debentures in open market, all of you. Let me put here in my OneNote methods of debentures. Then I'll explain each and everything through my OneNote. Then again we'll back to text. Methods of redemption of debentures. So debentures may be redeemed by paying lump sum. So at the time of making payment as a lump sum, you know the journal entries, that is as usual entries we already seen. Debentures account debtor, debentures account debtor at the rate of total face value. If the redemption takes place at premium, then the premium also you should need to record, that is premium on redemption of debentures account debtor to debenture holders account, to debenture holders account, then debenture holders to bank, then debenture holders to bank. You need to check the remaining all things, that is for creation of debenture redemption reserve and for sale of DRR investment, if at all applicable, such common entries also need to write. Now, if the redemption is at lots or at different time periods, if the redemption in annual drawings or annual lots, you can call it as either annual drawings or in lots. Then you are doing redemption of specified, you are doing redemption specified portion of outstanding debentures every year. Now, at the time of redemption, there are no change. The entries are same. So at the time of redemption, same entries continue. Am I right? Now coming to redemption through purchase of own debentures. Redemption through purchase and cancel. Purchase and cancel with own debentures. So let us discuss about this. We'll spend much more time. And one more thing is there. What is that? The last that is conversion into shares. So first, let me discuss purchase and cancel with own debentures. First, let me explain the concept of own debentures here, guys. What is the meaning of own debentures? What is the meaning of own debentures? Purchasing debentures in the open market. Related to same company. Purchasing debentures in open market related to same company is known as own debentures. Once the company purchased the own debentures, we can treat it as an investments. Once company purchased own debentures, we treat it as fixed income bearing security. Am I right? Debentures are fixed income bearing securities, na? Fixed income bearing investments. So once company purchased their own debentures, we treat it as fixed income bearing investments. Now all of you please concentrate here. So once the fixed income bearing investments coming to the picture, you should apply the accounting treatment related to the investment. Can you please tell me, all of you, at the time of purchase of fixed income bearing securities, what is the accounting treatment? At the time of purchase of fixed income bearing investments, can you please tell me, guys, what is the treatment? First, we should ask the quotation price is ex interest quotation price or cum interest quotation price. Am I right or wrong, guys? We will ask the quotation price is ex interest quotation price or cum interest quotation price. Whatever the case may be, whether it is ex interest quotation price or cum interest quotation price, we will record like this. That is investments account data, own debentures account data, which is nothing but investments only. Interest from last date of payment to up to date of purchase, we will record interest account data to bank account. If they are given quotation price is X interest quotation price, that means we are purchasing our own debentures. If the other party is given the quotation price is inclusive of interest, then quotation price itself is the own debentures cost. Interest need to calculate from last date of payment to purchase. Then bank balance is the balancing figure, which is quotation price plus interest. We know all such things, right? We saw under investment accounts. That is the reason why I am taking this chapter after completion of investments. But if the given quotation price is the cum interest quotation price, let us assume the given quotation price is the cum interest quotation price, the other party coding inclusive of interest, then first you should need to calculate the interest, that is same as like last date of payment to up to date of purchase. First you should need to calculate the interest. Then here cost of the debentures is quotation price minus interest, which is nothing but actually you will get it as a balancing figure. Bank balance itself is the quotation price. So cum interest quotation price only you need to pay. In such quotation price, both interest is there as well as cost of investments is also there. Am I right? Are you with me, all of you? Sir, once you purchase the debentures, sorry, once you purchase the investments, that is fixed income bearing investment, once you purchase the own debentures, what you should need to do, you should cancel immediately. Cancel, purchase and cancel, purchase and cancel. I'll write like this, just a moment. Purchase own debentures and cancel immediately. Okay, now it's better. Now concentrate, come below. Sir, once you purchase the debenture, you should need to cancel immediately, right? Let us assume 1000 debentures exist. All of you, please concentrate. 1000 debentures exist. Face value is 100 rupees. Sir, debenture interest due dates, 30th June and 31st December. These are the interest due dates on such debentures. Okay, next. We are purchasing the investment. Let us assume purchase of own debentures 400 at the rate of let us assume 98 rupees per debenture. X interest quotation price. The quotation price is X interest quotation price. Now all of you please concentrate. What is the journal entry first I should need to pass? If this is the case, if this is the example, first what is the journal entry I need to pass at the time of purchase? Own debentures account data. Recording the answer, concentrate. First at the time of purchase, what is the journal entry? The journal entry is first investment account data, that is own debentures account data. I am purchasing 400 debentures, right? So 400 into 98, 39,200, which is X interest quotation price. Interest is not included in the quotation price. Interest account data. Now you may ask, as on which date you are purchasing these investments, sir? Let us assume we are purchasing these investments as on 1st April. 1st April we are purchasing. Now interest from last date of payment to up to date of purchase. Last date of payment is 31st December. Up to date of purchase 3 months is there. Now you need to calculate the interest, that is 400 into 100 into how much percentage of debentures, that is also relevant, right? Let us assume the debentures are 1000, 8% debentures. So now 400 into 100 into 8% into 3 by 12. From the last date of payment is 31st December up to the date of purchase, that is 1st April. So total 3 months exist, that is 400 into 100 into 8% into 3 divided by 12. I got 800. So own debentures account data, interest account data to bank account. To bank account, which is 40,000. This is at the time of purchase. Now at the time of cancellation, guys. Now at the time of cancellation. Now if you check all of you, what is the status in the balance sheet? You know, the status of balance sheet is, if you check here, just if you can assume this is a balance sheet. Debentures, 8% debentures is there under liability side. 8% debentures is there under liability side. That is 1000 into 100 is 1 lakh, which is related to 1000 debentures. Now, as an investments, you have own debentures, which are related to 400 debentures, 39,200. Now you should cancel asset with liability. Now you should cancel asset with liability, that is own debentures. need to cancel with the liability, that is 8% debentures account debtor related to 400 debentures, which is 40,000 to own debentures account. Sir, liability should be debited, investment should be credited to own debentures account. Why investment need to be created? Investment is an asset, it have a debit balance. To cancel it should need to be created. Own debentures balance how much? 39,200. Now if you check whether it is profit or loss, now your 39,200 asset gone, 40,000 liability also gone, more liability gone, less asset gone. That's which is a profit situation, which you can term it as to profit on cancellation. Transfer to P&L account only. To profit on cancellation 800. This is also one type of the redemption, that is redemption through cancellation. Redemption through cancellation. Now in the examination, if they're asking to prepare ledgers, how you need to prepare own debentures account? Own debentures account is investment account. You need to prepare investment account in the chapter as we learned in the investment accounts, that how you maintain the fixed income bearing securities, date, particulars, face value, interest, cost or capital column. In the same way, you need to present the own debentures account if at all asked in the examination. Like this, you need to cancel, and the profit or loss you are getting, it can be transferred to the P&L account, that is profit on cancellation account or loss on cancellation account. Do you understand, guys, all of you? This is the concept of redemption of debentures through purchase of own debentures and cancellation immediately. Okay. Now the last one, coming to conversion of shares. All of you, redemption through conversion of shares. Please come here. Redemption through conversion of shares. I'll explain this concept also from a small example. Please concentrate. I'll give a small example. Sir, number of debentures. Let us assume 1000. Face value is 100. Face value is 100. Now, as per the terms, redemption occurred with premium. As per the terms, redemption takes place with premium at the rate of 10%. At the rate of 10% premium. That is a condition. Now one more thing, debenture holders have option to convert. Debenture holders have an option to convert 20% of their holdings. 20% of their holdings into equity shares. Into equity shares. Each equity share issued at the rate of 20 rupees each, having face value of rupees 10 each. Are you following, guys, all of you? So number of debentures 1000, face value 100, redemption with premium at the rate of 10%. Debenture holders have an option to convert 20% of their holdings into equity shares. Each equity share issued at the rate of 20 rupees, having face value of rupees 10 each. Now, if you check here, we are having total 1000 debentures, right? Now, out of this 1000 debentures, shareholders have an option to convert only 20% of their holding. 20% of their holding can only convert into equity shares, means out of these 1000 debentures, conversion option eligible or eligible parties are only 20%, means 200 debentures. But for the remaining persons, redemption occurred. Redemption through payment of cash. Redemption through payment of cash. Am I right? That is remaining how many debentures? 800 debentures. Now all of you, for these 200 debentures, how much amount actually need to pay? That is with premium 10% means I need to pay 200 into 100 into 110%, which is equal to I require 22,000 worth of shares. Now, therefore, number of shares to be issued, all of you, therefore, number of shares to be issued is equal to 22,000 divided by each and every share issued at how much rupees? 20 rupees. Face value is 10, but we are issuing at 20 divided by 20. Now, how many number of shares, guys? We need to issue 11,000 shares. 11,000 shares we need to issue. Next, coming here, all of you, redemption through payment of cash. Here, the required amount is 800 debentures into 100 into 110%. So, which is equal to 88,000. This 88,000 to be paid in the form of cash. Now, what are the journal entries need to be passed here? Now, we are converting, right? Here, first conversion is happening. Now, the entry is the debentures. Let us assume the debentures are 8% debentures. The debentures are 8% debentures. Now, the journal entry 8% debentures account data. 8% debentures account data. For conversion, we are going to convert 200 debentures, right? 200 into 100, which is 20,000. Remaining is premium. You are paying 10% excess, right? Premium on redemption of debentures account data. So premium is 20,000 into 10%, which is 2,000. To debenture holders account. To debenture holders accounts, which is 22,000. Now, for such debenture holders, you need to issue equity shares. Debenture holders account that are 22,000 to how many number of shares you issued? 11,000 shares. Each share is at the rate of 20 rupees each. Face value is 10 rupees each. Am I right? That points you need to remember. Now, two equity share capital. Two equity share capital, that is face value 11,000 into 10 rupees. Always with face value only you need to credit the share capital, which is 1,10,000. Oh, sorry, 11,000 into 10. Sorry, how many number of shares? So 22,000 divided by 20. How many number? Yeah, number wrongly entered. Sorry, 1100, not 11,000. Okay, just a minute. So which are 1100? 1100 shares. Okay. Now 1100 into 10. You can multiply 1100 into 10, which is equal to 11,000. Two securities premium. The excess of price over the face value can make it credited to securities premium, which is 11,000. Like this, you need to pass the journal entries at the time of conversion into shares. This is for conversion, right? For payment of cash, as usual entries. For payment of cash, 8% debentures account debtor. That is 800 debentures into 100, which is 80,000. Premium on redemption of debentures. Premium on redemption of debentures. Premium on redemption of debentures. How much? 80,000 into 10%, which is 8,000, to debenture holders account, which is 88,000. Then debenture holders to cash or bank. Debenture holders account that are to bank account or cash account. Okay. So one thing is sure, whatever the premium is there, the premium here, you can make it set off with profit and loss account at the end. Okay. That is the entry for both the premiums. So I'm talking profit and loss account data to premium on redemption of debentures. So the total premium here it is 2,000, here it is 8,000. So total premium is 10,000. You need to make it debit with profit and loss account. One more thing, guys. Now, at the time of apply of provisions in this case, which provisions? That share capital and debentures rules 2019 for creation of debenture redemption reserve as well as debenture redemption reserve investments. You need to apply only for non-convertible portion only. That means if at all creation of debenture redemption is reserve is there, we need to check 80% portion for 8,000 debentures only. You need to apply share capital and debenture rules. We already read such points, right? Here also I highlighted that. Where it is in the last lecture we highlighted. Yeah. In case of partly convertible debentures, debenture redemption reserve need to be created on non-convertible portion only. So now, in case of conversion of shares, so the total number of debentures are not going to convert into equity shares. Only part of the shares are going to convert. That's why that is non-convertible portion is nothing but 800 debentures. So DRR, if at all provisions applicable for such company, that is debenture redemption reserve and debenture redemption reserve investments is applicable only for unportion, sorry, only for non-convertible portion of debentures. Okay, so the same fact again I proved through this illustration. So now hope you understand how in generally debentures redemption is happen either in case of lump sum or in case of annual drawings or purchase of own debentures and then cancel immediately and a conversion into shares. So much more things I will explain through problems, guys. Now let us check the text first. Then I will entering into problems. So purchase of debentures in the open market. Debentures sometimes are purchased in the open market. In such a case, own debentures account is debited and bank account is credited. Suppose a company has issued 8% debentures for rupees 10 lakhs, interest being payable on 31st March and 30th September every year. The company purchases rupees 50,000 worth of debentures at 96 rupees on 1st August 2011. This means that the company will have to pay 48,000. That is 50,000 into 96, which is 48,000 as principal plus interest from the last date of payment to up to date of purchase, which is 50,000 into 8% into 30th September. Now we are purchased as on 1st August. Sorry, from 31st March to 1st August. How many number of months? April, May, June, July. 4 months, 4 by 12, which is equal to 1333. So the illustration we already done, guys. So unnecessary waste of time. So how the entry should be need to be passed? Investment accounted are, that is own debentures accounted are, interest account from the last date of payment to up to date of purchase to bank. Am I right? We already done. We already seen one illustration in my OneNote. That's why I don't want to explain the example here. So we already check that. Yeah, I gave one example, right? Own debentures interest to bank account. Next, it should be noted that even though 50,000 debentures have been purchased for 48,000, there is no profit. At the time of acquisition of investment, you should not recognize any profit. When you should recognize profit or loss? At the time of cancellation. On purchase of the debentures, profit does not arise, only on sale. And this is the case on cancellation of debentures, profit could arise. Sir, at the time of acquisition of investment, nobody will recognize any profit. At the time of sale means here, at the time of cancel such investments with existing debentures as liability, you may recognize profit or loss. So at the time of cancellation, the journal entry is liability accounted are to asset account. If profit, if you derive, you can credit to profit on cancellation of debentures under P&L. If loss arise, then you may debit the P&L. That's it. Next, redemption through conversion of shares. Under section 71(1) of the Companies Act 2013, a company may issue debentures with an option to convert such debentures. We already seen under the types of debentures: convertible debentures, non-convertible debentures, possible. So debentures with the option to convert such debentures into shares, either wholly or partly. We may convert wholly into shares, or part of the debentures may only convert into the shares at the time of redemption, provided that issue of debentures with an option to convert such debentures into shares, wholly or partly, should be approved by a special resolution passed at a duly convened general meeting. Because this issue may impact the existing shareholders, that's why the existing shareholders should need to pass a special resolution. Out of the shareholders, minimum 3/4 of the shareholders should accept for such conversion. Now the journal entry is debentures to debenture holders to equity share capital securities premium. If the redemption is at par, if the redemption is at premium, debentures accounted are premium on redemption of debentures to debenture holders, then debenture holders to equity share capital to securities premium. The same entries we passed through our illustration as well. Am I right? Next. That's it, guys. So then we can discuss problems. Now all of you, I'll create a mind map, guys, before going to the problem. So certain parts we discussed in lecture 1, certain parts we discussed in lecture 2. So let me give a quick mind map. All of you please concentrate here. Nothing is great. It's a very simple chapter. Mind map. So what we discussed, guys, here. First, we started the chapter with meaning of debentures. You know, debenture is an instrument. Debenture is an instrument. In such instrument itself, we have certain terms related to repayment of principal and interest. Then we discussed about different types of debentures. So in such different types of debentures, secured, unsecured, convertible, non-convertible, redeemable, irredeemable. But in India, irredeemable preference shares are not possible as per existing Companies Act 2013 provisions. First mortgage, second mortgage. So all such different types of debentures we seen. After that, we discussed about the provisions of Companies Act 2013. Provisions of Companies Act 2013. In such provisions, what we discussed, the first and foremost issue is debentures cannot issued. Debentures cannot issued with voting rights. Cannot issue with voting rights. We seen. One more thing we discussed, the maximum redemption period. Maximum redemption period is either 10 years or 30 years depending upon the class of companies. So 30 years is for infrastructure majorly. Infrastructure are permitted by central government or RBI or National Housing Bank. Okay. Then we discussed one more issue, that is actually share capital and debenture amendment rules. Amendment rules 2019 with respect to debenture redemption reserve and debenture redemption reserve investments. Am I right? Now all of you, please check here. Sir, with respect to debenture redemption reserve, with respect to debenture redemption reserve, what we seen? With respect to debenture redemption reserve, creation of DRR is applicable only in case of unlisted companies. Unlisted companies. In simple way, it is applicable to only unlisted companies other than unlisted NBFC and National Housing Bank. So it is not applicable to all India financial institutions and other financial institutions and listed companies and listed NBFC and listed NHB. Am I right? Next. Next. This is continuation only. Please concentrate. So then what we discussed, guys, after this? So if it is related to debenture redemption investment, if it is related to debenture redemption investment, DRR investments, it is applicable to listed companies it is applicable to unlisted companies also, but for NBFC, NHB, not applicable. Okay, right? How much debenture redemption reserve you should need to create? I should need to create, tell me guys, all of you, I should need to create 10% of debentures outstanding. How much amount of debenture redemption reserve invested in the outside market? 15% of debentures redeemed, or 15% of debentures matured during the year. Okay, need to create DRR investments. Next, Next, we discussed concepts related to methods of redemption. Methods of redemption. Under methods of redemption, we've seen different methods. In one method, we check that is lump sum. In another method, we discussed that is in lots. In another method, that is purchase of own debentures. In another method, we discussed it through conversion. Conversion. Am I right? Then, if it is at lump sum or lots, the entry is very simple. Debentures. All right, just a second. The entry in both the cases, the entry is very simple, which is debentures account debtor, premium exist, premium on debentures account debtor to debenture holders, then debenture holders to bank. But it is in case of own debentures, first you need to purchase such own debentures. The journal entry, own debentures account debtor, interest from the last date of payment to up to date of purchase to bank account. Then at the time of cancellation, debentures account debtor to own debentures account, profit to profit on cancellation. If loss is there, you can write loss on cancellation. Only one is appear. Only one thing is appear. Am I right? Next, coming to conversion. In case of conversion, how you should need to do, that is debentures account debtor. If it is with premium, premium also you can add to debenture holders, then debenture holders account debtor to equity or preference, whatever you are issuing, share capital to securities premium. Am I right? So these things we learned. One more important point, guys. Always you should always the premium on redemption of debentures, the premium on redemption of debentures should be make it set off with profit and loss account. Should not utilize securities premium. Securities premium you should not utilize. Tell me, guys, all of you with me? Okay. These many things actually we learned. So somewhere the treatment also we learned. I don't want to post all those things. That's it, guys. This is the mind map related to the entire chapter. So with this background, first let me open directly problem number 1. So in this lecture, at least we can try to do one problem, guys. Problems for discussion. Concentrate, all of you. Problem number 1. The following balances appeared in the books of a company which is an unlisted company other than AIFI, banking company, NBFC and HFC. For such unlisted companies, amendment provisions of 2019, share capital and debenture amendment provisions of 2019 are applicable. Creation of DRR is mandatory, as well as making investment in DRR investments form is also mandatory, which are unlisted enterprises. Am I right? As they are given, the balances just they are given as on December 31st, 2011, 6% mortgage 10,000 debentures of rupees 100 each. That is 6% mortgage debentures, 10,000 debentures of 100 each means, I think so, which is 10 lakhs, right? Which is 10 lakhs worth of debentures is there. Debenture redemption reserve for redemption of debentures, rupees 50,000. Okay. Investments in deposits with scheduled bank free from any charge or lien, rupees 1,50,000 at an interest 4% per annum receivable on 31st December every year. Bank balance with the company is 9 lakhs. The interest on debentures had been paid up to December 31st, 2011. He's telling that we are having liability, right? On such liability, we already paid the debentures up to December 31st, 2011. On February 28, 2012, the investments were realized at par. We sold the investments and the debentures were paid off at 101 rupees together with accrued interest. So we sold the investments at par and debentures redeemed at 101 rupees together with accrued interest. Okay. Together with accrued interest means as a full and final payment, we are giving 101 rupees. Just a minute. So debentures were paid off 101 together with accrued interest. Write up the concerned ledger accounts, excluding the bank transactions, ignore the taxation. They are telling that you need to record concerned ledger accounts. You need to maintain concerned ledger accounts. Concerned ledger accounts means 6% debentures is one account. Debenture redemption reserve is another account. Debenture redemption reserve investment account is another account. Bank account is another account. Am I right? So first let me open all the tick marks account. First, problem number 1. Problem number 1. So let me open all the relevant accounts. First and foremost account is 6% mortgage debentures account, which is 6% mortgage debentures account. What is the next account? Debenture redemption reserve account. Debenture redemption reserve account. Don't give that much of space. Only a few entries will come. Investment in debenture redemption reserve. I mean to say debenture redemption reserve investments account. DRR investment account. Next, bank account is also there. So which is bank account. So these are the relevant accounts, right? Now you can start drafting the ledgers, guys. Okay. So please all of you make start doing from your end, all of you, the formats. So my format is almost ready. Right. Over, guys. Please all of you concentrate, all of you here. If you want, you can give the sidelines as well, not an issue. Yeah, right, guys. All of you, please concentrate. All the accounts are ready from my end. Now we can start with one by one transaction. So I'm not writing particulars and amounts at each and every space. You can ignore that. But in the examination, you need to write particulars amount, debit side, credit side. Now let us start with the opening balance. Actually, the problem is start at 1/1/2011. If you observe, they are giving the closing balance related to 2011 means which are opening balances related to 2012. So that's why opening balance as on 1/1/2011, 6% mortgage debentures is a liability. 1/1/2012 by balance brought down, which is as on 1/1/2012 by balance brought down. How much? 10,000 debentures into 100 means, which is 10 lakhs, which is equal to 10 lakhs. Next, debenture redemption reserve is at 50,000. So as on the same date, 1/1/2012, 1/1/2012, debenture redemption reserve by balance brought down, 50,000 exist. Next, investments in deposits, which are DRR investment, we are having at 1,50,000. So DRR investment as on 1/1/2012, two balance brought down, which is at 1,50,000. And bank balance is also there as on the same date, which is as on 1/1/2012. Bank balance, two balance brought down, is given at 9 lakhs. Now, it is clearly given that the interest on debentures had been paid up to December 31st, 2011. No need to pay interest on debentures. We already paid up to December 31st, 2011. No worries. On February 28, 2012, the investments were realized at par. First, you are selling your investments. If you are selling your investment, the journal entry is bank account data to DRR investments. Am I right? As on which date? It is February 28, 2012. 28 February 2012. You are selling your investments, bank account data to DRR investment account. you will get 1,50,000 par value only. Nothing was mentioned means you are getting the same par value. So in DRR investment, if it is by bank, in bank, which is 2 DRR investments, 2 DRR investments. Now you get 1,50,000. Next. And the debentures were paid off at 101 rupees together with accrued interest. Now you should need to pay the debentures, guys. All of you, you should need to redeem the debentures. At the time of redemption of debentures, what is the journal entry? 6% mortgage debentures account debtor. Premium on redemption of debentures account debtor to debenture holders account. So I need to open premium on debentures as well. You can make it only transfer the principal here, then this account got closed. You need to open premium on redemption of debentures. I'll open here. Please concentrate, all of you. The account is premium on redemption of debentures. Just premium on redemption of debentures. So you can open a small account, not an issue. Right, guys, concentrate. The original entry is at the time of redemption. I'm writing here actually at the time of redemption. What is the original entry? So the debentures are 6% mortgage debentures. 6% mortgage debentures account debtor. 6% mortgage debentures account debtor. That is face value how much? 10 lakhs. How many number of debentures are there? Actually 10,000 debentures, which is 10,000 into 100. But we are paying with premium, that is 1 rupee extra. That is premium on redemption of debentures. Premium on redemption of debentures account debtor, which is 10,000 into 1 rupee excess, which is 10,000 to debenture holders account, which is 10,10,000. Then debenture holders account debtor to bank account 10,10,000. Am I right, guys? These are the journal entries, right? Now we will make it post. We already posted 6% mortgage debenture to debenture holders. 6% mortgage to debenture holders. Now premium on redemption of debentures to debenture holders. Premium on redemption of debentures to debenture holders account, which is 10,000. Then debenture holders to bank 10,10,000. In bank by debenture holders. We have existing bank balance 9 lakhs. We got through sale of investment 1,50,000. Total 10,50,000 we have. So from such 10,50,000 we need to make pay 10,10,000. Am I right? And the premium on redemption of debentures should make it set off with profit and loss account. That is P&L account at R2. Premium on redemption of debentures, which is 10,000. Now in premium on redemption of debentures by profit and loss account, which is 10,000. So with this premium on redemption of debentures account closed. Now all of you can observe 6% mortgage debentures account closed. DRR investment accounts closed. Bank account is not yet closed. Premium on redemption of debentures account is also closed. Okay, am I right? Now first if you come to debenture redemption reserve, how much debenture redemption reserve actually need to be maintained as per the provisions, as per the provisions of Companies Act 2013. I need to provide 10 lakhs into 10 percentage to the extent of 1 lakhs, but only in opening 50,000 is there. First you need to create debenture redemption reserve from profit and loss account, that is P&L account to debenture redemption reserve, which is for the purpose of creation of debenture redemption reserve. How you know? 10 lakhs into 10 percentage minus already there 50,000. Now for the remaining you need to create, which is 50,000. Now once the entire debentures are redeemed, the balance under debenture redemption reserve, entire debentures are redeemed, then the balance under debenture redemption reserve, simply you can make it transfer to general reserve. Tell me guys. So general reserve can make it transfer the amount of 1 lakh. This is debenture redemption reserve account. So debenture redemption reserve account is also over. Now the only one account with you is bank account. So you can close the bank account, guys, all of you. So you can close the bank account, but before closing the bank account, one thing you need to remember, you are having the proceeds as on which date actually, that is given, right? The proceeds actually is sold out as on February 28th. The date you can clearly mention here, February 28th. Sorry. So which is February 28th to 2012. One more thing you need to remember, sir, interest on debentures was paid up to 31st December 2011 only. But actually debentures are redeemed as on February 28, 2012. 2 months interest also you need to pay before making the redemption. So at the time of making payment of interest to debentures, what is the journal entry? Debenture interest account to bank account. Tell me guys, debenture interest account to bank account, you need to write such debenture interest as well. By debenture interest account. That is how much actually? So 10 lakhs face value of the debentures into 8 percentage into 2 by 12. 10 lakhs into 8% into 2 by 12, which is equal to 8,000 into 2 divided by 12. 13333 I got. Okay. Next, one more thing, guys. He clearly given that we sold the investments, right? As on February 28th, we sold the investment, but on the investment also we got the interest. Actually, till now I was not recorded, but before close the bank account, all the bank transaction you need to make it transfer. So what are all the different bank transactions occur? You will get interest on these debentures, interest on these investments as well. So interest on investment entry bank account data to bank account data to interest on investments. That's why in bank to interest on investments, to interest on DRR investments. Actually, before sale, this entry need to pass. Okay. First, I already made the sale entry, not an issue. 1,50,000 into 4% into 2 by 12. 1,50,000 into 4% into 2 by 12, which is equal to 1,000. Now you can carry forward the balance, by balance carried down. How much, guys? 9 lakhs plus 1,50,000 plus 1,000 minus 10 lakh 10,000 minus 1,333. How much is the balance? So 10,51,000 minus 10,10,000. 10,10,000. We got 41,000 minus 1,333. 39,667. The closing balance of bank. Now let us cross verify the entire answer, guys, one by one, all of you. So 6% is mortgage debentures. 6% is mortgage debentures. So by balance brought down, 2 debenture holders. We also made in the same way over. Debenture redemption reserve. If you check the debenture redemption reserve, sorry, where it is, debenture redemption reserve. Come down, come down, come down, come down. Yeah, here it is there. Debenture redemption reserve, opening balance 50,000. So to the extent of 10%, we need to create 10 lakhs into 10%. That's why 50,000 need to create, and which is the general reserve 1 lakh. Okay, we also made in the same way. Next, after debenture redemption reserve, what is the next account? TRR investments, debenture redemption reserve investment. Opening balance 1,50,000. We sold out it for 1,50,000. We also made in the same way. So what is the next account? Bank account for us. Come to the bank account. Okay. Now bank account. Opening balance 9 lakhs. Absolutely. To interest on debenture investments 1,000. We also got 1,000. Debenture redemption reserve investment sold out 1,50,000. Yes, absolutely. Debenture holders paid 10,10,000. And debenture interest, they recorded 10,000. Oh my God. But we recorded 1,333. How it is possible? Please let us check. So the problem, it is clearly given that 6% is mortgage debentures. Sorry, those are not 8%. I taken it as a 8%, right? Which are 6%. Okay, so if it is 6%, 10 lakhs into 6% means, please calculate, all of you. Any calculation mistake? 10 lakhs into 6%, I got 60,000 into 2 by 12. So which I got 10,000, guys. A clerical mistake, sorry. Wrongly taken 8%, and also I made a mistake at that point of time. So accordingly, you can adjust. The balancing figure is the bank balance balancing figure is 31,000. Yeah, now it is absolutely fine. Okay, so by debenture interest 10,000, the given percentage is 6%. 6% is mortgage debentures, right? So this is the end of bank account. And premium on redemption of debentures, they given under second account itself. 10,000, profit and loss 10,000. So we also made in the same way. That's it, guys. This is the end of problem number 1. Sir, in case of redemption of debentures, nothing is great. So simply you have to understand the problem, where the problem is. You should apply the provisions of Companies Act 2013. What you made here, simply you sold the investment, with that proceeds just made the payment to the debenture holders. But before doing that, you are collected interest from investment. Before making the redemption, you are paying interest to the debentures as well. And one more thing, that is by applying the Companies Act, by applying the provisions of Companies Act 2013, you check that, so to the extent of the 10% of outstanding debentures need to create in the form of debenture redemption reserve, but we are only having 50,000. So some more 50,000 you created and make it transfer to the general reserve once the debentures are redeemed. Am I right? Then finally you close all the accounts, you will get the balances. Premium on redemption of debentures, make it set off with profit and loss account. All are simply known things. That's it, guys. This is the end of problem number 1. I hope you understand. In the next video lecture, we will do more problems. If time permits, I will take a big lecture as a next video lecture. We can try to complete all the problems. Approximately we have 7 problems, I think so. Yes, approximately we have 7 problems. Yeah, we can easily complete. Okay, guys, bye. Hello, soldiers. This is a conclusion video after watching approximately 20 hours of marathon. You may feel that you are comfortable with a certain concepts of our accounting subject. You know, this is the marathon session where we try to cover approximately 50 to 60 percentage weightage of the marks syllabus, like fundamentals of accounting and financial statements of companies. Then we continued our journey with profit or loss pre and post incorporation, bonus and right issue, redemption of preference shares. Then I discussed the introduction to the accounting standards, framework for preparation and presentation of financial statements. Then certain accounting standards like AS2 inventory valuation, AS12 government grants, accounting standard 13 accounting for investments, certain important chapters like investment accounts and redemption of debentures. In fact, I covered very limited syllabus. The reason is, the subject of accounting is huge. If this is the regular course, we can go into the deeper roots. Okay, so hope at least you can utilize this marathon to cover in between 50 to 70 percentage of the syllabus. I know still I ignored very big chapters like cash flow statement and AST and PPE, branch accounts, certain departmental accounts. I know, but the coverage, as I already told you, the coverage is huge. But what are the topics I covered? I covered in detailed way. Okay, still, if you want to cover all those topics, you can choose the regular course, because my intention of doing this marathon is only for the purpose of revising the contents of the important topics. One more, guys, coming to examination point of view, how our preparation is going to be, sir. How our preparation would be, sir. You can start with the section 4 content first, as I told you, which is company related parts. So the chapters like finance statements of companies, cash flow statement, profit or loss pre and post incorporation, redemption of preference shares, okay, bonus and right issue, in the same order you can complete. Then you can start with section 1, that is with related to the accounting standards. The reason, once if you can able to finish it off the section 4 and section 1, approximately you may try to cover 60 to 70 marks. That too, section 4 is the huge coverage of in and around 40 marks, and section 1 is the mandatory question came. I mean, in the examination, the questions which are asked as compulsory is completely given from section 1 itself, that is accounting standards. So approximately 60 to 70 marks coverage is over. Then the remaining two topics like special transactions, like departmental accounts, branch accounts, special type of accounting, departmental, branch, incompleted, you can do. And the special transactions like insurance claims, hire purchase accounts, okay, such all other chapters you can do in the last phase. So that is the way in which you can complete all the chapters as well. Hope you enjoyed my entire marathon sessions. It is useful to the students who are going to appear their examination in forthcoming May 2022 attempt as well as November 2022 attempt. I'll come with another video. That video lecture is exclusive coverage of the recent past examination analysis and the RTP which is applicable to May 2022 attempt. So by coverage of the past examination question and the recent RTP, I'll come with another video lecture. You can get it very much soon. Still, if you have any doubts regarding the syllabus and anything, you can clearly put it under the comments. So if you feel it is a very good lecture and recommendable, so you can recommend to your students, which is necessary, because in the recent times, the revision part itself is too difficult for all such students. So if any of your friends or if any of your students, if it is necessary, you can recommend without any hesitation. Okay, that's it, guys. All the best for the forthcoming examination. Hope you will qualify with your CA Inter with flying colors. Until the next video lecture, bye bye. Have a nice day. See you soon.